Good morning. It is June 22nd. We're going to be streaming stocks, options, futures today. Watching the SPY, watching Jerome Powell. Looking at technical analysis. Sub up, like up, comment down. Happy Money sticks around. We have Twitter you can follow us on at Happy Money YT. I have that on the screen there. And Discord server. For both of those are in the description. I will put link for Discord in chat and pin it for your easy access. Okay, SPY. There was some data this. Switch browsers. Edge now. Instead of fixing Chrome, just use Edge. It's actually, yeah, pretty good, I guess. So I talked to IT guy. You might know him as Relocate. We need to fix something when you just use something else. Here we are. Interesting. Pretty similar browser, but hey, good morning, John. Give Root a shout out. Well, this catalyst you didn't know about. Where were you on that one? Kidding. Not sure why you shouted out Root, but yeah, Root has been given an offer to buy it for $19.34 a share. So we'll see if it trades up to that range or somewhere in that area. Still only at 14 bucks. Kind of interesting. GNS is the next play. Yeah, you imagine there are quite a bit of shorts on Root. Look up the... Yeah, the borrow fee. The borrow fee has been climbing. It's not high. It's 1 to 2%. It's been climbing. Yeah, and the available shares on iBorrow has dwindled. So this is what you want to see. They added shares traded on iBorrow. So yesterday they ran out of shares to short it. I mean, based on our data. Borrow fee is only 5%, but this could be the beginning of something. Where's GNS at? Did it ever fill that gap? Getting there. Had its little move from our RSI divergence, but didn't break out of this trend. So maybe it'll make a third RSI divergence, which would be a gap fill also. Then I'd probably be down to get some. About 6 minutes to open. Get ready in time. Did get a short on nat gas futures, but it kind of jumped around, so might not be. Probably just gonna close it. Not sure why it jumped around so much this morning. I don't know what all this was from. Fiscal, natty. Illiterate in over 40 languages. Something to be proud of. Good morning, Buzzin'. Thanks, guys, for your pre-market likes. I appreciate it. Got 12 of you. Awesome. Little bit. Go. I'll re-log into everything though, so this is gonna take some time. And you get a bunch of alerts because it's your browser. Up pre-market. Root's up 50%. Pixie's up 90%. Oh, Pixie. Is down 0.23%. And this morning we had, that's right, initial jobless claims. So previous was 262,000. Came in at 256,000. I don't know what the forecast was. Or no, wait. That is the forecast. It didn't come in yet? I'm not sure. 2 minutes. Why is Genius frustrating? Morning, Joseph. Yeah, I bought it. I bought Root yesterday, actually. And I think I still have it in my long term. Way down on it, though, so... it would have to be a proper short squeeze for me to get out of that position. Get back to break even. It's a small position, not long term. Okay, let's SPY. Let's delete this stuff. Let's get some fresh. I'll overflood it with lines. Pre-market low. Yesterday's low, which might act as resistance today. Be looking out for that. Not very high from where we are. All right, there's the bell. We're live. GME is down 1.2. Barbecue's down 2.4. Big is up 2.4. Morning Mo. I'm still looking to buy into barbecue, buy back in. So the news that I've seen on it has been pretty bearish to me, but I think there's still a trade there. Overstock's up 6.8. Maybe that's on the barbecue news. Jumps after winning bid for barbecue's digital assets. Yeah, there you go. So their initial stalking horse bid, I think won, solidified it. Good for Overstock. Let's see, Root's up 45. I'm just gonna hold this for a bit and see what happens with Root. Cost to borrow. The data we get on borrow fees is pretty skewed depending on where you're getting it. Yeah, iBorrowDesk. Oh, it shows there are shares. Oh yeah, you're right. You're right. Wow. Yeah, the borrow fee, 57% on iBorrow. They didn't have any shares available the last few days. They just popped up this morning with some shares. Interesting. Interesting. So I'm liking this as a support potentially where we are right now on barbecue. I'll be patient because I think we could even see 1925. Have to wait and see. IRNT's up 8.3. What are you doing, IRNT? GME's down 1.6. Ooh, Alt is up. Okay, Tree. Okay, Tree. 1.9. Yon's down 1.13. SPY's coming down a little bit. CFLT's up 0.5%. GNRC is down 1%. That gas position is now green. I think I might just close it so I can trade. What's it called? Yes. Root's hanging out there at 47%. Kind of interesting if it doesn't climb back up to, or climb up to that price. The SPY might make a bounce here and grab another another top on maybe this shoulder over here, like 436 area. Look to see if we get that and then a reversal today. Or we could just keep selling off. Let's see. Or we could also see this 432 first. We kind of we're gonna get the cup from here, this inverse cup. This is the cup, or we'll see one all the way down to the low J Powell, and then a bounce for the handle. But it could also happen here where we are right now, and then that bounce would probably bring us back up to this inverse head. Maybe not that high, but could be. What is it, Thursday? Could be today and tomorrow. You can see the SPY rally there, or if it keeps selling off, probably a bounce on that 432. Somewhere in there. Root. I am Root. Barbecue selling off. Wow, 1852. 1821, down 11%. Wow. I mean, that could be partially on that news from Overstock. 1802, 12%. So I didn't want it to break that support. It could double bottom on this level down here, 1750. We also have a 1790 as a support. Crazy. Quick early morning flush. TTOO? TTOO is up 15? TTOO. Sounds like a football player in a high school movie. Hey, TTOO. Little green candle there on barbecue at 18 cents. Got a support for its 1790, so maybe it'll respect that. 1750 is that low from last week. We do have JPOW. Could see similar type of just chop and mess during JPOW, like we did yesterday. Gonna be looking out for that. If we break this low, I'd probably take this short. Freaking, I guess. Gonna get out of it. Pop back up now. $17.70, $17.55. Broke through that support, so $17.50 is that low. We're right there. Buy moving up. Morning tasty. $0.18. Whoa, AMC's down 7 today? They get news? AMC slides Ape Surge as special master supports conversion plan. What does that even mean? So converting to Ape? Who's the special master? I'm the special master. I don't even understand the words on that. Beyond and Coin are both flat. This is down 1.5. PaySafe's down 3.5. Peloton down 1.7. Rup down 5. Barbecue 17.65. Root's coming down a little bit. It's up 40%. Pie's coming down. GME's down 1.8. Sterling Archer, is he going to get a ban? He gave a ban bet 2 days ago. Or yesterday? Yeah, yesterday, I think. I said this chart looks bearish. She's thinking it's 30 by, what, next Friday, I think? Friday after? Lawsuit reverse split approved. Court hearing one week. on them. Don't know what that says. So what, AMC and Ape have to converge in their price? Yeah, looks like it. Ape's coming up 11%. So why would you want to go long on Ape? Short AMC? Is that the logical move? Don't they have to converge? Barbecue, $17.99. Might be finding some support here. RS not confirmed? Oh. I mean, AMC sold off from it. News says it is, but says AM2 slides, Ape Surge, a special master supports conversion plan. Maybe it's just a news dump? Yeah, Ape's up 10%. It's a recommendation. The media recommendation. Iron T up 5. Objections kicked out, not officially approved. Oh, okay. So there's no objections, but it's not approved. Yeah, I see that GTI up 10. Unless they come out with another objection, it'll probably be approved, right? We're stuck up 4.5. Man, you guys will know a lot about AMC. June 29th, 30th. Maybe there's a reason I wasn't in AMC. Just sketchy. Sketchy all around. Barbecue 18 cents. Root hanging out at 45. Iron T 5%. Stock 4.5. Nothing honest. Goes to court next week. There's a little bounce on barbecue. Yeah, double bottom. Might pick up some shares here if I can. If I get a fill. Get a fill. If I can get a fill. No. Head and shoulders, inverse head and shoulders is dead. We've moved down to the head, so might be double bottom. Need today to kind of do a complete 180 for it to look bullish. Can't believe that MACD has actually stayed bullish this whole time. That's strange. Big is down 2.5. Dish is down 1.5. G. Happy Thursday to you, Daniel. GME's down 2.3, fingers up 11%. You'd think the buyout price for root was like 14 bucks. So it won't necessarily go all the way to the price because, you know, the deal might not go through. So there is some risk, and that's why it very well might not trade at the price that it's potentially being bought for. It's still, I mean, still supply and demand. So people are scared at this point. This is where it's at. Well, you hope it's supply and demand. It's not, but whatever. I don't know. As more news comes out, I mean, there's definitely catalyst for more news to come out and it to allow for it to rally or drop. So, really don't know. As time goes on, and if there's not news sounding like it's going to fall through, then this should slowly get up to 19 something. I do still have root in my long term. I only have a few shares though because all those reverse splits. Ah, we suck again. Oh my gosh. I used to have a lot of shares this thing. Wow. Not even enough for a covered call anymore. Barbecue kind of consolidating down here. See where it goes. 45% on route. Tough builds up 10.8. Overstock plus 6%. GME down 2. Yeah, AMC dropped on the news of chat knows about it. The special master, I guess he doesn't, it's not finalized, but he supports a conversion plan of APE and AMC. So I think that would mean these would have to converge on their price. Fair price on what, Jay Solis? I think we've got Powell in 10 minutes. Thanks guys for your likes. I appreciate it. We're at 18 likes this morning. Target price on SPY? I don't really, what do you mean? I don't really have a target price on it. Up. SPY will always go up. Eventually. There's a little pop on Le SPY. Got a little shoulder here and here. See if we make a head and another shoulder. Or this is just double bottom. That kind of handle being built potentially. That's above yesterday's low. Next resistance is the day before. I grab a short up at that. Alt's up 1.5. BNRC is down 3.3 now. So the short call on that is going to work out, I think. SPY climbing up a little bit. Let me see if I can get feedback. We have oversight of the SEC going on right now. With that feedback. Stop. 2 p.m. margin calls. Eyes coming up. Barbecue's hanging out at the low. GME's down 2.3. Overstock up 10.25. Root's coming down a little bit. 31%. If he gets a bounce there. Finger is up 4.5 or 4% still. Still climbing. Barbecue down 12.25. Fish down 2.25. Timing though. Ups down 8 again. Four. Hey, pow pow. Oh.
Healthcare is not.
Auto is at 10. Maybe it's not at 10. Let's see. That's definitely at 10. High rallying. And rejection right on that line. Yeah, root kind of bounced a little bit off that market support. I have still 5%. Down 7.5. Down 2.4. 8. Down 2. Stay safe down 3.75. Peloton 1.3. Companion down 7.8. That gas just flat. I liked the Head and Shoulders, and it broke out above it. Maybe now it's just in a bull flag. UNE up 3.5%. It really got its Juneteenth pump. Well, good news and bad news. Barbecue. Good news is showing support at a previous support. Bad news, it's doing it with a bear flag. So see which way it breaks. It's already down 12%. It breaks to the downside. Definitely looking at some cheaper prices on it. 15 cents, 15.5, maybe 17 cents even. Hey Lords. News and Barbecue Overstock, I guess won the bid. They were the stalking horse bidder and they won. So I don't know what exactly they won. They won a part of Bed Bath & Beyond. I don't think it has any baby involved. And I don't know if it's all Bed Bath & Beyond or if it includes that or what's in there. Let's see. 21.5 million offer encompassed most of the retailer's intellectual property, brand name, mobile platform, business data, marketing material. There you go. Most of it. The offer didn't include the company's physical stores, meaning that all stores that are still open will eventually shutter. Hundreds of stores have already closed nationwide. Those that are still open are conducting aggressive closing sales to get rid of the remaining merchandise. They're really not, though. 20% off is not a liquidation sale, which is what a lot of them have. But that could always increase. Bed Bath's debtors had selected Overstock to be stalking horse bid, the initial offer that sets the bar for competing bids earlier this month. Since Overstock won, Bed Bath didn't receive any higher offers for its assets. Not necessarily, because since they pick, it doesn't have to be the highest. You say just the IP, like, is it not everything I just read there? Most of the retailers' IP, their brand name, their mobile platform, business data, and marketing material. Jawa Brands and 1024 were selected as backup bidders for some of Bed Bath's assets. Jawa bid on Bed Bath's Suita private linens brand and 1024, a software company that does business under Beyond Pricing, bid on the company's Beyond.com web domain. It's getting pieced out, looks like. Court will give final approval for sale on June 27th. There have been questions over whether Bed Bath would be able to secure a buyer for some or all of its assets since it filed for bankruptcy in April. Bid deadline had been extended several times as Bed Bath negotiated with the potential bidders that emerged in recent weeks. Bed Bath is hosting a separate auction for its baby-oriented chain, which has long been considered the company's strongest asset. Buy Baby had attracted acquisition interest since before the company's filings. Baby List, an online baby registry site. Bid on Bye Bye Baby digital assets, including the website, email marketing, and social handles. Still no news of RC in there. I mean, he is on the filings, interested party, and as a creditor, so it's kind of strange. I don't know what all that means though, and if that's even good for us shareholders or not. We really don't know. SPY 433 put. How much time? We have a lot of time. I think it'll play. Depends on your plan. When would you get out? Scalping it, you can get it right now and close it out and we hit the VWAP. Little green candle there on barbecue. I picked up some shares. Eyes coming down. No release till June 27th. Yeah, maybe.
And I would ask you in your role as the active executive officer, if you would take some action firing those responsible for missing what was glaringly obvious now to all of America, certainly should have been obvious to the supervisors. I said from the beginning that this has been a failure in three parts, the SVB and signature. It was a failure of the bank execs. The action that we took 21-2 yesterday reinforces Congress is willing to take the lead and hold bank executives accountable. Second failure was a supervisory failure, and that requires the Fed to hold folks accountable just like Congress did. And third, the Biden inflationary economy that has drove
moving up there
really high and resulted in 10 rate increases from you all. And
breaking out to the upside.
Downfall, as the vice chair released his report on the failures, we heard directly from you that your role was to announce it, to get briefed on it, but not necessarily to be involved in the work of it. So my question is, as you watch Vice Chair Barr roll out higher capital standards, it seems like your very clear statements is that you will be supporting as well as working to implement Vice Chair
Eyes now
Barr's
green.
recommendations. But as you know, that the other members of the board, Governor Bowman has recently said that Mr. Barr wrote a report on Silicon Valley Bank's failure that provided his conclusions and went on to state that the report should be used to help guide discussions among policymakers, not necessarily just to rush towards implementation of Vice Chair Barr's recommendations. I'd love to hear your thoughts on that path forward, if in fact your job is to rubber stamp the decisions of Vice Chair Barr, or is your responsibility to take into consideration the Vice Chair's recommendations and then chart a path that seems to be consistent with what is in the best interest of our nation and, frankly, of our financial institutions? I do not believe that increasing significantly the capital standards is in the best interest of small businesses or people looking for loans. The more capital we put on the sidelines, the less capital there is for us to see our financial institutions loaning the money out. I look forward to continuing our discussion during the question and answer time.
Thanks, Senator Scott. Today we'll hear from the Chair of the Federal Reserve, Jerome Powell, on monetary policy and the state of our economy. Thank you for your public service, Chair Powell, and please present your testimony. Thank you.
Again, it should be the same as yesterday. Slight changes.
That's stock market live we're listening to.
It's popping up until he speaks. You're doing the pre-written statement pop.
We at the Fed remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve, and without it, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. I'll review the current economic situation and then turn to monetary policy. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains
So it looks like we're getting our handle here.
5 months of the year, job gains
437 might be the retrace.
314,000 jobs per month. The unemployment rate moved up, but it remained
Looking for
low
an entry to go long. Also, if you got
3.7%.
nat gas too.
There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, especially for individuals aged 25 to 54. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total personal consumption, or PCE, prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index, or CPI, came in at 4.0%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. With inflation remaining well above our longer-run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points since early last year, and we've continued to reduce our security holdings at a brisk pace. We've been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we have come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the FOMC decided last week to maintain the target range for the federal funds rate at 5 to 5.25%. And to continue the process of significantly reducing our securities holdings. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient.
Banks are sound and resilient. The banks are sound and
We
resilient.
ain't got that one in a
The
while.
Federal Reserve, together
Hell
with the
yeah.
Treasury
Even-
Department and the
even
FOMC, took
the
decisive action
stock market's
to
laughing about it.
the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including the failure of Silicon Valley Bank and the resulting bank stress, have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We're committed to addressing these vulnerabilities to make for a stronger and more resilient banking system.
Little Big Knock got 100K.
To conclude, we understand that
Awesome.
our actions affect communities, families, and businesses across the country.
I got a very small
Everything
amount.
we do is in service to our public mission.
SEC's making
We at the Fed
comments
will
on
do everything we
JP
can
Morgan
to
SEC
achieve
allegations.
maximum employment and price stability.
Something on JP Morgan.
Thank you, Chair Powell. Paul Donovan at UBS has discussed the role that corporate profiteering plays in persistent inflation. While inflation has fallen from 9%, as you know, it has peaked to 4%. Prices continue to climb because of supply shortages and corporate profiteering, what we're starting to call greedflation. Given that rising interest rates certainly won't solve greedflation, why maintain interest rates at the current level or even consider, as you suggested, raising them again, given the risk of harming the
Palo
livelihoods
Alto's
of
on the
more
high
than
too,
1.5 million
and Uber.
workers and their families?
Mr. Chairman, the committee broadly feels that while monetary policy has gotten to an appropriately restrictive level, if the economy performs about as expected,
It rejects right on our line
to
there.
raise hikes again this year and perhaps twice. A strong majority of the committee
Wasn't even
feels
that
that it will be
heavy of a
appropriate,
result.
again, assuming that the economy performs as expected 2 times before the end of this year. We've come very far, and the reason why we maintained our rate at the last meeting was to give ourselves more time to stretch out the time for making these decisions. We moved very quickly at the beginning, and we've gradually slowed down. This is just a continuation of that. But we are committed to getting inflation under control, and the strong majority of the committee feels that we're close, but there's a little further to go with rate hikes.
Well, thank you for that answer, but Mr. Chair, what Fed governors call cooling down, regular people where I live call them layoffs. I mean, the question is, why should working families continue to bear the cost of fighting inflation? Why should they lose their jobs so that corporate profits can continue to balloon? Let me move to the next question. Our economy's created 13 million new jobs in the last 2.5 years. Black and Latino workers with the lowest incomes have seen the greatest gains in job opportunity and wage growth. What the Fed considers too hot an economy has given these workers their first leg up in decades, if ever. We know that job losses will hurt those same workers the most. How will higher interest rates and the resulting job losses disproportionately impact Black and Latino and low-income workers?
Well, we have quite an unusual situation in the labor market where we've had persistently much higher demand
So you
for
see
workers.
Remember how I
than
tell you
the
guys
available
sometimes
supply
like
of
it's
workers.
coming across the
So
wire? This is
some
just one of
the
many
process
wires
of
too, by the
getting
way.
demand and supply
But
back
you're seeing it.
into
Powell,
alignment
the
has been
newswire
taking
picks
place
up Powell's
through,
comment.
declining
So
job
that one's
openings
highlighted in red.
and
It's
through
saying
lower
Powell
quits
likely
rates and
appropriate
through
to
wages that are
raise rates
moving,
2 more times
they're
this
still
year.
very high, but moving into more sustainable levels of increase. So actually there hasn't been a meaningful increase in unemployment. The unemployment rate has bounced around at historically low levels, and that's fine. That would be the perfect way for this to continue to happen. There's no guarantee that will happen. I would just say that it is working families who suffer most directly and quickly from high inflation, and it is for the benefit of those people and all other people that we need to restore 2% inflation in this country on a sustained basis.
And thank you, but in the dual mandate suggests that those workers that
Yeah, this is his stream you're watching.
for those
I couldn't find anywhere else.
But we also know that those workers are the first to be laid off, and I would hope that in your next meeting the Fed recognizes those disparities and gives them real weight as you make decisions that
Buenos
will
dias,
likely
Ace.
at some point result in more layoffs.
I don't know if
Probably my
barbecue's
last
done.
question. Since you last testified
I
in
mean,
front of this committee,
all
we've
the
had 3 of the
hype that
largest
people had on
bank
barbecue
failures in US
hasn't been
history.
disproved yet, I guess,
You explored that
for the
a
most
bit at the
part.
end of your testimony because the executives at those banks failed.
It's not been confirmed that RC is not part of it.
Regulators took swift and decisive actions to protect the banking
Or
system.
Icon. I mean, there's still
Thank you for
NDAs
that.
floating around out there.
That's in stark contrast
Redacted
to
names.
regulators'
I thank you for
supervisory
that.
failures in the years
I just
before
didn't
the
know
08
it.
financial
So,
crisis. What actions are you taking today to prevent more
I would like to
bank
find
failures,
one that doesn't
to make
have.
sure banks do real risk management and address liquidity and other basic risks? And you may impart one answer. I mean, he can do it himself, but Ranking Member Scott's comments on those Vice Chair Barr
There we go.
and where that takes us. What do you do to make that will likely at some point result in more layoffs? Probably my last question. Since you last testified in front of this committee, we've had 3 of the largest bank failures in U.S. history. You explored that a bit at the end of your testimony because the executives at those banks failed at Banking 101. Regulators took swift and decisive actions to protect the banking system and depositors. Thank you for that. That's in stark contrast to regulators' supervisory failures in the years before the 08 financial crisis. What actions are you taking today to prevent more bank failures and to make sure banks do real risk management and address liquidity and other basic risks? And you may impart one answer. I mean, he can do it himself, but Ranking Member Scott's comments on Vice Chair Barr and where that takes us. But what do you do to make sure banks do real risk management and address liquidity and other basic risks?
So I would say we are committed, and I am personally committed to learning the right lessons from what happened in Silicon Valley Bank and the other 2 failures and vigorously implementing appropriately. I think there's a clear need to strengthen both supervision and regulation of banks of that size. And I can go into more specifics in the course of the hearing, but I do think we need to learn those lessons, and I think we've started to do that. And it's something, what we saw was an unexpected bank failure overnight led to contagion and threatened the broader banking system, and that's not supposed to happen. And we're gonna take appropriate measures to reduce the chances that something like that would happen.
Let me follow up briefly on that. The Fed plans to propose an overhauls we've talked about to existing bank capital requirements, so we have a more resilient banking sector. Is increasing capital requirements for banks with $100 billion or more in assets to prevent future bank failures, is that a strategy the Fed plans to, is willing to deploy to promote financial stability?
So we have not come to there hasn't been a final proposal. There's been a draft proposal that's been circulated, but it's, in my understanding, it's not final, and I know things are still moving around a little bit, so I don't really have a final proposal.
Picked up a few more barbecue shares.
I do think
Very small compared to what I had.
Increases that are getting so much notice are really on the larger banks. There may be also some capital increases in the proposal for banks down to $100 billion, but not below that.
And yesterday you said we want to, in particular the G-SIBs, the 8 largest banks, to have high levels very high levels of capital and liquidity. You stand by that statement?
I did, and I said, of course, we did spend years raising capital and liquidity standards a great deal on those institutions, and I supported all of that. And then I concluded by saying that further increases, if they are proposed, will need to be justified, though, of course, as any change in rule would be.
Senator Scott.
Chairman, let's stay with the capital requirements as you and Chairman were talking about on the larger institutions, but frankly,
I'm liking Edge. Browser's
financial
fast.
Capital levels were in the single digits. In the last decade, it seems capital is continually being raised. My question is, how much is too much, and when is enough enough? We are going down a path where something happens or something goes wrong, and the only default solution seems to be to raise the capital standards or the capital on the sidelines. And the formulas that I use are real simple formulas. The higher the capital standards, the lower the capital for the private sector, which means fewer loans and less capital for those who are actually creating jobs. And so when we have too much capital,
Picking up some long on the futures.
We have too little capital for actually creating and producing a vibrant economy. At some point, if you've raised it,
I'll probably keep building this account, trying to build this small account up, $200 with day trades on SPY, the options,
is a possible outcome.
Webull account.
That's,
Only sell one trade a day, I think, is all I'll be doing.
Point out there is a trade-off
Be less even.
making the banks safer, more secure, more resilient. You want them to be very strong, particularly the largest banks, so that they can continue to intermediate and lend money and things like that, continue to function during stressful situations.
Talks
But
low.
with bank capital, it's always going to be a trade-off between the availability and cost of credit and how much safety. And I think that's the question we're going to be addressing and answering as part of this process.
As you continue to work on fighting inflation, which I think is job one of another simple formula for those of us in the real world of business, we hear a lot of celebration around the jobs that are being created and the wage growth, but the way I look at it is wage increase minus inflation has led to less spending power. Do you disagree with that?
No, I think that's right.
Yeah. And so in the end, as we celebrate what seems to be a healthy economy, the truth of the matter is that the average person in our nation
I want to wait for the put.
to make their ends
My
meet
one
because of
option
inflation
play on the SPY today.
on their bottom line, and what that means
After a
for
high.
them is that there's a crisis.
Oh,
where
might be a
single
couple
mother
hours at
that
least.
raised me or
Call, I
seniors
just don't see as much upside.
and we have yet to, as a
I think we'll
nation,
reject
adjust
437.
for the 500 basis points increase
Somewhere
in how we
thereabouts.
service our debt. Said differently, the more money we have,
But my futures I can trade as
for
much as I want, so I got long on the
debt,
futures.
less money we have for meeting the needs of the American people. Therefore, printing and spending $4 trillion.
Last resort. No, I talked to relocate.
COVID
Edge is way better now.
led to the
Oh, they're
election
actually on the
overseas,
Chromium
and
platform.
that, as a result, led to the
And
10 rate increases.
yeah.
So how do you, as chairman
Sick.
of the Federal Reserve, talk to
It's like Google, but it
policymakers
actually
about
works.
the importance of being responsible from a monetary perspective? I know I've seen and heard your comments that that's not
Back on 100,000 shares.
certainly the actions that we take here impacts,
there you go.
frankly, significantly what you have had to do in order to slow down Biden's absolutely explosive.
I can turn the volume up if you guys want, just let me know.
Let me start by saying that actually you were talking about real wages a moment ago.
Yes.
Real wages actually did go up at the lower end of the income spectrum, and now they are
Bottom
positive,
quintile.
but they're not as positive as we'd like to see them.
Yes.
So, but to your real question, I would just say this, that the U.S. federal budget is on an unsustainable path. It has been so for a long time. We need to deal with that sooner or later, and sooner is better than later. But that's what I can say, and that's what essentially all of my predecessors have said. We are not charged with supervising fiscal policy in any way. It's just, but as a high-level matter from the standpoint of the economy, that's what I can say.
Well, here's another analogy that works for me as a former football player, a running back. If my line isn't blocking, and I keep getting my head hammered, I'm going to say something to the line. At some point, I think it's your responsibility to talk about the importance of fiscal responsibility. That to the side, my last thought and question for you is that SVB suffered because their bond portfolio ended up carrying water in a negative way. You have a $8 trillion balance sheet and beyond. Every report that I've read is that your bond portfolio, our bond portfolio, the Fed, is underwater as well. Can you talk to me about the losses that you're experiencing at the Fed from a bond perspective?
Remember that the way it works at the Fed is when we buy assets during QE, we pay for them with overnight interest rate reserves. And for many, many years during the QE era, we've earned a spread, and we've been sending money to the Treasury way over $1 trillion since QE started. And so now that rates have gone back up to 5%, that process has reversed. And these are paper losses. They have absolutely no effect on our ability to conduct monetary policy or really on the economy. It's an accounting fact. If we retained capital, then that would be it would look completely different. But we don't. We give all of our profits to the Treasury.
So you were giving profits to the Treasury, now you're not. That has an actual effect. I mean,
well,
if I was getting $10 and now I'm not, there's an effect.
Well, the Treasury then will have to borrow money that it doesn't get or raise taxes. It'll have to get the money to
Correct.
carry out the spending that Congress authorizes. Yeah. But that's not going to it's not going to affect interest rates and things like that much.
To me, I have the holistic view of our economy where if, in fact, we have fewer dollars coming in, which requires us to raise taxes, that in the end has a real impact on American taxpayers. But thank you.
Thank you.
Senator Scott, Senator Menendez, of New Jersey.
Thank you, Mr. Chairman. After announcing the rate hike pause last week, you said that inflation has not reacted much to the Fed's past hikes. And I'll admit I'm a bit puzzled by that statement. The Fed's first rate hike was in March of last year when non-core inflation was at 8.6%. It is now 4%, and core inflation has fallen as well. So that sounds like progress to me, especially when you consider that according to the San Francisco Federal Reserve, it can take more than a year for tax rate hikes to take full effect, which means that so far only 3 of the 10 rate hikes since last year are in full effect. So can you expand a bit more on that statement from last week? What progress do you expect to see that you currently aren't seeing?
Sure. So, of course, you're absolutely right. Headline inflation has come down by essentially half, but that's largely due to energy prices coming down and commodity prices that go into food coming down. And those are not, I won't say that they're not affected at all by monetary policy, but they're principally affected by other things in the economy. The war in Ukraine drove energy prices up quite a bit, and also food prices. That's not really, those things are not principally a function of monetary policy, although we probably have some effect at the margin. So we look at core inflation, and we look at how tight the economy is. We are seeing progress, for example, in supply chains getting better. That again is not really a function of monetary policy. Really, where monetary policy takes effect is in the service sector. And that's where we haven't seen much progress. So, but we are seeing progress in other places, as you point out. Inflation broadly is coming down, but as I said in my remarks, we still have a long way to go. Inflation is still running between 4% and 5%.
So do you think that the lag period for rate hikes to affect inflation has lengthened, or are rate hikes as a monetary policy tool becoming less effective?
I don't think they're becoming less effective, but these are real questions. And the thing with lags is, this day and age, financial conditions react before we act. So the markets are already pricing in rate hikes. So that's quicker. But the effect of those financial conditions on the economy still takes time. It works very quickly on housing, for example, but less so on the service sector, which is not very interest sensitive. So I don't think that has changed. Others have a different view and different directions they think in which it's changed. There's not a consensus agreement on how long monetary policy takes to affect the economy. So some people think a very long time, some people think right away. So I tend to think let's look at the middle of that, and a year and change is That's not a bad way to look at it, but policy actually started tightening well before that. Before we didn't raise rates until March, but policy had already tightened substantially before the first rate hike in March.
Well, I will say, I know that you have a dual mandate, you know that as well. The last jobs report shows that unemployment is starting to tick upward for women and African Americans. So I hope that the cure is not more consequential than what we're trying to achieve. Recent reports reported that there's almost $1.5 trillion in commercial mortgages that will come due in the next 2 years, many of them held by small and regional lenders. With property values declining and interest rates rising, these mortgages could be serious liabilities for many banks. Do you think that we may see some banks fail as these mortgages come due? And if so, what can we do ahead of time to prevent that scenario?
So we're spending a lot of time on these issues, and we have been for quite some time. And again, I think you put your finger on it. It's really which banks have concentrations, high concentrations of real estate, and that is not seen in the large banks. It's seen in some of the smaller banks. So we've identified those banks, and there's a supervisory toolkit where we work with banks to try to help them resolve those issues by raising capital or dealing with what's happening. And of course, what is happening in the office space nationally? There's an issue with people working from home and just less demand. There's a sort of one-time adjustment going on. There are also some other pockets of commercial real estate where there's some softness. So we're working with banks to work our way through this. We're very aware and very focused on the problem.
Well, I'm concerned that it's a ticking time bomb. And let me just say that last week you said that commercial real estate risks are unlikely to pose a systemic risk because the loans are broadly spread and mostly held by smaller banks. But how can we ensure that the potential losses in the commercial real estate don't lead to the draining of assets from smaller and mid-sized banks and then create further consolidation in the banking sector that brings us back to, I don't want to be back to 2008 when I was here and was asked to do extraordinary things.
We certainly don't want to be there either. And so we're being pretty proactive about reaching out to these institutions and trying to help them get through these significant issues. Again, it's not all smaller banks. It's just some of them have high concentrations in real estate, and it's not in the large banks, which of course was where the problem was in 2008 and 9.
Thank you, Mr. Chair.
Thanks, Chairman. Senator Kennedy of Louisiana is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you for being here, Mr. Chairman, and to your colleagues. Thanks to all of you for giving so much to our country. As you know, our fiscal year, meaning the federal government's fiscal year, begins October 1. We're in the process of putting together a budget. If we pass a budget, we meaning Congress passes a budget that increases spending by, let's say, 10%, roughly $650 billion, what will be the impact on inflation?
So if it depends on, of course, if it were funded by tax increases or other spending cuts, I guess in your hypothetical, it's not. So I think deficit spending at the margin stimulates the economy at the margin. It's a big economy, though.
And what will be the impact on inflation?
It would probably be a small effect on inflation ultimately, but there would be an effect through stimulation of the economy. It would be more demand, which would, just in general, I'm not commenting on.
I know.
I'm sort of commenting on fiscal policy here, but nonetheless, there would be an effect on inflation.
I'm just asking you about basic economics.
Yeah.
I just read a piece by one of your economists from the San Francisco Fed, Mr. Shapiro, who's arguing that
back to BBBYQ.
Labor costs had virtually nothing to do with service inflation and a negligible is a negligible factor in broader inflation. And I read this stuff from some of your people, and I just wonder what planet they parachuted in from. If Congress passes a budget, in my prior example, that reduces spending by 10%, roughly $650 billion. What impact will that have on inflation?
So that would, you'd have less stimulus for demand, and you'd be cutting programs if you did that, and therefore you'd be slowing the economy down, and the impact would be less demand. Neither of these ideas affects the supply side at all. So less demand would mean less economic activity, less spending, and that would have a negative effect on inflation.
Well, more stimulus by federal
Pretty big red there on SPY.
Is inflationary. Is that right?
It has so we've been in this situation where inflation was so stable for 25 years, you remember, and almost nothing that we did mattered for inflation. And it's called the so-called flat Phillips curve, where there just wasn't a connection between how tight the economy is and inflation. That does not appear to be the case right now. I think many people would say that the Phillips curve is now not so flat, and that there is an interaction between.
So that's a yes.
I think that's a yes. Yeah, it's
okay.
This is economics,
And less spending by government it means less stimulus, which tends to be disinflationary. Is that fair?
Yes.
Okay. Let me ask you about the Basel III end game. You know what I'm talking about?
I do.
There's been some reporting, and of course, not every country has to follow the Basel recommendations. The European Union is not following. They're going their own way, and we're kind of going our own way in America, using the Basel directives as a guidepost. But it's been reported that the Fed's going to raise capital requirements by as much as 20%. Or, excuse me, it's going to raise capital requirements to 20%. Is that right?
No, the idea would be to raise them by 20%. In other words, if 20% of whatever current capital requirements are, you would raise it by 20% of the total existing amount.
Okay.
So
if J.P. Morgan's capital requirement right now is, let's say 13%, it would go to 15%?
Right, something like that. If that were to be what happens.
And this will be for banks $100 billion or more?
No. There isn't a final proposal. So, and I know it's still in motion. I know things are still changing.
Yeah, but you folks are talking
I've been
about
briefed
it, and
on
you're going to have a lot of input.
No, that's right. So, but I will say, sorry, what was it? Your question was?
Are you going to raise capital requirements for 20% to banks $100 billion or more? Or are you going to affect community banks as well? Smaller?
No, the capital requirements will be very, very skewed to the 8 largest banks, the GSIBs. There may be some capital increases for the other banks, and there won't. I think none of this should affect banks under $100 billion.
The really big banks you're talking about?
Yes.
Are they the ones that are at risk right now?
They weren't. They were a source of strength in a place of strength.
They're doing pretty well.
Turmoil. Yeah.
We've gone from too big to fail to we're damn happy they're big. I mean, haven't we?
Well, I would say that, as I mentioned, we spent a lot of time and a lot of effort raising the capital standards 10 years ago and more recently, and I supported all of that and was happy to do so. And I think.
Senator Kennedy's time's expired. Senator Smith of Minnesota.
I yield back.
Chairman, Senator Kennedy, as you always do, on schedule, on time.
Thank you, Mr. Chair and Ranking Member. And Chair Powell, welcome back to the
It's like a boxing match.
So I have a slightly different perspective than Senator Kennedy does on this question of inflation and debt. I don't think that discretionary spending is the problem when it comes to our federal budget. If you look at it, military and non-defense discretionary spending has hovered at about 3% of GDP for the last 30 years. And in fact, discretionary spending has decreased over the last 30 years. So clearly, that is not the problem with what's going on with our debt. It's not what's driving debt growth. The big change is in revenues. So the national debt has increased to nearly 100% of GDP because of the Bush and the Trump tax cuts. And without those tax cuts, in other words, if we'd left our tax levels at roughly what they were in the Clinton administration, I mean, which in no way restrained economic growth, the budget would only have been significantly out of balance during the Great Recession and during COVID. So, Chair Powell, I'm not going to ask you to comment on that because I know you don't like to comment on fiscal policy, but I feel that that's important context for the committee to have as we think about what is driving inflation and what we are doing about it. I have been really struck by how remarkably resilient the labor market has been over the last 16 months or so, which is a good thing as we do the work we want to do to grow the middle class and create more opportunity and more financial security for people. And so rates have risen 10 times, yet unemployment is still near historic lows, and wages are growing. Now, as you and others have pointed out, real wage growth has been clearly impacted by inflation, which is a real challenge for especially middle-class families, working families. Although I believe, as you said, Chair Powell, let me just check this, that real wage growth has ticked up in the last couple of months. Is that right? Do I have that right?
So at the beginning, it was positive real wage growth only at the bottom of the income spectrum. I believe now on a 12-month basis that overall wages are moving up faster than inflation.
Right.
Just recently.
Right. And so, I mean, I think, clearly we're not there yet. Clearly we have more work to do. I'm encouraged by the progress we've made so far. And I also just want to point out that the significant investments that we have been making in domestic manufacturing and bringing supply chains home and supporting prevailing wage jobs, I think are an important part of this success story, this economic success story, not mitigating the impact and the need to continue to bring inflation back down. So, Chair Powell, my question for you is, you said last week and you're saying today that while the labor market remains tight, you're seeing signs that labor supply and demand are falling back into sync. Do you see a path for inflation to continue slowing without us seeing significant job losses and doing harm to middle-class families, working families?
I do continue to see that path, and you're right. It is the labor market is really the strength of the economy. It's what's driving the economy. It's very, very strong demand for workers, and workers are getting jobs and they're getting paid and they're spending money, and that's driving demand and the whole thing. But it's gradually cooling, and that's what we would want to see. Mm-hmm. So I think there is a path, and ideally the means by which demand and supply get back into alignment will involve things like the job openings rate coming down as opposed to the unemployment rate going up. Mm-hmm. Although if you look at our forecasts, it's not a desired objective, but we do expect on this path that the unemployment rate will go up a little further because it is historically low, even at 3.7%. Until the last few years, we really haven't seen that for 50 years. Mm-hmm. So we do think it'll come up a little bit, but ideally, most of the loosening will come in the form of other ways. Right,
and so to the extent that we're able to pursue policies that strengthen the labor market, that contribute to the resiliency of the labor market, it seems as if that should help to mitigate the negative impacts on the labor market that rising rates would have, because in effect what rising rates do is it slows growth and potentially leads to layoffs.
So our part of it is to try to get inflation under control, and that's what we're doing. And ideally, we'll do that with with as little as possible, damage to the economy and the labor market.
Great. Thank you very much. Thank you, Mr. Chair.
Senator Smith. Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chair. Chair Powell, thank you for being here. I got a quick question. Yesterday, Governor Cook said in this committee that the Basel Endgame proposal from the vice chair, she has not had an opportunity to look at it. Now we hear reports that I think that it's 1,000 pages long, probably with a lot of technical information. How much time are the voting principals going to have to fully review and vet this proposal? And is there any expectation that review would result in any changes, or is it just a matter of them either saying yes or no, they agree with Barr's recommendations?
So, I I would say I will make sure that there's enough time for governors to review the final proposal. We've been briefed on the contents of it, and it's still in motion. There will be a proposal that comes to the board for approval, and it'll be subject to discussion, and it's possible there will be further changes before the vote or as a result of the vote, but we'll make sure people have time to review it.
As you're going through the review process, do you believe that it would be appropriate to give members of this committee or members of Congress a sort of roadmap for what the recommendations entail prior to moving forward?
So I think that'll happen, I think that'll happen because I think Vice Chair Barr would probably be giving public remarks at some point before the meeting, and I guess I understand now that the head of the FDIC actually gave a speech this morning. I didn't see it, but I know he gave a speech about this subject.
Can you explain why comments from Mr. Barr about having a safe and sound banking system square with a banking system that needs additional capital?
Sound and resilient.
So that's the question is, of course, we spent all those years raising capital for the largest banks, and I think further increases will have to be justified, and they will be. We've always known that the Basel III endgame was going to bring some capital increases and bring a discussion about the trade-offs, and there are trade-offs between higher capital, and that's the discussion we're going to be having, and we haven't had it yet, but we will.
I watched your opening testimony in my office. Actually, Gus was there. He says hello. Chair Powell's met my office dog. But
hello back to Gus.
But
I said he was a good boy.
Mr. Chair, you've you got me. I'm kind of curious about Silicon Valley Bank now. Yesterday, we had an appropriate hearing and a markup on executive compensation. I voted against it for a couple of reasons. I think we need to work on more tailoring, and I hope as it moves through, we can work in good faith to address some things that would get me to a yes. But another reason why, or one of the concerns I had about that meeting is I think we could pass an executive comp bill and think that we're done with the root causes of Silicon Valley Bank. I, for one, think it was equal parts of management malpractice and supervisory malpractice.
All right.
So the question I have is who in the Fed is ultimately going to give me a straight answer on what the breakdowns were in the supervisory functions, who those people were, and to the extent that we found less than adequate supervision, what's the disposition of their jobs? Who's that person? Because I ask everybody and they say it's not in their lane. So who is the person that owns me? In the same way that we've mapped the CEO and various members of the bank having made egregious decisions that they should have their compensation clawed back, who can I talk to that says we've looked at the supervisory process, here were some lapses, they didn't use the optionality of 2155. We now are seeing increased reports of MRAs and MRIAs, so I think there are supervisors out there that are probably understanding Senate Bill 2155 better. But who can answer that question for me? This comes down to a handful of human beings who are responsible for the supervisory functions of SVB.
Tough for me to say that something's not in my lane. So
yeah,
and I also think tough for Vice Chair Barr. So it is our lane. And, but I what. So if I can address what it is you're asking though, it's I would say clearly supervisory failures. And let's not just say San Francisco. It's very much at the board. We are accountable. It's a delegated function. It's definitely at the board. The buck stops at the board on supervision, not at San Francisco Reserve Bank, although they're involved. So we need to learn the lessons and we need to implement changes. It's not just supervision though. We need to fix liquidity regulation because of the speed of the it's just a different world, and the regulation for liquidity, the LCR and the NSFR, they're just not adequate to a world where people are moving money around on their phones like that. So we're doing all of that. I think we're doing it very transparently and rapidly. The piece of it that you won't be satisfied with is we in public service, people, if they engage in malfeasance, if they conduct criminal behavior, if they break rules and things like that, they get fired. Nothing like that happened here. The San Francisco Fed they had identified the issues. They had notified the management team that they needed, but it just wasn't forceful enough. And that's a problem with our system, I think, and the way bank regulation is a very kind of procedural-oriented thing where you're raising things like that. And we need to be able to be nimble and more forceful where appropriate. Not every day on every decision, but on where it's appropriate. So that's what I think we're working on now.
Well, thank you. And again, thank you. You've been very accessible. I'm going to try and request a meeting after the recess sometime this summer. I would like to get back with you, and we'll be submitting questions for the record. Thank you, Mr. Chair.
Thanks, Senator Tillis. I would add that I don't think that that Congress in 2155 and Barr's predecessor, Mr. Quarles, weakening the rules even more, and frankly, all of you at the Fed in those earlier days, and the Congress and the administration those earlier days, are off the hook either. Silicon Valley Bank. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, Chairman Powell. I just want to make sure I have a couple observations straight in looking at the most recent report, beginning with wage growth, because throughout the last couple years, we've seen rising wages. We've also seen, of course, rising prices. But it's been my observation that for lower wage workers, the people who are working paycheck to paycheck, real wages are up. In other words, the increase in their wages outpaced the increase in prices they were facing. And your latest report seems to indicate that that trend is actually even more broad-based right now. Could you speak to that?
That is right. Exactly right. At the beginning of the pandemic, the wages went up a great deal for people in those public-facing service jobs that are relatively low paid because that's where the shortages were, and they got positive real wages. But that has now spread, I think, overall, on a 12-month basis, you now have wage growth by most measures that's higher than inflation. So real wages going up.
Well, that's obviously a good news story for the economy. Let me ask you about labor force participation, because we've also seen more people reentering the labor force. Obviously, that helps with, inflation, wage inflation. And I understand that immigration actually has been an important part of that. Could you speak to the role of immigration in that sense?
Sure. So participation has moved up, I think, more than we had expected. It did move up last year. We were very disappointed, and then now it has moved up, and that's more people in the labor force. The other thing that's happened, though, is immigration basically went to almost zero during the pandemic, and there's been quite a strong rebound in immigration, and that's creating more people in the workforce. So we think one of the reasons why businesses are reporting that labor supply and demand are getting into better balance is because of both participation and immigration.
Thank you. I'm still hearing, and I know you are, and it's still a real phenomenon, that there are huge workforce shortages, especially in healthcare, nursing, all sorts of areas, and look forward to identifying ways to deal with those issues. So just a broad question on how you approach the decisions regarding interest rates, and I very much support the decision you and your colleagues made to pause the increase in interest rates. I understand you're going to continue to monitor the situation. I understand the signaling you've already given regarding the future, but you obviously have a dual mandate. You have mandate to maximize employment. You also have a price stability mandate. But then you also have this other responsibility regarding being a prudential regulator, overseeing the banks, including Silicon Valley Bank. So my question is this: to what extent did the crash at Silicon Valley Bank, and to what extent does continuing concerns about stability in the banking area impact the decisions that you make going forward with respect to interest rates? How is that factoring in?
So there's pretty substantial research showing that when you have a shock to banking, like the one we had in March, to a sector of the banking industry, that if you come back in 6 months, you will see lower lending. And it doesn't appear immediately, but it's strong in the data. So we have been saying, we've been waiting to see that does play a part, at least in my thinking, that there may be a bit more tightening in the pipeline than there otherwise would have been. Now, we don't really see evidence of it yet, but then again, we wouldn't expect to see. But it all points to me in the same direction. We moved very, very quickly when we had to move quickly. We've been slowing down since last December, from 75 to 50 to 25 at every meeting. And now we're getting very close. We're at least close to where we think our destination is, where we think it is. And it only makes common sense to move at a careful pace. We don't want to do more than we have to, but we do think, overwhelmingly people on the committee do think that there's more rate hikes coming, but we want to make them at a pace that allows us to see incoming information so we make good decisions.
Thank you. Thank you.
Thanks, Chairman Holland. Senator Vance is recognized from Ohio.
Thank you, Mr. Chair, and Chairman Powell, thanks for being here. Good to see you. I want to sort of pick up on some of the questions that Senator Tillis was asking about Basel III, and in particular, some of the capital requirements and how they affect the regional banking ecosystem in particular. And maybe we can just sort of start with some background on the Silicon Valley Bank situation, just to make sure we're on the same page. I suspect we agree on this, but I want to sort of make sure, and if not, have a discussion about it. So Silicon Valley Bank, I think sort of broadly agree that the reason the bank ultimately collapsed is they were way too exposed to long-term interest rate risk, because the interest rates went up, their balance sheet deteriorated. That, of course, led to a liquidity crisis, and then the bank was put into receivership. One thing that I've heard a lot of folks talk about, and this is in the context of Basel III, but also in other contexts as well, is the idea that we need to increase capital requirements, in particular on some of the small and medium-sized banks. Of course, if we adopted Basel III, that would happen. But as I understand it, if Silicon Valley Bank, let's say in the years leading up to the crisis, were exposed to higher capital requirements, isn't it plausible that they would have satisfied those higher capital requirements by buying more long-term treasuries?
Well, it doesn't matter what the assets were. You just have to have capital is the difference between your assets and your liabilities. If they'd had more assets of whatever character, including treasuries, then they would have had more capital.
Exactly. So I just want to be clear here. If they had bought long-term treasuries, not saying they would have done that, but if they had a higher capital requirement and they bought long-term treasuries, additional long-term treasuries, that would have in fact satisfied the higher capital requirement.
In other words, treasuries could have been used.
Treasuries are capital.
Right. Well, no, they're an asset.
Sorry, treasuries are an asset.
You would have had to fund that somehow.
But then the follow-up question is, given how poor of a job they did at hedging against the long-term interest rate risk, if they had bought more long-term treasuries, do we think their balance sheet would have been in a better or a worse shape?
Setting up another Head and Shoulders here.
A bigger loss, and more to the point, they would have still had overwhelmingly uninsured deposits.
Exactly.
That were very runnable.
Of course. So I want to sort of, the point that I'm making, which I'm sure you can kind of understand here, is that capital requirements are not necessarily a panacea to the type of banking run that we saw in the Silicon Valley Bank case. I think there's a very good argument that higher capital requirements on Silicon Valley Bank would have made the bank run worse, or even could have made it a more catastrophic or an even quicker failure. And at the very least, I don't think they would have helped. Do you agree with that?
I think there's a lot to unpack with Silicon Valley Bank.
Of course.
And the thing is, remember, it was a capital issue. They were trying to raise capital. That was what was going on, and the market was very focused on their portfolio losses, which were highlighted by the fact that they tried to raise capital. And so there was a capital issue there. Now, you're right, if you had filled the capital hole by, well, you have to retain earnings or raise or get some new equity. And if you just use that to buy treasuries, then yeah, it wouldn't have made things better.
Yeah, appreciate that. So one just final question I have just really is about the operation of the Fed here. And we've talked about this privately. I've talked about this a lot on this committee. I know the chairman shares this concern. We have a lot of mid-tier banks in the state of Ohio, and I think that mid-tier, that three-tier banking ecosystem is really, really important. Huntington Bank in Columbus, Ohio, I believe, is the single largest SBA lender. If you look at the commercial and small business lending, a lot of it's being done by the mid-tier banks, and I feel like they're facing a lot of pressure from regulators and just in their business model, because they have seen some flight of deposits away from them and towards the larger banks. So I really worry about the potential problems we're creating for these banks from both a regulatory and a business model perspective. But I wonder, Chair Powell, do you guys have,
breaking that
at
shoulder
the Federal Reserve, do you guys have a standardized approach where you try to understand the capital cost of each tier of our banking system? Is that something you don't concern yourself with, or is it?
No, we definitely concern ourselves with that.
Okay.
You know, all of us, and I'll just speak for myself, really believe that we're lucky to have such a diverse group of institutions, from the community banks through the smaller regionals, the big regionals. That's a great feature of America and of our economy, because they're just important in their own ways. So we try hard not to do a one-size-fits-all thing.
Of course. If I can, just one more final question here, Mr. Chairman. Do you have a good sense of what the capital cost is for the biggest banks, the sort of systemically important banks, versus the mid-tier banks? Like, what is the capital cost difference, broadly speaking? Maybe we'll follow up in a written question, but I'm very curious about how you guys think about that different capital cost, because it informs a lot of the policy we make. Thank you.
I'd be happy to have that conversation.
Appreciate it.
Thanks, Senator Vance. Senator Fetterman of Pennsylvania is recognized.
Thank you, Mr. Chairman. Chairman Powell, sincerely, thank you for being here today. And first and foremost, I believe that the Fed must make sure that we have an economy that truly works for working families. I suspect you would agree. And the reality is that the tool of cooling the economy with interest hikes can push people out of jobs. We want to drive down inflation, of course, that makes sense. But we don't want to hurt working people to suffer. You know, how do you kind of square that together? Because it's quite a paradox.
So it's working people who are the most hurt by inflation. It is a bit of a paradox. I would agree. If you're living on
quite the paradox. Exactly, you're absolutely right.
Yeah. No, so if you're living on a fixed income and you're spending every dollar on necessities of life, transportation, fuel, food, clothing, and inflation goes up, you're in trouble right away. You don't have a safety net. You're not a middle class or upper, wealthier person. So it is for those people that we need to get inflation under control. It is also the case, though, that the tool that we have, and we are the organization that's charged with price stability, is to cool off demand so that demand and supply get into better alignment over time. And we of course, would love to do that in the current situation with as little effect on the labor market as we can. And there's much cooling that can take off in the labor market that doesn't involve higher unemployment. However, I can't guarantee that restoring price stability wouldn't have some implications of a higher unemployment, but you have to think that restoring price stability will pay benefits to everybody, especially low and moderate income people, for decades.
Yeah. Thank you. No, and I agree. It's just such a paradox, because you have a dual mandate, and now we're going to kind of change the gears. It's clear that inflation over the last years have been many causes. It includes rampant corporate price gouging and monopolies. While Americans have gotten ripped off, executives and shareholders have raked in record profits. It's deeply immoral. I understand that it's not the policing price gouging and not in the Fed's direction, but you might look at smart ways to fight inflation. Is it fair to say that big business have been jacking up their prices and way more than their costs have increased? Is that accurate?
So I think what happened during the pandemic was supply was constricted. Cars is a great example. So the demand for cars went through the roof because people didn't want to take public transportation, and rates were very low. So demand was just very, very high, and we couldn't make cars. Literally, production of cars went down because there weren't enough semiconductors. I mean, I personally didn't realize that you needed a lot of semiconductors in a car, but now everybody knows that. So what happened was, how do you decide who gets the car? So the prices went up a lot. Car prices went up because when there's a lot of supply and restricted, a lot of demand and restricted supply, you get higher prices. As the economy returns to normal function and We have more semiconductors now. Supply chains are getting better. What's happening is corporate profit margins are coming back down, as you would expect. And so that's just the way the economy is working.
So is it fair to say that you don't believe that price gouging wasn't a factor?
So I think that the collision between very strong demand and limited supply was a big factor, particularly as it relates to goods inflation. It's not much of a factor as it relates to housing services inflation or services inflation, which account for about 3/4 of inflation.
Okay. All right, thank you.
Thank you.
Ceding the time back to the chairman.
Thank you, Senator Fetterman. Senator Daines of Montana is recognized.
Chairman, thank you. Mr. Powell, good to have you here this morning. In Montana, as well as the Mountain West, inflation remains above 5%. In fact, we're higher than any other region in the nation, whether it's gas stations, grocery stores, increasing prices, and its real-life impacts remain truly a top-of-mind and daily issue for Montanans. With inflation remaining stubbornly high, I can't help but reflect on the warning signs that were ignored by my colleagues across the aisle while they raced to push through trillions of dollars in partisan spending disguised as COVID relief. And now the American people are bearing the brunt of this reckless spending. In fact, for the average American, unless you've received a nearly 16% pay raise over the past 2 years, you've effectively received a pay cut.
Added to my
Chair
pits.
Powell, I urge you and the Fed to remain vigilant and steadfast in your effort to rein in inflation for the sake of all Americans. Unfortunately, record high inflation is not the only crisis the Fed is having to navigate. While bank regulators were more focused on climate change than actually regulating the banks under their supervision, several coastal banks collapsed and caused panic across the banking sector. Before the dust even settled, several of my colleagues across the aisle immediately began calling for increased regulations and greater capital requirements for banks, with little appreciation for the negative impacts these changes would have on small and mid-sized banks across the country. I've heard from community banks across Montana who are justifiably concerned that they will be wrongfully punished for the actions of a few poorly regulated and poorly managed banks. You mentioned several times in your testimony yesterday and again here today that the U.S. banks remain strong and well capitalized. Chair Powell, if banks are so well capitalized, why the urgency now to increase capital requirements that would really prevent another Silicon Valley Bank?
Well, let me say first that I think we don't have a final proposal to talk about yet. When we do, we'll be able to talk much more specifically about it. But for community banks and banks, any banks under $100 billion, I don't think they're going to be part of this proposal. So we're really talking about principally the very largest banks, the GSIBs, and to a lesser extent, the banks, the regionals, and then the banks between 100 and 250. And yes, the right question. The question is more capital the answer? And we'll be addressing that. We'll be making a proposal. We'll be soliciting public comment on that. I'm well aware that there's a trade-off here. More capital means more stable banks. It means stronger banks, but there's also a trade-off there. And with capital, you've got to make a judgment about where you draw that line.
Yeah, and to that point, increasing the capital requirements could in turn decrease lending. Will the impact this have on small businesses who may not be able to get a loan be taken into account before you finalize a proposal?
Yes. I mean, the thing is, stronger capital means banks will be able to continue to lend during difficult times too, right? So that's why we do it, is for those stressful times. But it is a judgment call, and there's a lot of science and arithmetic that goes into it. But ultimately, deciding how high to go is a challenging question. And we're going to be making a proposal, and I'll personally be listening carefully to the comments.
You alluded to focus more on the GSIBs and trying to spare the smaller banks, perhaps, from the impact. And I realize the proposal is still being developed, is not finally baked yet. But are you prepared to commit to sparing the smaller community banks from changes the Fed might propose on capital requirements?
So let me say, my understanding is that the proposal doesn't affect banks under $100 billion, and I would have serious questions as to why it would. And particularly, most community banks, for example, in your state, are much smaller than $100 billion, and I don't know why we would be looking at their capital. They're generally quite well capitalized.
Great, thank you. I'm going to turn on inflation, back to that earlier statement. I appreciate the wait-and-see approach the FMOC took at its most recent meeting. But as I noted in my remarks, inflation does remain stubbornly high, particularly in the Mountain West, and labor markets remain as tight as we've ever seen. It was noted, however, that the committee is poised to continue raising rates later this year. My final question, could you expand just a bit more on your outlook for the rest of the year and speak to your continued commitment to do whatever is necessary to bring inflation back to your 2% target?
Yes, so I think if you look at the committee's forecasts, and mine are very similar, we expect modest growth going forward, growth in the below the sort of longer run growth rate of the United States economy, which is around 2% or a little bit less, growth lower than that. And we expect the labor market to continue to gradually cool off. And with that, there's an expectation that inflation will continue to move down later this year. And if things happen that are sort of broadly in keeping with that, the strong majority of the committee believes that it will be appropriate to raise the federal funds rate again once or twice by the end of the year. A strong majority came down on twice between now and the end of the year. So I think the data will tell us what to do. I think the point of our meeting, the last meeting, was really to moderate the pace of our decision-making on this because, it was very important to move quickly last year, and we did. It's not so important now because we've come so far and we're relatively close, we think, to where we need to get. But we will, people should believe, and broadly speaking, the data show that they do believe, that we will do what it takes to get inflation down to 2% over time.
Thank you. Senator Hagerty from Tennessee is recognized.
Thank you, Mr. Chairman. And Chairman Powell, good to see you again. I'd like to start with something that has troubled me since our hearing yesterday regarding the Basel III Endgame proposal that's coming forward by Vice Chair Barr. The proposal is going to have far-reaching ramifications, I think. It's rumored to have over 1,000 pages in it. Yet when I asked Governor Cook about the proposal yesterday, she told me she hadn't seen it, has not reviewed it. And my understanding is that the agencies, including the Fed, are due to vote on this on the 18th of July. And given the fact, and I think Senator Warner described it aptly yesterday, the potential for a perfect storm here, if the rumors that we're hearing about capital requirement increases that may be proposed are true, this may come at a time, banks may be preparing for a capital increase at a time when we absolutely need banks to be lending, not constraining lending by raising capital requirements. So I think there are numerous analyses, the impacts on the small business community, on the banking system need to be taken into account. And I'm very concerned, particularly in light of Governor Cook's response that she had not reviewed it, hasn't seen it, and didn't seem to have any perspective on it at this point in time. It's a very short window to undertake a decision on something as complex as we may be talking about with over 1,000 pages in this report. So my question of you is, how will this process be managed at the Fed in terms of the decision-making and the analyses that need to take place? So I'll make sure that governors have enough time to carefully evaluate this. So the staff has been briefing governors, for the past few weeks about what. But the proposal is still evolving, though. You're still. I'm hearing even as recently as this morning, things are moving still. So it's not possible when you say we haven't seen it. We have not seen a final proposal. There isn't something to send to the committee, and I think. You can be briefed on the current state of where things are, and I have been in detail. But ultimately, when you sit down to read this large document, I'm going to wait for the final version to really do that. But you're right to point to the need for time to evaluate it. Yeah, Governor Cook's response to me as she deflected yesterday just left me with a great concern. So I appreciate it. I just see no need to rush here given the significance of what's happening. And frankly, the other concerns you and I have discussed in terms of where we are today, I think it warrants very deep consideration. I'd like to turn to another item that you and I have also discussed in the past, Mr. Chairman, and that has to do with bank mergers. And if you think about a potential bank that's in distress, all things being equal, would we be better off for that bank, that distressed bank, to undertake a merger or acquisition, or would we be better off to let it enter into receivership?
The former.
Certainly, I agree with you. Yet we also, in the case of First Republic Bank, it was like a slow-moving train. Stock price had collapsed. There were actually, in my understanding, 11 different financial institutions that put forward proposals that would have, been a rescue package for the bank. Yet none went far enough to achieve an actual merger or an acquisition in that place. In fact, they let it go into receivership. And, my concern is that this administration has created such a negative environment for consolidations that it's a real issue. My question of you is, do you think the current state we are, should we allow more banks to merge, especially given the stress that we're seeing in the system?
So I think there was every chance given for and much hope bestowed on the idea of having that bank sold before it went into receivership. It just they couldn't make it happen, and that's unfortunate. Everyone would have loved to see that outcome rather than a receivership. No one wanted that to be the case.
I'm certainly in that camp as well. My view is that there's an environment right now of uncertainty as the banking community looks at mergers and acquisitions. In the guidance that the White House has given about very negative in terms of mergers and acquisitions against consolidations. I think that institutions are very reticent to move forward, and that's why I've introduced the Depositor Protection Act, which, among its many provisions, is going to provide a green light to well-capitalized, well-rated banks to merge with institutions that are under distress without having regulatory interference. And so as the committee moves forward, I hope that we're going to have opportunity to work on this legislation. I hope we can remove needless regulatory hurdles, and I hope we can actually encourage mergers and acquisitions that will protect taxpayers. One final point I'd like to raise with you, Mr. Chair. It's something that you identified nearly a decade ago. At that point in time, the Fed created a reverse repurchase facility that was intended to be a tool that would put a floor on interest rates. The facility was targeted at investment vehicles like money market funds, which actually play a significant role in the short-term funding markets. At that time, you joined others on the board in expressing concern about the possible unintended consequences of this facility, particularly in times of market stress. That's where this facility could actually exacerbate the so-called flight to safety. Since that time, this facility has grown to over $2 trillion worth of overnight deposits at the Fed. So I'd love for you to walk us through, if you might, the potential risks that this facility might pose, and take us through how it relates to basically pulling deposits out of the banking system at a time when we'd like to retain those deposits.
So the reverse repo facility really hasn't increased. In fact, it's shrunk in size since the events of March. So it's really not on net accounting for the decline in deposits. Really what's happening there is that market rates are higher than deposit rates, and depositors are moving their money. This happens in every cycle. I think I raised.
May I interrupt for just a moment,
please,
Mr. Chairman? So, are my numbers incorrect that we now have $2 trillion that are parked in this facility by money market?
We had $2.5 trillion before March, so it's come down in size. In fact, now that Treasury is refilling now that the debt ceiling is solved and they're refilling the Treasury General account, the reverse repo facility has been declining, and that's what we would have hoped to see, rather than taking reserves out of the system.
Thank you, Senator Hagerty. Senator Warner's recognized.
Well, thank you, Mr. Chairman. The challenge of coming a bit late, you kind of asked my question, but Mr. Chairman, great to see you again. I'm going to at least ask a variation on the same question I think a number of members have asked, and I know a lot of us are sometimes get the advantage of being Monday morning quarterbacks on how you navigate through monetary policy. I think you've generally done a pretty good job. I'm very grateful that you're on a pause. I hope that pause, as the data comes through, continues. But we definitely have some stresses with that monetary policy. Secondly, you are doing what, again, I think people on both sides of the aisle have called for in terms of quantitative tightening. And again, that doesn't have the immediate effect that the monetary policy has. But as we've discussed, and I think Senator Haggerty raised, we also have, the appropriate review that Vice Chair or Barr for Supervision is doing on capital standards. And I think Senator Haggard and my staff told me even used the term I was going to use, perfect storm of these three all coming together.
I borrowed your term from yesterday and properly acknowledged that, Senator Warner.
I'll call it very stressful situation. And I understand, I think you pointed out that my friend from Tennessee, the capital requirements will phase in, but, you could have all three of these events come together. I think you've addressed this already, but I just want to add my voice to that concern. Safety and soundness, you got a lot of jobs, safety and soundness, inflation control, and full employment. That full employment piece could be affected by this potential perfect storm. And again, I hope all of your colleagues, I raised this with the other members, the nominees for the Fed yesterday, and I hope you will, and again, I think you've been asked in the House, you've been asked here. I don't know if you've got anything else you want to add to what you've already responded on that. But
I'll just say you're right. We're thinking very much about that. Fortunately, it's been orderly. The shrinkage of the balance sheet has been quite orderly. There's still a very, very high level of cash reserves in the system, and we don't think they'll be scarce anytime soon. We think the refilling of the Treasury General account, people have been focused on that for a couple of months. So far, early days, that seems to be going well. We're watching it very carefully.
But again, and it's easy to sometimes sit up here and attack rather than manage all three of these, but there could be this moment in time where these factors all come together that could have a really negative effect on the economy. Let me move to I think something I think that's not been raised. I have huge concerns. We've all litigated back and forth causation on SVB, but one of the things that happened when you get $40+ billion coming out of an institution in 6 hours, driven by an internet-based run, that is, I don't know what regulatory framework prevents that. And while I was glad that the SEC Chair Gensler put out a commentary that's saying, we do need to take a look on more transparency on short selling. We're not, we've found in the past short selling bars themselves don't prevent some of this. One of the things that a New York Fed official mentioned is how do we get rid of the stigma of a bank going, to the window. I mean, the thing is, rather than Fed being lender always of last resort, if we have that liquidity window, it's available. Banks are reluctant to use it, but in an era where people can move capital so quickly, having that liquidity tool available and not taking a huge amount of hits for using it would seem to me to be something that could at least take on this question of these internet-driven runs, which so far I've not heard from anybody on either sides of the aisle a really good suggestion, including I've thrown out a lot of suggestions that, frankly, upon reflection, I'm not sure make that much sense. But this liquidity tool of using the window, the Fed discount window, is there a way to think about getting rid of the stigma? And maybe we as policymakers ought to make that point as well. But could you address that?
Well, it's critically important that people be able to use and willing to use the discount window and also the bank term funding facility, other facilities that we set up, and that they aren't marked down by the markets for doing that. And so
or marked down by the regulators or the examiners.
Yeah. But the concern is that markets will see this, and so I would say the first thing is do no harm, and that is the Dodd-Frank provided disclosure of names and things like that at a quicker pace. That's one of the reasons banks don't want to do this, is they know their names coming. I wouldn't bring that. I think whenever you look at changing that disclosure around use of these facilities or that, you should really consider that you're going to make the stigma worse. I actually think it's good that banks have been willing to use the discount window and the new facility during this crisis, And it's almost like the stigma is a little bit less than it was. I want to think that anyway.
Thank you, Senator. Senator Cortez Masto of Nevada's next. 2 Republicans in a row I called on. So, Senator Britt, you will be after Senator Cortez Masto of Nevada.
Thank you, Mr. Chairman. Chairman Powell, it's great to see you again. Thank you. I'm very glad that yesterday, I think Senator Warner mentioned this, we had hearings for nominees to the Federal Reserve, and one of the nominees is the first Hispanic to sit on the Federal Reserve, Dr. Adriana Kugler, who has extensive experience economically as well as including congressionally confirmed positions. I'm looking forward to supporting her confirmation as well. Let me talk to you a little bit about tougher lending standards that might be affecting inflation as interest rates increase. Yesterday, Raphael Bostic, president of the Federal Reserve Bank of Atlanta, published a blog post noting that the tightening bank lending standards we see are directly due to the Federal Reserve's higher interest rates. Do you think that the credit tightening we see from regional banks is acting as an effective substitute to an additional interest rate hike?
It may be. We've been looking for that. We actually don't see a lot of evidence of additional tightening on top of what we had already been seeing yet, but we're keeping our eyes out for that.
And so then what are some risks if the FOMC continues to raise interest rates despite seeing the impact of these rate increases already resulting in more credit tightening and higher housing costs? And we talked a little bit about this.
So the risk is that the reason we've slowed down, really since last December, we slowed from 75 to 50 basis points per meeting to 25 at every meeting. And now as we get closer and closer
Beyond
to
is
what
ripping.
we believe will be our it's uncertain, but we think our destination is we've slowed down a little further. So we're trying to avoid the mistake of going too far. And that's all it is. And as you can see, overwhelmingly, people on the committee do believe that it will be appropriate to raise hikes 1 or 2 additional times. A strong majority believes 2 times this year if the economy performs as expected.
Thank you. And so I'm going to jump to employment, and this is something I talked about yesterday as well, because Nevada has this sort of workforce paradox. The most recent data shows that in Nevada, with both the biggest increase in job growth and the highest unemployment rate, I want to get your thoughts on moving forward as we address this concern, this paradox. Let me give you an example. Nevada has the largest percent increase in employment, which was 4.2%. We also had the highest unemployment rate in the nation in April at 5.4%. That's 2 points above the national rate. As you consider the Federal Reserve's mandate to keep unemployment levels low, how do you consider states like Nevada where there is that paradox?
So we only have the one federal funds rate. We really can't. We have to look at the national level, although we're well aware of different labor markets and also other interesting characteristics in Nevada.
Well, and we've talked about this because the labor market, particularly in the service industry, has been a drag, and we've seen that in Nevada. And you and I have talked about this as well. Is that something you consider as you look at the numbers, particularly in the service industry, and what are you seeing?
So we're seeing in service industry is really where we still see labor shortages. You still have a very high number of job openings compared to the number of unemployed people. And I think even in Nevada, you've got a job openings ratio to unemployed of 1.4 or something like that. That was unheard of before this period of time. And that just means there's still tremendous demand. And of course, in Nevada, it would largely be in, travel and entertainment sector. I would into it.
And then talk about the housing data, if you would. It's another conversation we had, and how much of a drag that is on the economy as well, and what you're seeing.
So housing is very interest-sensitive spending. Mortgage rates are very sensitive to our policies, and housing construction and housing sales and things like that are very sensitive to mortgage rates. So you saw housing activity moved down pretty significantly when we started raising rates. You've actually seen it kind of hit a bottom now. We met with with a housing group, manufacturers, housing builders yesterday, and they say business is pretty good. It's largely new entrants, though. Many people have low rate mortgages that they're not eager to get out of, And so the sort of strength you see now is new buyers coming into the market. So the market seems to be improving. But again, it's the most interest-sensitive spending, or among the most interest-sensitive. So it's going to be affected when we tighten policy.
Okay. Thank you. Appreciate you being here.
Senator Britt of Alabama is recognized.
Thank you, Mr. Chairman. I want to start by acknowledging the strength of the U.S. banking sector. In recent events that unfolded related to SVB, Signature, and First Republic, it highlighted the significant consequences that could occur when bank execs prioritize profits over risk management, and also when banking regulators fail to do their job. Regulators left numerous red flags unaddressed, which allowed the inexcusable risk management practices at these banks to continue for as long as they did. Let's be clear, this inaction played a significant role in these banks' ultimate demise. However, the mismanagement and excessive risk-taking that occurred within these institutions are not representative of the broader banking sector.
Bed Bath going to overstock.
In fact, I think it's quite contrary. Banks across the board have proven to be resilient, well-capitalized, and a source of strength in the global economy. In fact, I think
this is beyond meat over here. I don't know why it's ripping.
You see that the U.S., comprised of banks of all sizes, is the world's most dynamic banking system. I'm concerned, though, with impending actions of the Federal Reserve that in itself will be jeopardized. If you look, community banks, for instance, have served our individuals in our small and rural communities across not only my great state of Alabama, but across our entire country in ways that have allowed individuals and small businesses to actually be able to achieve the American dream and to thrive. However, over the past decade, we've seen a significant decline in the number of community banks serving Americans. The U.S. has lost 71% of total banks in the last 4 decades, and unfortunately, smaller banks have made up a large portion of this. And just in the last decade, the number of community banks dropped by nearly 40%. That is completely and totally unacceptable. When we look at the vital role that they play in each and every one of our communities, we have to make sure that that strength is maintained and not undercut. In the face of these declining numbers, the Federal Reserve is considering proposals that could further contribute to the decrease in small and mid-sized banks. Chair Powell, as the Fed is considering changes to the current banking regulatory framework, including stricter capital requirements that Vice Chair Barr has advocated for, how is the Federal Reserve evaluating the downstream impact of these on our smaller community banks?
So I think community banks, when we think of community banks, we think 10 billion and under mainly, but in assets. But I don't think under 100 billion. I don't think the proposals that are under consideration are really applying to those banks. So I think that it shouldn't be a factor for smaller institutions, which, as you point out, have been declining in number for 30 years.
So what do we do to support them? From your perspective, what is the Fed doing to support community banks and rural banks, or creating conditions where they can thrive?
So there are these secular forces that are driving interstate banking, and also just population moving out of, you see rural areas that have lost half their population, things like that. So we can't do much about that. The piece of it that we understand that declining numbers of community banks is not a good thing for the country. The country isn't better off for that happening. And so we don't want to be part of the problem. And part of that can just be once fit size regulation, high fixed costs, it will make even small bank, especially small bank models, unprofitable. So we very much try hard to not be part of the problem, and we do, as an institution, very much understand how important community banks are for the economy.
Can you speak to that? Can you tell me what role you believe community banks play that maybe other institutions cannot?
So community banks are in their communities, so they know the community well, and they know the people in the community and the businesses in the community, and
relationship lenders.
It's relationship lending, yeah. It's not. I told a story yesterday, which happened to me. We were moving to Washington, and we had this big bank wanted to make the loan, and they decided not to make the loan at the last minute. I called the local community bank. The loan officer was somebody, they knew my family, they knew the house. He went to my high school. He was much younger, of course. And they made the loan very quickly and they just understood it. It was going to be a great loan. We paid it off long ago. So I understand personally that they're better at doing certain things. The big banks do certain things very well, but they don't do that very well. And for smaller businesses.
Absolutely. And just want your commitment that you'll continue to take a look, whatever type of additional regulating or regulation tools that are kind of perceived to be helpful to maybe some of the bigger issues, that we take a look at how they affect downstream, how they affect small banks, mid-sized banks, and that we make sure that we create conditions where they can flourish.
Yes, you very much have my commitment on that.
Thank you so much.
Thanks, Senator Britton. Rest assured, one of the, best after yesterday, maybe not, but one of the few things that both sides feel strongly and agree on here is that community banks play a major role in our financial system, and all of us support the community banks in our communities and know how important they are. So thank you for your comments. Senator Tester is recognized from his office.
Yeah, thank you, Chairman Brown, and thank you, Chair Powell, for being in front of the committee. I appreciate you. Look, when I talk to Montanans, I hear about what I think everybody in the committee hears about. They hear about inflation, hear about the high cost of housing, you hear about unaffordable child care, and all these are economic conditions that impact hardworking families.
I get into the high today.
And communities across my great state. And the examples are clear. Hospitals can't hire nurses. Schools can't hire teachers. And if they can hire them, there's no place to live. And even if they can find a place to live, then finding child care is a problem, and then paying for that child care is a problem too. Unfortunately, we haven't done much about any of those
They can make a cup and handle.
From a congressional standpoint, but I think all these challenges need to be addressed. But I'm talking to the chairman of the Fed. And so when I ask the chairman of the Fed, when we talk about these issues of inflation and housing and child care, I know you guys think about inflation, but do you think about the other things, and do you have tools to address things like housing and child care, or is that simply out of your purview?
We enforce some of the consumer protection laws, and so we can have an effect as it relates to fair lending and things like that. But ultimately, the bigger question is just the availability of housing and its availability near where the jobs are. There's not much there's not really nothing that our tools can do. The best thing we can do for those issues is to provide an economy where we have stable prices and maximum employment.
So there's been a lot of talk, and I'm sure there's been a lot of questions asked on this committee about interest rates. And I ask this not to influence you, because I do not believe you should be influenced by political forces. The last thing we would need would be the worst thing that could happen is if the United States Senate is dictating monetary policy. We'll leave that up to the pros like you. But interest rates continued to be an issue. You are fully aware that the debt deal that was struck clawed back unspent COVID dollars. You are familiar that there are some supply chain issues in this country that have impacts on inflation, as I think the COVID money will have some impacts. And there's some other things out there that I know you're looking at. So I'm going to ask you a question that I'm sure you've been asked already, but what's going to be the key determinant as to whether you raise rates or leave them where they're at? Or I don't think dropping them would be appropriate, but what are the things you're looking at to make those kind of decisions?
Well, I would say that if we see the economy performing about as we expect, then 2/3 of the committee really thought it would be appropriate to raise rates a couple of times between now and the end of the year. So what do we expect? We expect continued modest growth. We expect continued gradual cooling off of the labor market, gradual better alignment of supply and demand, and we expect inflation to be improving. And so if all those things happen, we think we're within a couple of rate hikes of the level we need to get to. We want to get to a level where we're confident that inflation is and will continue to move, is moving and will continue to move down to 2% over time. That's and not a higher level, that level. And so that's why we've slowed down here, as we think we are getting close to that level.
Okay, so let's think out past that. What factors are you going to look at that would determine a lowering in interest rates then?
So we don't see that happening anytime soon, and the test for that is that we're confident that inflation is moving back down to our 2% goal. We want to have some confidence. So, and I will say in the summary of economic projections that my participants and I filed last week, I think by the end of next year, by the end of 2024, the median participant did have some rate cuts. But that's going to depend on how the economy performs, and inflation has just consistently proven more persistent than we've expected and that other forecasters have expected. So it's going to have to await a time when we're confident that inflation is moving down to 2%.
So I want to talk about regulation. I know it's been touched on. Katie Britt touched on it a little bit. And I know Michael Barr oversees the Fed's regulation actions. But when we passed 2155, the bill to give reg relief to small banks in particular, there was a sentence in there about tailoring, so that even if you had a community bank, a small community bank, if they had a risky portfolio, you could regulate them to match that risk. And bigger banks, the same thing. Can you tell me what Barr is thinking or what you're advising him when it comes to, because I think we've all agreed, the chairman just said, we want to protect community banks. They're not the problem out there. In fact, they're the ones that provide access to capital for these communities so they can grow and an economy can happen. Can you tell me what your interaction is with Barr when it comes to regulation and where you think he's going?
So broadly speaking, when regulations need to be voted on at the Board of Governors, and I'm one of the people who votes. I'm also chair of the committee. So that's the nature of the interaction. Okay. In terms of what you're really talking about, regulation for smaller institutions, I would say I think it's important that regulation be appropriate for an institution's size and risks. So it's not a one-size-fits-all approach to regulation, and the largest institutions need the highest capital standards and the most regulation. And as you get down to community banks, the regulation and supervision should reflect their size and risk.
I apologize, Mr. Chairman, for running over. Thank you, Chairman Powell.
Thanks, Senator Tester. Senator Kramer of North Dakota is recognized.
Thank you, Mr. Chairman, and thank you, Chairman, for being here today. I know several of my Republican colleagues have been asking you about Basel III and the potential for some changes, obviously, in capital requirements. I'm afraid part of what they're trying to do is fix a liquidity crisis at regional banks with a capital fix, which I don't think the two necessarily go hand in hand. In fact, it seems to me, while you've been trying to engineer a soft landing and now have taken a pause, and I'm certainly not critical of that, I can't fathom why the Fed would want to raise capital requirements when we could be facing what's a credit crunch. And I mean, does that make sense to you that in a potential credit crunch with caused somewhat by higher rates, obviously somewhat by design, that it doesn't make sense to increase capital requirements for banks and individuals?
So I think that's always the trade-off, is higher capital means more stable, stronger banks that can last through bigger crises and things like that, but it's a continuum, because that also means slightly less capital being available and higher price of capital. So, and the thing with capital requirements is the answer isn't 0 and it's not 100. You've got to find the right place. I would also say that the capital in the form of the what I've been briefed on is a proposal where the big capital increases are really for the largest institutions, and much less so for institutions that are not among particularly the 8 G-SIBs.
But what's the motivation for that? I mean, you've just articulated the challenge, obviously, better than I did. But why the big, for example, the big institutions? What's the situation that would require
So
higher
we,
capital requirements.
to your point, we spent many years raising capital and liquidity standards for the largest institutions, and appropriately so. I supported all of that, and I'm glad that I did. I think it's been warranted, and I think that the large banks have competed very successfully with this high capital. And I think, further increases are going to be on the table. We always thought there would be some further increase at the end of Basel III globally, but I think, it's going to be on the increases are going to need to be justified.
I'm going to get to another question, but you said something a little earlier that I wanted to get to. In response to Senator Tester, is your interaction with each other confined only to public meetings? Is that?
Not at all.
Okay.
Not at all, no, not at all.
So you try to persuade each other at the water cooler?
I talk to all my colleagues a lot. I'm not one of those people who can just sit in your office all day. I'm popping up and running around. I'm one of those people. So.
I see, okay. Well, just because in your interaction it sort of sounded like that, and I used to be in a 3-member commission, not that regulated.
We have very regular meetings and conversations, right through the weekend. We talk frequently.
Okay. In an earlier exchange with, I think it was Senator Tillis, you talked a little bit about, I think it was Senator digital economy challenges, and you considered some changes to reflect, how quickly individuals can move money, changes to reflect. How quickly individuals can move money, changes to reflect. How quickly individuals can move money, changes. You might not even have a storm, but for the fast ability for somebody to spark a run, for example, or to move money quickly. But you didn't elaborate on what kind of changes you might be considering. Do you have some personal thoughts on it, or things that you've been talking about as you're running around talking to each other?
Yes. I'm not the biggest expert on this, but so
that's two of us.
The thing that's clear is that our existing liquidity requirements, they didn't take into contemplation at all the idea that you could have a run this fast. And so things are embedded in the net stable funding ratio and the liquidity coverage ratio that reflect an understanding of how fast a run happens. Mm-hmm. And, we now learned that, so that's why I think there is regulatory response is going to be appropriate here, not just supervisory. In addition, you would have thought, and we thought, and by the way, the board is every bit as accountable as the San Francisco Fed on this, that supervision could have been much more forward-leaning on the liquidity issue than it was. And so we're going to address that too. Yeah, no, great point, because these guys have heard me use my my soccer referee illustration. If you warn the offender over and over and over but never throw up a card, they just offend worse the next time. So I think that's an obvious finding, and I would concur with you. But the whole issue of the run itself is also problematic. While not maybe directly jurisdictional to any one regulator, as policymakers and regulators together, we should find a better solution. But I thank you again for your service and for being here. Thank you, Mr. Chairman.
Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So in 2010, Congress passed Dodd-Frank to make banking regulations tougher and to avoid future bank collapses. And very soon after that, bank CEOs started lobbying for weaker rules. Now, Chair Powell, you also lobbied for weaker rules. When President Trump first nominated you as Fed chair in 2017, you testified, actually in this very room, I think, that you intended to, quote, consider appropriate ways to ease regulatory burdens for the banks. And when I asked you if there were any rules at all, that you thought ought to be made stronger, do you remember what you said?
I think I pointed to the net stable funding ratio.
No, actually, that's not what you said. You said, honestly, Senator, I think they're tough enough. You couldn't point to anything you thought should be tougher. In 2018...
In the event we strengthened the net stable funding
ratio.
Well,
in 2018, you supported Congress's weakening of those rules. You led the Fed in hacking away at one rule after another. According to the Fed's own analysis of the Silicon Valley Bank failure, you weakened the rules in multiple ways. You reduced capital requirements. You weakened liquidity risk management. You skipped out on using enhanced stress testing for banks with tens of billions of dollars in assets and more. And the result was that the second, third, and fourth largest bank failures in U.S. history, which together required $23 billion in bailout money. In fact, you now hold the record. In a single year, the FDIC has been forced to rescue more giant failed banks on your watch than any Fed chair in American history. Chair Powell, do you agree with Vice Chair Barr's conclusion that the Fed bears a big share of the responsibility for the failure of SVB?
I certainly think that our supervision has been shown to have been lax in not being assertive enough. I think that the supervisors saw the right issues but weren't forceful enough in hindsight. And I think that's certainly a fair conclusion.
Okay. So those regulations were weakened. Those supervisors were clearly asleep at the switch for more than 5 years under your watch. And I'll just say it again. This is exactly why I opposed your nomination in 2017. The decisions that you made, the votes that you took, and the things that you said caused this mess. And when you were up for reappointment in 2021, I opposed your confirmation because I believed that your continued leadership would be dangerous to our financial system. And the Fed's own report confirms that. So yesterday, Chair Powell, this committee voted on a bill to help hold CEOs accountable when their actions blow up banks. At the Fed, you are the one who lobbied, who drafted, and who voted for weaker rules, and you were ultimately responsible for the team of Fed supervisors who fell down on the job. Do you take responsibility for your role in these bank failures?
So I think we learned some lessons from the bank failures, and the main responsibility I take is to learn the right lessons from this and to undertake to address them so we don't have a situation like this where we had unexpectedly a large bank fail and spread contagion into the banking system. That's not supposed to happen, and we need to take appropriate steps to make sure it doesn't happen again.
So I just want to make sure I understand what you mean when you say you take responsibility. Do you take responsibility for your actions that led to the failures of these banks?
Yeah, I think the question of what happened, supervision was at fault. That's both at the board and at the reserve banks.
And are you ultimately responsible for those supervisors? Are you
Actually,
in charge here?
under the law, the vice chair for supervision has
Okay, so you take no responsibility on that.
I didn't say that.
Well, that's what I'm trying to ask. I'm trying to understand what you take responsibility for.
I take responsibility for addressing this situation appropriately.
That's talking about going forward.
That's my focus. It's going forward.
Yeah, well, that kind of sounds like not taking responsibility for what you've done in the past. You know, a month ago, we had the CEOs of the banks that exploded in here. And each of them had scooped up huge bonuses, and each of them said they plan to keep every penny of that money. And now we have the chair of the Federal Reserve who led the charge to weaken bank regulations, who oversaw the bank supervisors who failed miserably to hold these banks in line. And again, the accountability is zero. Our banking system is broken. $23 billion in bailout money, and there is no accountability for those at the top. And once again, the people who didn't cause the mess are forced to clean it up. We need significant changes here. Mr. Chairman, I yield.
There are two senators that might be online. Senator Sinema is recognized from Arizona if she's online. If not, Senator Warnock from Georgia, if he's online. Okay, we'll close the hearing today. We have come together to discuss how the economy ought to be. I don't believe that to have a strong economy we must trade American jobs for corporate profits, nor do I believe we must sacrifice a safe and resilient banking system for easy money for the biggest banks. We can fight inflation and protect worker gains by investing in growth right here at home and building a more inclusive economy. Thank you for joining us, Chair Powell, today. I look forward to working with you to strengthen our economy. For senators who wish to submit questions, they're due 1 week from today, Thursday, June 29th. For Chair Powell, please submit responses to questions. For the record, 45 days from the day you receive them. Senator Scott has some comments he'd like to make.
Thank you, Mr. Chairman. Just to be quick, one of the comments that I heard during the hearing was that somehow tax cuts led to the challenges that we're facing with our debt. Just wanted to clarify the record that revenue in 2022 was $4.9 trillion, more than 30% higher than 2017 revenue of $3.32 trillion. One of the things we should just recognize as a clear fact is that if your revenue goes up, and that's what happened after the TCJA in 2018 and 2019, we had an increase in revenue, not a decrease in revenue. Unfortunately, we had an increase in spending that exceeded the increase in revenue. So if you spend more money than you take in, you still end up with a deficit.
Thank you. And of course, Senator Scott recognizes that we had a pandemic. The committee is adjourned.
Ended off there with some drama. Dude, Edge is sick. I get picture in picture. This is crazy. You can just pull videos out of your window. This is just the video from YouTube. It's so cool. Look, here's the whole YouTube tab. I do picture in picture, and I just have the video. That is neat. Pretty mellow there for Powell, other than Warren. She's usually pretty good at dumping the market and pissing Powell off. She didn't fail. Beyond Meat was ripping there. Not sure why. Not sure what's going on with that. Barbecue kind of flat a bit. I like Beyond Meat. I think the chart looks nice. ENRC down 4%. FLT down 2. We're down 2. Oh, my first solar puts are filling. Build. Down there a bit. Hey. Alright, I got the first solar puts. Sketchy trade with roll Otis, but FSLR put for December 70 strike. Why did I so far out of the month? I've had those queued up for a long time. So far, the money, not really that much time. I don't think those would. We'll see. And then I did get some barbecue shares. And I puts on SPY. I stopped out of them. Assess. Wait for this to kind of turn to another Head and Shoulders here. Thought about reopening them on the double top. However, this could still be a kind of a cup and handle, I think. Cup handle. And I didn't just want the move from this double top to like here. A bigger move. Do another day trade on it. Still have the futures. The short side. 1890. Arba coding at the 7% range. Market's just chopping around today. Yeah, gas ended up coming down, but I'd already closed out of my short to make margin for my OES. Group bonds up 9%. Weird. Overstock looking good on that breakout of that downtrend line there. Up 15%. Catalyst was probably the winning bid for $21.5 million for Barbecue's assets. Probably a very good price for it. Root has stayed flat. GME's climbed up a little bit, still a gap to fill there. Crews searching for missing submersible find debris field in North Atlantic. Sorry. You guys said they just ran out of oxygen? Or if they got them. The housing market is so tight that home prices are 44% higher than before the pandemic. Barbecue, little green candle there with some volume popping up out of the barcode. US 30-year fixed rate mortgages 6.67% versus 6.69% week prior. Math and reading scores among America's 13-year-olds fell to their lowest levels in decades. You mean they don't teach math and reading on TikTok? UK government debt is above 100% of GDP for the first time since 1961. Oh, this is the news you're hearing from stock market. JP Morgan mistakenly deleted 47 million records, the SEC has alleged. $47 million records. All in on puts. Yeah, hype starting to wear off. Yeah. Just AI puts or? Yeah. Invest for the 4-cent dividend. Me still the gap fill. Barbecue 1919.3. Curious if SPY fills this gap today. Test this other shoulder.
Away from his commentary so far.
Reiterated basically his hawkish stance. He said there's a long way to go in terms of hitting those the inflation goals that they have. He said that he believes the regional banks are well capitalized. Of course, he's kind of suggested that before, and that he doesn't think there's going to be additional regulation to come in place. He doesn't want to keep them kind of constrained from a competitive standpoint. But I think that, you know, we get PCE next Friday. And if you look at all of the inflation metrics, you could say, unfortunately, the preferred, the core PCE services ex housing is the gauge that, you know, just look at the last couple of months. It's hovering around, you know, 4.6, 4.7. It hasn't really budged. And so let's see what happens next week and see if there's any improvement there. But we know on the services side that, you know, demand's still pretty healthy there. So that's really the crux to me. It's that if that remains pretty sticky and Chairman Powell is really going after that 2%, and that's what he's focusing on, you know, what if he does drop, you know, 4 more or so, and let's say he staggers it over a couple, you know, 6 months, 8 months, whatever the case, let's say 100 basis points, even getting the extra 100 would probably be a pretty significant reset to the market expectation. And then we'd also have to, again, see, are they doing too much if they continue to do some more from this point?
Yeah, I think there's still some work to do. They've kind of hit that on the head, Kevin, where
Still seeing this kind of head and shoulders here too.
Some duration, right? There was 6 weeks between
you got them both ways.
Decision and the next
really just chop. You got a head and a shoulder here, inverse shoulders,
those lag effects take
double top.
Here. Probably not a bad way to look at this, because that's what everybody's been calling for, is that, like, you don't know what's happening due to the fact that you were raising 10 meetings in a row. That's going to have an effect on the economy, and we're slowly starting to get some of that data.
even though Jerome Powell spoke yesterday, I thought Raphael Bostic, the president of the Atlanta Federal Reserve, he made some really intelligent comments saying he thinks we should wait through July because we need to let the data work more, and he doesn't think there's enough of a pause between now and the July meeting to see enough data to make another decision. So he basically said, you know, he wants to pause more before further hiking. He wants to see the effect of the data, more time for the data to take effect. So I think what they're starting to hint at is, and I've said this all along, I think they want to be done. They feel they might not have to be done, but they want to be done at 5 1/8.
Yeah.
But we'll see. I think the Bank of England playing catch up today, going to 5% was pretty significant, but they're still below where we are.
Yeah, and Norway and Switzerland also raised, and that was after Bank of Canada and Australia raised after their pauses. But we'll have to wait and see on this and see if we do get that rate hike come late July. Let's take a quick break here, guys. When we come back, we're going to take a look at AMD. Chipmaker just hit 52-week highs last week, but has dumped about 6% so far this week alone. 5 sessions down in a row. Fast Markets coming right back.
German 2- and 10-year yield curve inverts most since 1992. The reverse repo's below 2 trillion now. China says U.S. should act to undo negative impact of Biden's Xi remark. Here's an inflation rate map of the United States.
percent of the market share. So I think they're trying to play catch up. But,
hey trader, good afternoon, sir.
Earnings per share, their revenue expectations dropped
or ma'am
2.6% to 23 billion. Their earnings in the last the current fiscal year
come up on 12:30.
To $2.
You guys are at 28 likes on the day. I appreciate it.
Not in the same,
pretty slow summer day. Little J Powell.
that some of these other stocks do.
Warren, keep it exciting though.
Catch up and compete with NVIDIA, but they are not in the game yet. And it's significant level. It looks like around 108.78.
Appreciate you guys' likes. SPY's bouncing there off VWAP.
Gap, or the bottom, I guess, of that gap that they need to fill.
Yeah, and Nathan, when you look at this, Kevin mentioned AI, the total addressable market. We don't even really have a basis for that yet. NVIDIA seems to be a little bit more optimistic than maybe Lisa Su here at the CEO of AMD, but she's led a pretty good resurgence in this stock. What's your take here on AMD?
Yeah, it's not NVIDIA, and not at this point. I think Kevin makes, a lot of good comments there regarding their competitive positioning, I guess, with NVIDIA. We know they're not going to be producing their AI chips until Q4 of this year. And as we saw from the guidance from last quarter back on May 2nd, it wasn't a beat raise like NVIDIA because they don't have that AI demand component there, right? But they did send the stock up from 81, guys. So it was down $5 on guidance on May 3rd, and they rallied the stock from basically 81 up to 130. So they're treating it as if it's going to deliver like an NVIDIA. And I just
Overstock won the bid.
Looking at this stock as an
So they were the stalking horse bidder, and they won it.
When they report in late July or early August that there's going to be high expectations. Let's put it that way, given that they moved the stock up 50%. But we know PC sales have been getting hit. Maybe they, improve or flatten out a little bit here in the next quarter. But they still have some time to go before you really see that EPS and revenue boom from AI.
Something to watch for, Tom, real quick. Sorry, I've got a little stat here. NVIDIA's market cap, just over $1 trillion. AMD's market cap, $193 billion. So basically a fifth of NVIDIA. So if they do start to compete, there is opportunity there, but that's a big if.
Yeah, and Q4 is when their MI300 chip is going to compete with NVIDIA's. But Nathan, when you look at this from a trading perspective, I mean, just at the end of May, the RSI was at the 80 level. So anything above 70s overbought. It was at 80. Now it's down to 45. So we've had a substantial pullback in the shares.
Yeah, certainly. And now you might question, given the 15%-ish drop here in, 7 days or whatever, and if you look at something like a MACD oscillator, you can see it's really basically at the lows it's been in the last year or so, which tells you it's pulled back significantly. Kevin brings up a good point, though, at that 108 level. Are we going to
AMC
fill
still
that gap?
dropping down 9%.
A little bit more downside, but I was thinking, given the pullback and given the fact, the potentially oversold pullback that it has right now.
Yeah, not Bye Bye Baby, just Bed Bath stuff.
4th holiday, so I was looking at something like a bullish, more of a mean reversion from the recent sell-off type of a position. And one way you could do that is by doing it a call diagonal. I was looking at buying the 114 call on the standard July expiration, and then selling an out-of-the-money 120 call on that July 7th expiration date. You've got 2 weekends, and you got the July 4th holiday that would be in that sold call at the 120 strike. So that's just one way. If you had a bullish position looking for some mean reversion in the next couple of weeks, you could position it as such.
Yeah, let's break this one down. July 21st monthly cycle, buying the 114 strike call, just slightly out of the money to the upside. And then to take advantage of that and lower the cost entry point on that bullish call, selling the July 7th weeklies 120 strike call. You're paying roughly, we've got 340 debit here on the Analyze tab. It's closer, just below 315 at this point. So it's a little bit cheaper because the stock has moved a little bit lower. But the debit that you pay on this type of strategy is your risk on it. So about $340 on that Analyze tab there that we've got to kind of reflect the risk profile on this one. You do have some assignment risk on your short 120 call into July 7th expiration, so keep that in mind. But Kevin, this is a $6 wide call calendar. You're barely paying over $3 for this one, so it's got a pretty good risk potential reward setup.
29 days on the long side, 15 days on the short side. So what does that do? That cuts into that premium level, obviously, the net debit that you pay. But if you look at the theta, it hasn't really kicked in yet. The theta will start to pick up as you get closer to expiration. But you've got a nice $6 spread here. You're paying just over $3 for a $6 spread, and you'll have a chance to extend some duration into that. But a 2-week diagonal, but remember, it's not a stock replacement. Both these are out of the money, so this is a fundamental diagonal spread. So the theta is a little bit lower because both are out of the money.
Yeah, on this. And Nathan, when you look at this, somebody might say, oh, why don't you just buy the 114 call out in July, wait a month and see if it goes higher here. You're offsetting some of the costs on this, but it's not like you're looking for an explosion back to 132 where it was trading just over a week ago, right?
Yeah, exactly right. And that's the risk. Near term, what if we pull back to that 108, like Kevin mentioned, and then we rebound? If you had bought that 114, you're going to get hit, but you offset some of that by the short call. The other thing is, if we do see an explosion,
Iron at 18%.
Back, let's say we get that bullish momentum back in here, I've positioned it such that if it gets above that 120 strike by the July 7th expiration, you're going to walk out of there with a double if you close out of both of those legs. If you take into consideration there will still be some time value in the long strike at the expiration of the short strike, we'll just say it's about a double. I don't want to say you're guaranteed to get a double there, but it's about a double, which isn't a bad trade if you get that explosive move.
Yeah, you've got some time decay working in your favor on that one also. And as Nathan and Kevin both mentioned, if you're closing this early or rolling or adjusting that short option to collect credits, you got to make sure the market's open, liquidity is provided on those adjustments or trade management on those. So good look at a bullish call diagonal here in AMD.
Yeah, I don't know how it's going to play out, trader.
Not anything massive here. All right, thanks to Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research, for joining us, breaking down markets and AMD. But coming up after the break, Kevin and I are going to be joined by Landon Swan.
I added some shares this morning. I sold I sold here, and then today I just added back a much smaller amount though than what I had before. Afternoon, Jay from the Bay. Wow, that's crazy, trader. Yeah, you can't really... You just put a limit order for low and just try and get filled, I guess. That's way too big of a spread.
Handily. In fact, if you look at AutoNation, CarMax, and Carvana on a purchase intent scale or consumer happiness, AutoNation is the top here. It's by far the leader when it comes to happiness at 85%, CarMax 63, and Carvana down at 54. Even when you look at purchase intent, though, AutoNation and CarMax are both very positive when you look at a month-over-month, quarter-over-quarter. This is actually the chart that we've got for you guys is the quarter-over-quarter chart. Carvana's losing. It's down about 50% on that period, and AutoNation and CarMax are up about 20-30% each. So CarMax is definitely taking advantage of this better than Carvana. Not quite as good as AutoNation. AutoNation is doing better, but there's a lot of factors going into play. It's not just used car prices. It's the Fed not raising rates, so that lowers payments if you're going to be buying a new or buy a used car. But overall, I think that CarMax's pitch is resonating with consumers. You know, they've got a very large selection of vehicles. The customers love their return policy, their warranty. I mean, when was the last time you heard of a car company that had a return policy? It's very cool. You can also go there to sell a car. They'll give you a price and you can come back within 7 days. And they also love the no haggle pricing. So there's a lot of things that people just like about CarMax. And all the metrics that we see, they're doing fairly well. And based on the stock kind of bumping up against that support, or that resistance maybe turns support, I like the potential for a breakthrough on 80 here.
You know, Landon, this is a fascinating story, and here's why I think. I'm going to make a statement. You tell me where I'm wrong here. Some companies like volatility, right? You would have thought that these used car companies would have done extremely well during the pandemic and post-pandemic when used cars were so popular. But CarMax didn't do well. They did horribly because it appears they had trouble pricing the cars. And I think this company prefers a stable auto market to a volatile one like we're coming out of. So I think this stock suffered during that because, frankly, CarMax suffered during that. They're so much better than Carvana, right? Carvana, number one, they're brick and mortar. Carvana is a vending machine. I don't know what the heck they're doing there. But this company seems to do extremely well when their used car market is more stable and more predictable. Now, in terms of, you made a good point. The CPI for used cars, if you look inside the data, 2 months in a row, used car prices were up 4.4%.
SPY's moving up. See if it
this company long term.
See if it rejects the high of the day again.
If you look at a long-term chart, they're incredibly profitable in the past. They want this market to simmer down so they can get back to doing what they do right. Tell me where I'm wrong, Landon.
I think you got it exactly right. I mean, yes, if used car prices go up, all your inventory goes up. But that's short-term thinking. Long-term, they've got their system, right? They know exactly how much a car's worth and what they'll offer and then what they can sell it for, how much it's going to depreciate. They've got their formulas down.
Barbecue's moving up a little bit.
Slowly depreciate over time. Like
1939, down 5.5% now. We're down like, what, 11, 12% at one point.
After that, it's nice and slow, and they're in the used car business, so it should be nice and slow depreciation. They've got their system. They've got their methodology. They don't want wrenches in the works, and I think that's what you're talking about. When these used car prices are going crazy up and down, then all of a sudden, they could find themselves in a position where they buy a car and turn around and sell it a week or two later and lose money on it, and they've never done that before, right? Because they know exactly what they're doing. So I agree, the volatility is not great for them. It's probably very challenging. I'm sure it presented some opportunities, but I am certain that they would prefer steady prices and just back to business as usual. As an investor of CarMax, I would certainly prefer that.
When you look at those happiness levels, it seems like right in the middle of AutoNation, that's kind of more of a regional play there, Landon. So I don't really pay attention to that. But then you've got all the competitors that came in during the pandemic too. You got Vroom, Carvana. Carvana a lot of debt on their sheets.
They're running out of cash.
Yeah, they're burning through cash, right? They need probably an injection at this point. Short squeeze taking place in that stock across the board. But when you look at the happiness levels and the business and the number of cars sold on a yearly basis, you know, you look at this and you say, okay, our earnings score is what, and it makes sense.
Yeah, so I mean, I think that long term we're probably pretty positive on this one. Again, to Kevin's point, we want it to calm down, the used car prices to calm down. But going into this earnings report, we're at a plus 38, so firmly in the bullish category, ready to take a bet on that side. And then just like I said, you know, I think that if you can get over 80 as a long-term investor, that could be the running point to maybe up to
1939 on
triple digits again,
barbecue.
where it was not too long ago. So like Folio's plus 38, firmly bullish going into this one.
That was me.
Great stuff. And you made that point. Last quarter, they surprised to the upside.
I think Edge actually might be a little lighter load on the system too.
Thanks, appreciate it.
Thanks, guys. Take care.
All right, that's Landon Swan, co-founder at
Stop looking at me, Swan.
Data for us here on CarMax. Now we go to the trading side on it. How do you want to look at this from an example trade perspective?
$6.90 expected move, almost $7 on this
Percentage-wise, it's pretty hefty.
What's that? 8-9% getting up there. So, Tom, you heard my general thing. If you are bullish on this name, like Folio's data is and what we've talked about here, you could do the 84 call calendar, right? And that would be equal to the move on the upside, but we don't know what's going to happen. We don't. I have no idea if the stock is going up or to 84 or anything. So if you don't know and you want to trade this, you could do also the 70 put calendar. Just the 1 week. It's trading. You know, one's trading about 55 cents. The other was trading 50. Now they're both a little higher. But all things considered, the double calendar gives you that opportunity. I think that is the call calendar there on the upside. That's trading right now about 53 cents. The put's actually a little higher, up to 63 cents, Tom. But anyway, a bullish play up towards $84, right around the price of the, you've got dollar options, so you can be very precise in your movement. But this is one that you're playing for an upside move. If you want to play for a downside move, maybe the 70 put calendar is the right play. If you want to do both, you can do the double calendar. Combine the two, it's trading about $1.13.
Right.
$1.15 range.
Yeah, so the divergence between implied volatility you're really taking advantage of because you're selling about a 200% aggregate implied vol and buying in the June 30th weekly about a 95% aggregate implied volatility. So let's break these down. We're going to do them one by one, Kev, and then we're going to show you with the double calendar. On the call side, the 84 strike, buying the June 30th weekly 84 call, selling that same strike in the June 23rd weeklies that expire tomorrow. You're paying roughly about a 50-cent debit for that trade right there. And you can see the break-evens on this one just above, I'd say probably, they're going to probably be just below 100 and just above maybe 75 or something like that, maybe a little bit tighter than we've got on there. The debit you pay is your risk on that particular trade. And on the put side, the 70 put strike, we're looking at buying the 70 put in the June 30th, selling the June 23rd weekly 70 put. You're paying roughly, it's worth about 65 cents. Right. You've got 55 cents on there. The debit you pay is your risk, and you've got a nice wide range on that one for it to trade in. You got some assignment risk on your short options. They've only got 1 day till expiration, so keep that in mind. But Kevin's got the double calendar position for us lined up where this is taking advantage of that divergence in the implied volatility. You want it to move maybe that one standard deviation because the apex of profitability is either at or near 70 and at or near the 84 strike on this one. Kev, your final thoughts on the double calendar? It's inexpensive, right?
Right. Taking advantage, remember, we always look for edge, and edge is hard to find these days. But when you're talking about an implied volatility so high in the front expiration, there's a little way to do that. Now, does that guarantee you're going to be profitable? No, it doesn't. No. But you've got a low net debit number, way under $1, under 60 cents on the call side. So that gives you a little bit of edge there. You're collecting, if you do the double calendar, it's about $185 in theoretical theta. It'll be something about that. There's a little bit of vega involved though, so you have some risk there when they all come down. But all things considered, this gives you the opportunity to be profitable in either direction.
Yeah, break evens on the double calendar be probably close to about 65 on the downside and about 90 on the upside. So you have to keep that in mind also. But a good look at a double calendar position, or if you're more bullish or more bearish, just do one or the other. Yeah, a lot of options there. All right, Kev, let's take a quick break. When we come back, we're going to take a look at Amazon, which is up sharply today, again, on the back of another price target hike. Fast Markets coming right back. Here on the TD Ameritrade Network. Before we take a look at Amazon and the rally that we've seen in that stock, let's bring in Ben Lichtenstein, Senior Futures Contributor here on the network. Give us a market update. Benny,
Lichtenstein.
Stocks mixed at this point.
Barbecue up a little bit more. 1970.
Low. What's your take here?
Yeah, Tom, a mixed session.
Only down 3.9% now.
For the most part,
it's rallied almost 8% from the bottom. 9%.
We saw the Dow trade down below 34,000 down to 33,835. You got the Nasdaq, which is holding below 15K at 14. Well,
SPY setting up this wedge. We'll see which side it breaks out of.
43. You know, I think this is a reflection of a market that's really kind of mixed, right? As I mentioned, in line with the trend we've been seeing, kind of chop as investors sift through some of the data. Comments from Fed Chair Jerome Powell this morning. Jobless claims. We had existing home sales. The Chicago Fed leading indicators really failed to tip the scales one way or the other. Here you can see 2 of the 4 majors in positive territory, 2 of the 4 majors in negative territory, and really looking at the strength we're seeing in the Nasdaq is kind of, I think, a bit of a head scratcher in many ways still, kind of bucking what we're seeing in terms of rates, inching up a bit here today. But yeah, just sort of off the highs that we saw last week. And, you know, I think a bit of a pullback could have been expected as investors, again, come to grips with comments from Fed Chair Jerome Powell, and as we come off a very strong run-up that we saw into the middle of June here, Tom.
Yeah, higher dollar, higher yields. Kind of scratching my head on that one, too, while we're seeing that strength in the Nasdaq after 3 straight days of losses. But, Benny, crude oil taking a beating today, down over 4%. Yeah. What's going on there?
Yeah, back down below $70 a barrel. I think there's a lot of concern out there about what this higher rate environment is going to mean in terms of economic conditions. Interestingly enough, we did see a draw in the inventories. Crude inventories were drawn down by about 4 million barrels, down 3.8 according to the EIA. Now Cushing a little bit less than that, so maybe that's why we're seeing some weakness here. You mentioned the U.S. dollar, which is inching up a little bit. Oftentimes that weighs on crude prices, but look at energies across the board here. Again, Tom, I think the idea being just a slower, weakening economy, ultimately in this higher rate environment. You had the Bank of England raise rates 50 basis points. I mean, everybody was expecting 25, but them to raise, but 50 was a little bit more aggressive than anticipated. We also heard from Norway, we heard from Swiss National Bank, all raising rates. I mean, the Fed was pretty clear, Powell yesterday and today, that there's more to come here as well. So I think the concern out there being economic conditions. And, I talked to Carly Garner from DeCarly Trading earlier in the Future Show, and I was asking her about some of the production cuts, how we haven't really seen response to the upside. She said all of that's been priced in at this point, and she expects further downside price decay here, Tom.
All right, great breakdown there, Ben. Appreciate it. That's Ben Lichtenstein, host of the Future Show, breaking down markets for us. But now let's bring in George Tillis, senior markets correspondent here on the network. George, it seems like Amazon on a daily basis now trying to play catch up with the other big mega cap tech names. Yeah. We're seeing price target raises across the board. Everybody thinking AI is really going to help this company out, right?
It is, and I think, you have to think of Amazon really as having two themes. We know, of course, the retail side of their sales, which is the greatest component of their revenue, about 80%. And then Amazon Web Services. I talked about Broadcom or Avago, symbol AVGO, with Nicole earlier today, and that stock is ramping higher because of its infrastructure, enterprise infrastructure backbone. You have to think about the backbone of artificial intelligence, which includes not only connectivity solutions, not only semiconductors from companies like NVIDIA, but the cloud. And I think that's where Amazon Web Services component of Amazon's business is going to continue to shine. I think if you look at the other thing about their business, the retail side of their business also is starting to improve in terms of scalability as more and more of the sales, which are growing every single year, are going towards third-party resellers versus Amazon Direct. That gives the business a little bit more scalability, lower costs, and those margins may improve going forward. Now, Loop Capital also increased their price target to $180 from $140, and they actually see the cloud sales, which were only up about 16% year over year, compared to 20% for Microsoft and about 23% for Google's cloud, which has been growing competitively against Amazon Web Services. Loop actually sees the deceleration in Amazon Web Services cloud growth bottoming out in the next couple of quarters. But they also talk about what I mentioned just a moment ago, the AI infrastructure. Everything is going to be in the cloud for connectivity solutions. And that's why we're seeing companies like Google, Microsoft, now Amazon starting to play catch up, considering, again, the operating margins in terms of the operating margin growth. It really comes from AWS, not from the retail space. Now, if the retail space starts to improve in terms of scalability, that's also going to be a huge sweetener for the business as well.
George, they had an FTC action taken against them yesterday that they make it really easy to sign up for Amazon Prime, make it real hard to cancel. Yeah. Excuse me, didn't they just describe the entire internet? Every single site ever? It's easy to get in, it's hard to get out. The market shook it off. They basically ignored that news. Now it's higher today. They closed their acquisition of Roomba. They're looking into buying this company, Ocado, the robots for supermarkets. George, this company is shaking up the bad news now and embracing the good news.
Yeah, I mean, that's the thing, and I agree with you there. When you talk about, signing up for services, it's so ubiquitous across the board, multiple companies. And these FTC actions, they're doing their due diligence, but it's just incidental to the business overall because of the scalability. I mean, the sales for Amazon last year were $530 billion. I mean, it's a remarkably large company in terms of its scalability. And they are spending still from a CapEx standpoint on expanding their businesses, the infrastructure they're building out, logistics, including robotics for warehousing, delivery, and so forth. Still very expensive. But if they can improve the scalable margins in the retail business, you have to look out for this company, because we know that their cloud business, in terms of their market share, is leading, even though their growth is decelerating. The retail space also might show some improvement. And you also have to consider the last part of their business in which they're gaining market share, and that's advertising. If you look at digital ads, Google and Meta have the largest market share, but Amazon has been closing the gap. They've been growing their digital ad marketing space quite aggressively in the past few years. So that's another area you have to consider when looking at Amazon for an investment.
It's nearly 8% global share now, according to JP Morgan, on that, contributing. They expect about $46 billion just this year. So definitely another silo of revenue generation. All right, George, appreciate the rundown here on Amazon. That's George Tillis, senior markets correspondent here, breaking that down for us. Kevin, you mentioned the iRobot acquisition, $1.7 billion. The EU is antitrust investigation. They finish up on July 6th, and then they're going to extend it. They're trying to push back against this deal. I don't understand why.
Roomba is hurting what?
I don't know.
Who's being hurt by Amazon buying Roomba?
There's others with similar products. I don't know. But they are going to. They got Prime Day on July 11th and 12th.
Yep.
So that's going to be a big catalyst. Right when that was announced, Target announced their week of deals that they're going to have, of course, as they always do.
And Walmart will come out with 8 days, right? Yeah. It's like one-upsmanship.
But the way that I wanted to look at this, price target hikes. George mentioned Loop Capital up to 180 yesterday. Got a price target hike up to 150. So I think a lot of traders feel when you see moves in stocks like this, you feel like you missed the move. That's the kind of strategy I wanted to kind of look at as an example here. How to play this using the option market potentially to be profitable on this, or maybe pick up the shares at a cheaper price. So looked at a cash secured put here, Kev, out in the July monthly cycle, so 29 days till expiration, selling one of the 127 strike puts. You're collecting a credit roughly about $3. Now, probability on the 127 put, you see here, you want it to remain above that 127 strike. Probability of finishing out of the money, only about 58%. But the break even now goes down to 124 because you collect that $3, Kev. That's got about a 68% probability of finishing out of the money. You've got a lot of risk on this one because you have to be prepared to buy the shares if at expiration this is below the 127 strike. But your break even 124, risk about $12,400 or $12,300 on this one, Kev.
About a month trade in this. But the good news is because it's a month trade, you collect about, north of $3 on this. The theta is relatively mild. That'll pick up. But you're right. This is for intermediate to larger accounts because there is a capital requirement on a put on $130 stock. So you've got to be careful there. But as long as you have intent to buy that, your entry point will be lower.
Yeah, and Kevin, this is like one of those strategies you can do repetitively if you're comfortable with the stock saying above that a specific strike for a specific duration. This one's got 29 days. Also, on this one, it looks similar to a cover calls type of strategy, but it's not. It's just
Theta Farm
to take advantage of. If it does pull back, you're comfortable buying it at a lower price point. All right, that's going to do it for you and I today here, Kevin, on Fast Market. But stick around right here on the TD Ameritrade Network. Next Gen Investing's coming up.
Stick around. Qualcomm and Sony in a multi-year smartphone pact. Money market fund assets are near all-time highs. The rally in technology stocks isn't going to stop until the Fed gets more aggressive and breaks the economy, according to Wells Fargo Chris Harvey. AI could further an erosion of the middle class unless Congress takes action, says Chuck Schumer. Dollar yen at fresh 7-month high. Last up 0.58%. Oh yeah, and I guess I had storage numbers at 10:30. really fall much. The share of adults who said they were worse off financially than a year earlier rose to 35%, the highest level since the question was first asked in 2014. Homebuyers now need 117,000 annual income to afford a median-priced home in the U.S. See if SPY kind of bounces off this trend line here. The wedge is closing. The wedge is closing. Yeah, it's bouncing right on that support.
Alongside Alex Coffey. And Alex, we are seeing some degree of a reversal in the markets today. I can't say necessarily a comeback, as the NASDAQ has been relatively unchanged throughout the session, but now up about 0.5%, led by, of course, a lot of the strengths we're seeing in some of the heaviest tech names throughout the market.
Yeah, a little bit of a bounce back for some of the indices. Still mostly a pretty mixed day, I would say, but most importantly, just a quiet day. You look at volumes, this is about as low as we've seen them in quite some time. Pretty heavy trading month in the month of June and May, but not really this week. It's just been kind of steadily declining as the week has rolled on. So I don't know if the holiday had something to do with it. I don't know if it's the recent strength that we've seen,
sunshine.
the calmer waters, volatility lower, but it is
sunshiny
slow. And
days.
Again, we've said this a couple times the last few weeks, we got some stock-specific stuff to talk about.
We do, thank goodness, because I think right now to digest the overall macro picture, it's pretty much the same that's been said all throughout the other shows. But we'll be kicking things off here with our upvote and downvote segment. Following that, we'll
add to my posts if we get a
upvotes. Our FOMO discussion
break
today
there.
is all things Take-Two Interactive, as shares are pacing for their longest winning streak since 2009, which is frankly very impressive. Then we'll look at Micron investing more in their future as well as in plants overseas. Last but not least, our under 30 name today is Ford, which is getting some government incentives as far as its EVs go, and we're seeing shares higher.
Yeah, we'll talk with that with George. Looking at Micron, the next in the kind of line of tech firms that we've seen sort of seemingly diversifying away from China and using India as maybe the next market to focus on in terms of where to have their facilities in terms of manufacturing, etc. And then, of course, we got a lot to get through on upvote, downvote. So let's start there. Upvote, downvote, not endorsements, not recommendations. Plenty to go through here, but a little bit of a kind of travel theme for the most part. At least 3 of the 4 names here pretty tied to that space. And you can throw Netflix in there. Maybe you throw on Netflix during the travel.
SPY's breaking down out of that wedge a little bit. We do have VWAP right there though.
kind of close out the week.
Although they have made it a lot harder to do that now with their password sharing crackdown. It's not as easy to access Netflix, and I've definitely been trying. But we'll start things off here with Expedia, which did get
Whoa, there's the flush. Holy smokes.
Today, I would say from B.
Right, I can't add to it.
Coverage on the stock
that was crazy.
$160 price target, which
so you just break that support.
Upside from where we're currently trading at just below 107 a share. But the analyst is positive on the company's leading position across its key markets.
All right, looking for low of day.
Execution resulting in the closure of U.S. market share. They also highlighted tailwinds in the tech stack changes,
432
in its B2B markets, and margin expansion through cost
I take some profits at low day.
Some overall marketing efficiencies from the company. Now, this name is completely split among the analysts that cover it. Of the 32 analysts, 15 buys, 15 holds. There is
Weeble's really annoying saying I can't do market orders on SPY options. It's like a 1 cent spread.
From the analyst community, but average price target
Trash.
is 125, which does imply upside, but not as optimistic as a price target of $160, of course.
This particular name got off to a very, very hot start at the beginning of June, and it has since sort of soured, but at higher levels, kind of consolidating here around 105. But this is a pretty optimistic initiation by B. Riley. The 160 price
there
target
it
is
is.
Quite a bit of upside from the current share price,
Look,
but not a name
so long.
that I think is really maybe as in focus as some of the others. So for that reason, we'll go ahead and say downvote, but you could make an argument for this one, especially given the turnaround of recent and, of course, this pretty impressive call from B. Riley. Speaking of B. Riley, they also looked at TripAdvisor as well. Trip, the stock ticker here, Jenny, and the move in reaction to this note seemingly a little larger.
It is, and I think that is because this name has been met with more pressure really throughout the trading year thus far. It's down still 7% on the year, even with this almost 3% higher on the session. B. Riley also starting coverage on TripAdvisor, though, with a buy rating and a $25 price target. And they said this reflects a stable core segment, which it believes will continue to generate meaningful free cash flow for the foreseeable future. They are now also forecasting for robust growth for Viator, which they call one of the best plays on growth in terms of experiences bookings. This name, though, I will say actually definitely leaning more neutral from an analyst perspective. 3 buys, 12 holds, 2 underperforms, 2 sells. So the average price target is actually closer to this analyst note's $21 a share. So all things relative, though, because this name obviously has a lower price point compared to, say, Expedia to begin with. But it's actually our only name of the 4 upvote and downvote stocks that is lower year to date and lower over the last 12 months.
I think that makes this a little bit more intriguing from potentially a technical
Old one put there.
But just conversationally, because this
Look
is
less,
somewhat, I mean, you just look at the average, price target being
the rest,
21, that's
the other
of
two
course
keep running.
A good 30% or so above the current share price, but it seems a little bit more kind of different than what the market has been pricing. This hasn't been an outperformer. That it hasn't been NVIDIA, for example, where there's this pile-on effect. This seems a little bit more tactical, a little bit more focused. Obviously, kind of initiating coverage in this space as a whole. But TripAdvisor getting a little bit more of a pop today, underperforming relative to some of its peers, struggling post-earnings. In a pretty, I would say optimistic call from B. Riley. That $25 price target is comparable, I would say, if you kind of compared that 160 to the current share price in Expedia. So looking for a ton of upside in both of those names. Going to say upvote, though, for TripAdvisor. If we had to pick the two, you could go either way, but going ahead and trying to narrow these down. Next one on the list, though, is UAL. So maybe if you were going to go somewhere that you read about on TripAdvisor, maybe if you were going to do something on Expedia, well, maybe you have to hop on an airplane. And
yeah, that's a pretty big support from yesterday.
Being based out of here, that's a common option.
Took some time maybe to break through that.
Twice as much as you
We'll retest it VWAP.
Flights are extremely expensive. I was recently on United's website thinking everything right now is so costly in terms of air travel. But United Airlines did say this morning it added a self-service feature to its mobile app that will now provide customers with customized options for rebooking and tracking baggage when flights get delayed.
Oh, look at that bounce.
Which feels like a pretty persistent theme as of late. But the app, which will also, they said, provide meal and hotel vouchers, is expected to automatically offer affected customers with these options with their flights being delayed or canceled. So this is seen to me as
I could day trade more. I'd reload here.
Some of the complaints that have been really overwhelming across the board with all air carriers. It's not just United, but they're currently the best performer of the airlines on the year, up about 40%, up still 12% for the month, and up over 40.5% over the last 12 months. Now, we are still seeing shares down about 3.7% off of their high, but all things considered, this name has fared what has been a volatile storm for the airlines in the last several months quite well. And for that reason, this name definitely sees more bullish analyst activity. 13 buys, 7 holds, no sells, no bearish calls on this name at all.
Yeah, this is one of the stories that I think on the surface maybe would read like, oh, this is going to cost them a lot of money. It's going to make it easier for you to kind of claw back something when you have a, not favorable experience, let's say, on one of these airlines, in particular United. But there's a math equation here. Say you have a flight delayed, you're unhappy about it, you pull out your phone or whatever it is, you call service, you commit that time. Oftentimes the end there was, well, you got a voucher or something, but someone had to deal with that. So the more that they can automate this, increases the efficiency here, maybe alleviate some of those service wait times. You can see what they're doing here. But I think it goes to show what you said, which is this has been a bigger problem, not for just United, but for this industry as a whole recently. Let's just get these things here on time and deliver the service that was paid for.
I mean, no kidding. I feel like you read across like social media, just everyone's flights are either delayed or canceled. I feel like I have been somehow very lucky. This hasn't happened to me significantly yet, but I feel like because I said that, Alex, now I'll probably have every single flight delayed for the next year. But our last name today is Netflix. Now, Netflix did announce really interesting news, actually, that their co-CEO outlined the company's plans to spend about $2.5 billion for K-drama, including working with South Korean organizations to help identify new talent. They did say that Netflix will also be bankrolling training programs for the next generation of entertainers, both in front and behind the camera. And I have to think this follows the extremely successful launch of Squid Game several years back, which of course was produced by a Korean studio. So pushing more overseas, I think this is an interesting move by Netflix. Not enough to move the needle here, as shares are still down about 1% on the session. Netflix, though, a name that's up 43% on the year, up 135% now over the last 12 months.
Yeah, I think this is a really interesting headline. I'm not sure, at least right now, how much of a market mover it's going to be. Obviously, it shows that they're willing to kind of continue to be kind of forward-looking in terms of where they're spending content and going towards things that have been popular and will continue to keep subscribers, one, growing internationally, but also subscribed here in North America. Parasite, I believe, is a South Korean film as well. As one of the better films I can remember seeing the last few years. So this isn't like a one-hit wonder situation with Squid Game. I think there's really a lot of incentive for them to be investing in this region, particularly in things like film and entertainment. But from a trading and talking about this standpoint, I'm not sure this headline today is maybe as meaningful as, let's say, the United Airlines one. But also, United ties into our theme a little bit easier, so we'll go with the travel theme. Let's talk TripAdvisor. Let's talk some United Airlines.
And I think it's a nice theme because TripAdvisor has been somewhat of an underperformer in its respective space, being the online travel agencies, and one of the best performers in the overall airline space. So we'll be diving into some technical levels with our chart master. We'll also be looking at some example trades. Stick around. Next Gen Investing. We'll be right back.
Excuse me.
Below this red dashed line near 17, and that was a crucial point here because it was a point of frequent support, and we broke below it with a one-day move downward to the tune of about 8.5% or so, brought us into new yearly lows. Then we stabilized a little bit here. We recovered somewhat. The next low in this journey downward, unfortunately, was around the $15 level near this green dashed line, and we've recovered a little bit since then. We moved above this volume node here near the 16 level, and we moved above our yellow 21-day exponential moving average today. That was frequently acting as support. It looked a little dangerous yesterday because we closed below it, but now we're recovering once again back above that point as well. So we can see as well, in addition to that, now we have this short-term trend line to watch here based on these lows that we established yesterday. That could be something to watch going forward as well. Just remember, the shorter term a trend line is, the less useful it is, but you got to start somewhere with some of these points sometimes. And we can see now that the RSI, our measure of momentum, trending upward still. We once again dipped below our 50 midline with yesterday's decline, but we're making our way back above that point as well with price here. So look for RSI to make new relative highs above this point as price climbs above its old relative highs as well. So really the $17 level, like I mentioned, is the critical point here because this was a supportive point many times here and around here as well. It was a little bit above that point there, but just for the sake of round numbers, we'll call it near 17. And we also topped out here then, once again showing that old support became new resistance. And also it was significant because we filled the gap here that we generated with that 8.5% downward move there. So where to look for some support and resistance? Well, like I said, we have our trend line, and then below that, probably around 15 would be the dangerous point where price could be getting to based on those lows that we carved out there. To the upside, 17, like I said, that's the critical point to break above. Just above that, we've got our orange 63-day exponential moving average around 1728, so very close to this importance of resistance level here as well. So a move beyond that would be notable.
$17 level, and Rick, I have to say, all things considered, we're relatively close to that level right now, just trading just below $16.60 a share. So fairly reasonable and definitely more achievable, it seems like, in the near term than that $25 price target we of course got from B. Riley this morning. But Alex, now when trading this name, thinking that, you know, following this analyst belief that this name stands to only continue to improve its cash flow in the near future and only continues to grow, walk us through that an example trade leading into more bullish momentum.
Yeah, you mentioned pop-ups, Jenny. For those looking for a pop-up in this stock, I got a trade illustration. I've been waiting to say that for like 5 minutes.
Oh, so. No, that was good. That was good. That was like a Ben Lichtenstein.
Well, we got Ben coming up next, but let's do something real quick here. Buy and call vertical. Okay, he talked about 17. We need to move to 17 and a little bit more on this particular trade illustration to get to the max profit. but it will benefit from any type of upwards movement for here. So that's the idea. Really low volatility relative to itself.
Barbecue up a little more, 19.99.
In a couple ways. One, the movement that you're looking for. The analyst was very optimistic in this name, calling it one of their best picks in this particular space. Also, this is a strategy that is used when implied volatilities are typically a little bit lower. So with this, this strategy goes out to July. The thing to think about here is how it's structured in this particular case. The upside
SPY stays below VWAP here.
graph, which we'll see on the risk profiles at 17.5. Rick talked about
Continues with this
being
bear
a pretty
flag.
critical point of resistance. It's both where that gap was, as
Did
well
bounce
as
on that support from yesterday.
where this
Should
name had kind of
respect my lines a little bit more.
momentum. So
Well,
if you're looking at that, maybe you would shift this around where you're selling that 17 strike. This
so excited with that volatility.
from a test of that 17 and potentially a little bit of a breakthrough with 17.
20 cents, back to 20 cents on barbecue.
Is the break
Only down 2.5% now. Big reversal day.
With these call debit spreads or put debit spreads is sort of as a loose guideline, looking for risk and reward to be equal. So in this case, it's $75 in risk, $75 in max possible reward, neither accounting for transaction fees, of course, but the break even also being close to the current share price. So with the stock at 1660, 1675 being the break even, kind of falls in line with basically all of those guidelines.
Alex, I so thought you were going to say you agreed with me about the pop-ups, and you were going to be like, yeah, that's wild, and it was completely different.
What
direction.
I will say is the Yelp situation, where every time I try to read a Yelp review, I have to make an account. I'm never making that account. I'm never going to read those reviews now.
I avoid Yelp at all costs for that very reason. So these are like lessons on the internet, I think. I have to go through so many steps. I'm just not going to do it at this point. But now looking at United, of course, in terms of the technicals, Rick, and you have some pretty hefty expectations here to make a good pun. But could we see shares lift off, perhaps?
Well, they've been rather turbulent, I would say. No pun intended. But looking at the chart during the past year, we can see that we had a very steep rise upward here, and we gave it all back within a couple months later. So kind of an interesting situation on this chart. Nevertheless, still making higher lows from that point there. Since then, we've progressed from a more shallow trend line to a more steep trend line going upward there, which is our white dashed line.
2050 barbecue back to break even. Wow.
That was about where we topped
That's awesome.
here. And we found some consolidation around this area, and we
What a test for liquidity and buyers. Like,
there was definitely some trading.
it's so raw on
taking place at
OTC.
these levels here. Now we're kind of at a crossroads here because we
I mean, literally right at that support.
just barely below this 53 level where the bulls would probably want to see a strong close above to signify a break above.
That's why I
that,
bought right here, because bad news was that was a bear flag. Good news we're at support. Once it started to go up out of that bear flag, that was a trigger for me. Same way how I closed when it came out down below a bull flag right here. And then the other trigger was back here. And this bull flag failed. Came down here to VWAP and then below VWAP. Exact same thing happened in reverse here. At the bottom.
of that day was completely
2062. Look at the illiquidity gaps.
that we may have been in for a move downward there.
Oh my Lanta.
Still would see as the bullish crowd would want a move above the 53 level.
There's no volume.
55 level was about where we topped out right here. That's the pink line there. And we can see momentum is actually still holding up fairly well. We crossed into the overbought area, which is typically regarded as a sign of strength. And we are still hanging on to that overbought area despite price trending downward just a little bit here. So a move above 53 plus hanging on to the overbought area would be worth noting, I think, in terms of any kind of upward move. So in terms of support and resistance, to the upside, as I said, 53 and then 55 are the points to watch. To the downside, we've got our white dashed line here, our trend line. That could be a significant area. Just below that, we've got our 21-day EMA in yellow, near 50.50 or so. So maybe 50.50 to $51 would be a support level to keep your eye out for in this name.
Right, looking to establish somewhat of a new range here, as we have seen shares
That was me,
definitely
sorry.
fall higher, but like you said,
I haven't
it
used
hasn't
Weeble in a
always
long
been the
time.
most
I'm trying to learn how to use it
consistent
again.
of uptrends, especially not for the overall airline space, as we know. But we will leave it there.
For this stuff.
Appreciate all the insight as well as the pun rectification on Chart Master. So now, when trading this
Those
name,
notification
Alex,
sounds
the
are
fact
so
that
annoying.
this name looks completely different than TripAdvisor on a chart perspective, given its overall rally and outperformance this year. Walk us through then a more neutral to bullish leaning example trade.
Super low relative implied volatility. The IV percentile on the Thinkorswim platform here is 2%. So, you know, you can't get below, zero. So you're at the lower end of the range, but we're also at the higher end of price range. And so I looked at a strategy. I think in general, this has been an area of optimism for market participants. So looking at kind of a neutral to bullish reflection of a low volatility strategy, a calendar spread. And so this could be, you make an argument that this is just bullish because it's at the 55 strike and the stock is at 53. But you could also say it's neutral, I would say, given that 53 is only a couple percentage points higher than the current share price. And this goes out till the middle of August in time horizon. So I would argue this is more of an implied volatility play, looking for the stock to kind of maintain its value, kind of retest those multi-year highs around 55. The 2-year high is exactly 55, 57. So if we just get up to the higher end of that range over the last couple of years, see a little bit of expansion of implied volatility, this strategy could benefit. 75 cents is the debit cost for this illustration, to be $75 in risk then, Jenny. And we know what the risk profile looks like. It's going to look like a mountaintop. It's going to peak out at the strike. It's going to have a ton of customization afforded to the individual who's looking at this type of a strategy. I would say this is a neutral to bullish version, given that the stock or the strike selected here is slightly above the current share price, given the time horizon. But for someone who's bearish, for someone who's more bullish, even potentially more neutral or neutral to bearish, as long as there's strikes available within the time frame that you're looking at, this could be a strategy that
last price 22 and a half.
Whatever your opinion may be. But we talk about it every time. Precision is most important. So this a trader looking at this type of a trade illustration would want kind of a grind towards 55 and then an expansion of implied volatility.
And of course, we don't really have any near-term catalysts facing United shares either. Just the fact that right now we are in a very pivotal travel season for, of course, all of the airlines. But also important to keep in mind for both of our example trades today, they do contain multiple legs that can lead to higher transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk, like unanticipated exercise or assignment. Now, coming up next, it's time for FOMO. We are looking at Take-Two Interactive pacing for its longest winning streak since 2009, ever up so slightly on the session. We'll have to see if that can hold. We'll discuss that stock coming up next.
What caused this off? Nothing specific, I don't think. Maybe the news that Overstock won the bid at that cheap price. But I don't know. It reclaimed everything. 2027, down 1%. Super gappy. No liquidity. IRNT is up almost 15%. E-cigarette sales jumped nearly 50% in the past 3 years. Now, should I hold my puts? Probably not. Maybe I will. Because I can't reopen them. Root's holding that price. Interesting, it's that price and not higher. This is like what happens with a buyout, but usually it's closer to the buyout price, I feel like.
Spending,
Liechtenstein.
economic conditions slowing, and maybe even jobs ultimately. And I think that translates into travel. I did notice today, though, a lot of focus on this Wall Street Journal report that there's hotel guests suing Marriott International.
How are they taking their $5.5 billion in debt if they're only paying like $23 million for it?
The suit alleges that the employee protection surcharge violates California's consumer protections and unfair competition laws. The lawsuit filed Wednesday in Los Angeles County Superior Court alleges that the local hotel worker protection ordinance
I feel like it would probably specify if they're taking the debt
designated to reimburse the hotel for costs
and say that this is the amount after the debt's paid off.
Well, they say it goes beyond what Marriott needs to comply with the new
He just said beyond. I'm buying more.
law and enriches the hotel's chain by overcharging guests. The law seeks to afford greater protections for hotel workers, as I mentioned, but this says it's gone a little bit too far. The proposed class action lawsuit estimates that one Los Angeles Marriott would bring in about $3.6 million a year from the surcharge. The cost for the Marriott for them to comply with the ordinance at Los Angeles Airport is far less than that.
I did notice it. Yeah, we're like 50% on I borrow.
Junk fee that directly
Oh, there's actually shares available though. It's been updating.
At Marriott hotels, the extra fee gives Marriott an unfair advantage.
64%, so big bump in borrowing fees. Huge, 6x.
Hotels are getting sued all the time,
and
so this is
not many shares. So yeah, it's a good sign.
But it's what attracting attention here today, and what the Wall Street's covering here today. Also, weighing on shares probably down on the day by about 0.75%.
Ben, what caught my eye from this Wall Street Journal report is that the surcharge ranges between $10 and $14 a night. That's it. I mean, I know it accounts to millions like you highlighted, but $10 to $14 a night, I mean, you're living in LA. You're basically paying that in taxes somehow anyway. So to me, that's obscene. But now walk us through what you're seeing in terms of the broader picture in Marriott, because this name has been sort of in line with its hotel peers, being Hyatt and Hilton this year. They've all seen collective strength. They fell back a little bit in the latter half of this year, but all in all, names that have stuck out what has been a volatile market for travel.
Yeah, collective strength for the most part, and a very similar pattern playing out on multiple time frames as well. You know, I kind of like to look at that more granular all the way into that bigger picture. I like to look for trend, and when I pulled up the chart in Marriott, I found a pretty good working example of well, what we look for. And in this instance, let's just begin with the 1 minute time frame. You can see a strong run up on the left side of your screen. We're just looking at the today's day session trade up to $177 from around 172. You can see again the conviction to the upside. You can see how since we've been just kind of teetering around 176. We're below that level right now. This is sort of the middle of the range that we've been in. Lower extreme around 174, upper extreme around 177. And again, really the conviction on the left side of your screen is what you should see, because since, as mentioned here, it's just been a bit of a chop, right? There's not a lot going on.
All right, SPY's coming up more.
Candles, so let's not get too
need to zoom out before see what that support actually was. That's pretty significant.
I like to take a step back and sort of look at, well, what we're seeing in terms of this recent run up here, again, to 177, and where it puts us on the bigger picture. Because you can see, again, as I look at hourly candles now, adding quite a bit more time onto this chart, to say the least. We're going all the way back to the lows that we saw down around 165 in the end of May. Nice run up throughout the month of June. So far, a little bit more sideways than the initial run up we saw around 183. Now, back down below 178, and this is key because we're below a pivotal area here in terms of this intermediate 1 hour time frame. But let's take another step back. I want to show you where we are on the bigger picture daily, right?
I don't really use TradingView.
Had that same pattern. Top or left side of your
but yeah, I think you're getting a 15-minute delay.
Sideways consolidation, same pattern on the hourly, and now we're looking at a weekly pattern or candles here. So this goes all the way back to April of 2020, Jenny, the move off the pandemic lows. You can see 3 well-defined areas of consolidation. So I mentioned in terms of the intraday time frames, that more intermediate look at price activity, we're a little bit weak here below the pivots, but here you can see on the bigger picture, holding above 160. I think this is key. Lastly, I did want to show you where we are in terms of the 50-day, the 200-day moving average, because the pullback we just looked at, you can see how it just recently tested the 50-day moving average. So the bulls want to see this one hold here, get back up above 183, exhibit some conviction to the upside along the lines of what we had seen to begin the year. Again, kind of losing some of that momentum, but not necessarily rejecting these upper levels as of yet, Jenny.
This is a chart that all in all, you can see that very clear uptrend. Despite some blips, it has still been a relatively consistently strong name. But we will leave it there. Appreciate all the insight, Ben Lichtenstein, the host of Futures. Now I'd like to bring back in Alex. And it's time for...
I do mind.
Today we are
Jonathan.
looking at Take
Don't ever
Two,
ask that
which is
again.
pacing for its best winning streak since 2009, which is pretty incredible here. And now up for the 10th straight session. Slightly though, so I was just watching
Just playing.
here to see if we can still
This is Weeble.
gain to then put it on pace for that
It wasn't updated either,
14 years. I mean, that's pretty
but then I signed up to trade OTC stocks, and then it gave me updated quotes.
Huge move. This at the time.
Banned.
A lot of this was just
Or even insinuating about that question.
And sort of the hype around a
I think most legit brokerages have up-to-date data though on Bed Bath & Beyond price.
Which has been one of the more successful video game franchises.
But yeah, Weeble had it delayed.
One of the things that falls
I just had to
underneath
sign up
Take-Two.
for it. I have a sign up link for it in the description below. Feel free to use it.
You know, the
That's me
earnings,
smiling.
That we saw last month, in the middle of the month, StockX sort of started teetering, giving back some of those gains. But the last 2 weeks, it has fought its way back to the top end of this range, and it is essentially...
All I mentioned was a assume any liability of the assets.
You know, several months, basically
This?
going back
No
to,
assets to
this
which
time
they're...
last year.
You can't hold debt, and the stock and horse agreement said in the PA they wouldn't take any debt.
Report, like you said, is the fact that I do think they have the growth
All right.
to match some of the outsized strength. I
Good thing,
compare them
Jonathan.
most closely to say an EA because right now I think Activision trades.
I heard they
pretty
found
closely
debris.
with the fact that it is potentially going to be bought.
Heard
by
they found
Microsoft,
debris.
That they have their own headwinds and own regulatory concerns right now they're facing. But when looking at EA versus Take-Two, Take-Two's revenue growth has been better consistently, averaging
And then
around
I also
22%
heard
over the last 3 years versus EA's only about 11% growth over the same time period. Now we've also, if you look
Might
at
not
the
have been
last
an
12
accident.
months, Take-Two also fares quite better with 53% revenue growth compared to just 6% revenue growth for EA. A lot of this has to do with their acquisition of Zynga, which has been read as a huge positive by the street.
All right, little head and shoulders
Like you
built
said,
up
they've
there.
also had franchise success. They also have NBA.
Come on
2K.
down.
GTA is to me, GTA is Take-Two. That is sort of what got the street so excited following their quarterly report. Again, we don't even really know a for sure timeline yet. We just know it could be coming in the next several months. So that's more of a
Played Rocket
long-term
League last
story to
night
me,
for the
but
first
it's
time
clearly seen as
since
the
like it came
upside
out.
positive. The company's also benefited though from recent acquisitions, including Playdemic,
It's actually pretty fun.
Smallhead Software, and Glue
You can see
Mobile.
why it
And they are expected to see a lift
got so
from
popular.
the recent release of Star Wars Jedi Survivor, along with several of their sports franchises. So I guess it's wrong for me to only think that GTA is all that matters to them because they have so many other titles up their sleeve. So does a name like EA, so does Activision Blizzard. But when you just look at their performance side by side, you could see why this name is outperforming the overall video game space.
No doubt, and I think when you kind of think about this space, I think undoubtedly there's sort of a big three in console gaming. You have Activision, which of course has Call of Duty, but you talked about the Microsoft acquisition, whether it happens or not right now being probably more of a primary driver, I think fairly, of the stock price performance at the moment. EA sort of has their niche within sports games, of which some of the sports Take-Two dominates. NBA 2K is certainly kind of underneath their realm of things to concentrate on. But what Take-Two has in Grand Theft Auto is a game that I think was last released like when I was in college, Jenny, and still has people playing it. And so whenever you have a game that has that long of kind of a lifespan, it allows for continued opportunity to monetize, especially now with in-game purchases and added content that can be added in and purchased directly on the console. You can see why the street's excited about this next edition. Not only are you going to sell the game, but all the ancillary potential ways to monetize it.
Ancillary.
Maybe
It's a
another
good word.
decade, after it's released. But again,
Not
it
one I
hasn't
use very
even been
often.
released. This is just hope that it's going to be soon.
And to speak to GTA 5, it was released in 2013. It sold 180 million copies totaling about $8 billion thus far, which they do expect to continue on because it's just that successful. So to me, this is like the opposite of gaming fatigue, or like the way we see a new iPhone release every single year. And Alex, we always say, is there really anything changing that much at this point? This is the opposite. This is going to be released sometime in the near future. So it'll be a decade between this GTA 6 and GTA 5, which is amazing. And so I do think they are expecting to see even better sales from this recent installment. So it's just sort of fascinating the way that a game that is 10 years old can still be so popular.
No doubt, and so much has changed in this space, sort of the model of give the game almost for free, or at least part of it.
Edge still spikes my CPU a little bit,
sort of in-game purchasing, and you
but it doesn't lag out at least.
You've seen over the last few years really kind of revolutionized, you know, how I think game developers think about these games, but also ways to actually make money off consumers, not just selling the disc at the GameStop of yesteryear.
Sticking with it, I like this better.
It's going to be fascinating.
That picture-in-picture,
on the forefront of
it's actually really sick.
Other games too, as you mentioned.
Worth it just for that.
Really, really impressive streaks. So say you wanted to trade this name, and you wanted to be, you know, optimistic, and you wanted to potentially benefit
T5
from
is still selling.
either holding on to this level or potentially continued upside move. I looked at a neutral to bullish strategy, basically just looking for this stock to hold on to its recent gains. It's had such an impressive rally. It would be completely normal for a stock to kind of go sideways after a big earnings gap, and that's sort of what we've seen. So looking for more of that, and maybe a continuation even of this now almost 2-week long streak of up days. Looking at selling a put vertical slightly below the market. July 140, 137. That is only $1 below the current share price, but looking for a $1
Bounce
credit
on VWAP.
would create a 2-to-1
Maybe.
risk reward ratio, $200 in risk to make $100. Break even at 139. Jenny Classic elongated Z risk profile here. Just hold on to 140 here. Gives you about 96 cents in cushion here by that July expiration, and this one could potentially make up to $100, not accounting for transaction fees. But I think most importantly, how I think about this type of a trade is in some of the trades that we looked at in the first or the last segment, rather, the chart and trade segment. You needed something to happen. You needed the stock to go higher in some cases. You needed implied volatility to go up. In this case, all you need is for something not to happen. Stock just can't go lower. I know that it always sounds like semantics, but it's truly a difference.
Yeah, and I think that is a fair point, just given the fact that this name is, I mean,
It's on Logitech.
significant upside this year, up 35.5%, up now 3% for the month. I'm surprised we're actually not seeing more strength, considering they are in a 10-session winning streak. But we will leave it there for our FOMO segment today. Now, coming up next, we will look at Micron investing pretty heftily in a new plant in India. Ronita Young will break down that story for us coming up next.
SPY breaking out of this little range. SPY moving up. See if it gives another retest of the high. Home Depot, the entire... No, I haven't seen any of that stuff. These the lawsuits that company's gonna take. It just retest this breakout line here. Old supports become new resistances, even if they're not horizontal. All right, Jay, thanks for stopping by, man. 100-page waiver. 3 times on page 1. Wealthy families, attorneys. We'll figure something out. There's a couple of inconsistencies they can find in that contract. No gaps.
Going to start up not too long after that. The construction will be of a similarly scaled facility in the second half of the decade, actually, so it is a little bit longer than what people may expect. Now, up to $825 million in an investment that covers both of the phases, and it's expected to create 5,000 new Micron jobs. It'll create 15,000 new community jobs, and the company's going to receive half of that money from the government in India and then 20% in incentives. And the second chip maker, this makes this company the second chip maker as of late to diversify into India behind Applied Materials, who's investing $400 million over 4 years for a new engineering center.
You know, Renita, I think that this builds on kind of a greater trend that we've seen even outside of semiconductors, which has been sort of maybe this almost pivot from, you know, growth focus and manufacturing focus being based in China. And now it seems that India has been sort of this natural, almost, I don't want to say plan B, but new target for that focus. I remember about a month ago we were talking about how Apple's done that. So is that sort of your general read here? Is not to say one is, you know, more than the other, but rather that India seems to be this new primary focus for many companies, less so China now going forward?
I agree 100%. And we could have guessed this with the tit-for-tat trade war that's been happening when it comes to chips during this year.
Right, and this isn't the first company we've heard that's now pushing into another market outside of China, and I think that one of the up-and-coming, most developed, and also just largest is naturally that found in India. So interesting move by Micron. We'll have to see, of course, how tensions then in China end up playing out, as I'm sure negotiations are still up in the air between these massive companies. But we will leave it there. Appreciate all the insight. Renita Young, Senior Markets Correspondent for the network. Now coming up next, it's time for Under 30. We are looking at Ford that is getting some government benefit for its EVs. George Tills will break that down for us coming up next. Catalidis.
No, I've not seen the lira. Uh-oh, is Edge starting to lag? I think if I change this account to a cash account, I'll be able to trade options more often, right? Oh yeah, dude. Dang it, I'm getting some lag on here too. Because a cash account you can trade with, you just trade with settled funds, and options it takes 1 day for them to settle. So you basically have, if you use your whole account, you have 1 day on, 1 day off. Use half your account, you could theoretically trade every day. I think. It's been a long time, so I've had to think about this stuff.
Saying the Fed strongly supports more hikes to come. And here's a look at the dollar, 102. That's gaining some. Gold, 1926 a troy ounce. Crude oil pulls back after a pretty big run up. Right now it's down 4.5% at 69.18. And the volatility index sits at 16. And Bitcoin back above 30,000. Incredible week for Bitcoin, no doubt, right now. So this week gaining 14.5%.
I might be wanting to break out here.
In the markets, we welcome in Kevin Hinks, host of Fast Market and Senior Manager at Trading Education at TD Ameritrade. Kevin Hinks, good to see you. So we've had a lot to digest. I mean, jobless claims still, as we get those in and we look at those levels, I mean, what does it mean to you? Because
Broke out to the downside of the wedge. Retrace all the way back to the top.
But it's low historically.
Yeah, still historically at moderate to low levels, coming off many months, 24, 36 months, Nicole. That are some layoffs, people filing for the first time. That number that was in the low 200s, now the 4-week average with today's 264,000, the 4-week average up over now 255,000. Much more indicative of a normal labor market, Nicole. We've had a really strong labor market for the last really couple of years, actually. So a little bit of normalization. It seems higher than normal, but only if you look back a couple of years. This is actually a pretty historically still moderate number in terms of jobless claims, Nicole. So yes, the trend lately is higher, but still nothing to be completely worried about. Still a very strong labor market.
Right, and that's the whole point. Right now, still a very tight labor market, and that's why the Fed feels comfortable to talk about moving rates
Oh, I thought that was a burn mark on my CPU.
concern about inflation.
That's a normal hole that's supposed to be on there. Like a little hole in the top of mine. I thought it melted through.
Then a little bit of a drop. What's going on?
Weird.
Yeah, iRobot trying to be acquired by Amazon. As you know, they are the robotic, vacuum cleaner basically for the home. Nicole, they're having problems with the European, basically competition agency, they call it. The UK reluctantly gave them a thumbs up on it, but this is a pretty incredible, and now they're talking about the FTC is probably going to get involved and fight this. Nicole, I can't think for the life of me why a robotic machine like this, basically a vacuum cleaner, is coming under such scrutiny, especially they're incredibly, there's a lot of competition in this market, but the FTC thinks that it'll hurt competition. Amazon wants to add to their smart device category. This is very interesting. It's going to go to the courts. They're going to fight over it, but iRobot down about 8.5%. Amazon, on the other hand, is actually rallying today based on a couple upgrades. And by the way, yesterday, the news on Amazon was the FTC was basically telling them, filed a suit against them because it's too easy to sign up for Prime and it's too difficult to get out. Nicole, I think I just described the entire internet.
Yeah, well, that's exactly right. So basically, they're saying they're alleging the company basically duped people into signing up for Amazon Prime and not, giving them the ability to get out so easily, coupled with the fact that the FTC it's continuing an investigation. This thing about how you click and accidentally end up on Prime and as a Prime member and can't get out is one issue. But that is only the beginning of what the FTC is doing to Amazon. So I think that we're going to hear a lot more. I mean, this $1.7 billion deal for the Roomba, I probably wouldn't even know how to work it. Anything with robots, probably not my forte. But this is the thing. And they said, this is the last part that I just read here, that they'll be able to gather more personal data on people. That's what it's about, right?
Like what? If you have a dog or a cat? I don't know what they're trying to. I don't know what they're worried about.
I don't know. And I do have a dog.
Interesting.
Kevin.
Fascinating.
I have a dog. I have a great dog. All right. Thank you so much. Good to see you.
Yep.
All right, let's get the bigger picture here. Eddie Gabor is with us right now to take a look at what's going on with this market. Key Advisors Wealth Management. Eddie, good to see you. Thank you for being here. So what are you thinking here? How are you feeling about the big picture? Because we've had an incredible run-up. It looks like we're going to snap the recent weekly winning streak that we're seeing for the major indices. What do you think?
Look, from a technical perspective, it's been amazing to see this rally that we've seen since March when the banks failed and the government came in and bailed out all the depositors. It's been an incredible run led by technology, of course. The overall macro picture, in our opinion, from an economic standpoint, continues to deteriorate. But again, you have to respect this move in the market. I think right now we're probably overbought in this market. We are expecting what we've been telling our clients, a buyable dip this summer. So the last 5 weeks, we've been raising cash from some of our defensive positions in preparation for these buys. And I think the headwind in July that will give us that opportunity to buy some dips is going to be earnings. Look, at the end of the day, we can say AI all we want, but these companies are going to have to deliver on earnings, and we're going to have to see what guidance is, because if they don't deliver on earnings, that's going to provide some volatility in the marketplace. And then, of course, lastly, this Fed is probably not done. I mean, look what is happening overseas with these surprise rate hikes because inflation is staying sticky. Chairman Powell said yesterday that two more rate hikes were in the cards. So we are not nearly out of the woods yet from a bear market, in our opinion, but we do respect this rally that we have seen here in the last couple of months.
So if there's a dip, and you were to say, I'm going to buy a dip, right? That sounds interesting to you. What would you do?
So if there was a dip that we felt was viable here this summer, we're going to look at healthcare. We think there's some good opportunities there. There's some areas in retail, too, that have gotten really beaten up that we would take a look at. Defense and aerospace as well. That's another area that we're going to be looking to add positions to. And as we look globally and internationally right now, we think India is going to be an interesting play because I think you're going to see more and more firms or companies like Apple take some manufacturing away from China and go into India. So the upside there from a diversification international perspective, we think is very attractive. So those are the areas that we're targeting. And then lastly, is energy as well, too. And look, if you look at all these areas, they really haven't participated in this rally year to date. So if this truly is the start of a bull market, this rally is going to have to broaden out, and these areas will benefit. We don't think this is the start of a bull market. This would just be something we're buying the dip on that would still do well, in our opinion, if we get a material slowdown in the back half of this year.
Look, I mean, are you thinking that, what about some of the names that have already had incredible momentum? You're not going to say ride those names like tech or communication services or even consumer discretionary. There are some areas and names that have done well. So you're not saying keep on the winners.
So we're not going to get FOMO here at these levels, right? I want to see what the earnings are for these areas, right? Because these earnings are going to have to accelerate and guidance is going to have to be strong. So I think you'll get opportunities in those areas you just mentioned. I just don't think right now for our client base that this is the proper entry point because, again, I think expectations have gotten a little bit over their skis. And I want to see the proof in the pudding.
Looks like it's getting rejected up there.
Revenues and how they deliver, and more importantly, their guidance in the back half of the year. Again, one thing that I think is undeniable is the economy is slowing. Like jobless claims are going up, credit is tightening. These same problems that we worried about 3 months ago when these banks failed, they're still here. So it hasn't gone away just because the government gave us a bailout. So we need more data showing that we're on solid footing before we go into some high beta names at these current levels.
All right, so at this point now, when you talk to the clients, are they generally very concerned or not so much? Because there could be a recession looming, but maybe it won't be as bad as people could expect.
Look, the majority of our clients are very concerned about the economic backdrop that we have ahead of us. And they agree with our thesis that we believe that there's a high probability that we will have a recession. Frankly, the recession is going to come later than what we had originally anticipated. But at the end of the day, we are seeing recessions around the globe happen, and we are a global economy. So in our opinion, this slowdown, if it continues to accelerate, then we could potentially see a recession sometime fourth quarter, first quarter next year. And again, if it does get pushed off that late, there's still going to be opportunities in the market before we get in there, because the market has not priced in a recession. So if we do have a recession, I think you're going to see some really big buying opportunities. So we're still going to have money market as a big core position for our clients. Right. They agree with our positioning. They agree with our thesis. And they're seasoned veterans. They've been investing for a long time, so they know what they see.
So at this point, right, money market could be core. You talked about some of these areas that you do like, not really chasing tech. What about international?
Yeah, so in the international space, again, we are targeting India. I think India is an interesting play. Look, the Japanese stock market has done very, very well so far year to date. Again, we don't want to chase that at these current levels. But the setup in India, again, when you take a look at some of these tech companies potentially moving manufacturing there, there is some nice upside. So from an international perspective, we want to be more concentrated in areas that are not in a recession. And then later on, when we see what happens with Europe and how deep their recession goes later on, maybe next year, there'll be some opportunities there. But they have quite a bit of headwinds ahead of them right now economically.
Right, understood. Eddie Gabor, Key Advisors Wealth Management. Thank you always, Eddie. Good
Thank you for having me.
All right, later this hour, we'll take a look at some new offerings from CoinDesk Indices aimed at making crypto sector exposure available for direct investing. You'll want to hear more about that. We'll also take a look at the importance of personal branding and lessons to be had from names like Elon Musk and Sir Richard Branson. And our panel looks at the labor market, what new data says about the chances of a soft landing. And up next, Charles Schwab's Jeffrey Kleintop. He will weigh in on the rate hikes that we are seeing across the world, not necessarily here at home. We'll be looking at commodities, treasuries, what it all means to us, coming up.
Zambia reaches deal to restructure $6.3 billion in loans from China. Biden says his comment on Xi being a dictator did not undermine or complicate relationship with China. Biden says, I don't think it had any real consequence. Ford has received a $9.2 billion government loan for EV battery factory projects. Wow.
50. Norway, 50 basis points. Swiss National Bank, that was at 25 basis points. What does this tell you? What's your takeaway from these hikes that are happening?
Well,
SPY rejecting
the
that
cycle's
breakout.
not over yet. Maybe as we move through the summer, we'll see the end of this rate hike cycle. But, we got a few surprises today, but overall, the market wasn't shocked. If you look at the currencies of Switzerland, of the Bank of, the UK, of Norway, they didn't really move that much today, despite some of them surprising with 50 basis point moves rather than 25. In fact, the Bank of England last went 25 at their last meeting. Now, jacking that up to 50 basis points. But I think one of the reasons is that the market just recognizes they're probably not done. The market has priced in another 100 basis points on top of that move today for the Bank of England by year end on that very shock inflation reading yesterday. So this hawkish hike from the BOE does raise risks that they may take rates too high. The UK is teetering on the edge of a recession. We know the Eurozone is already in a recession in Q4 and Q1. So it's notable that these central banks are still sticking with these rate hikes despite some of the lackluster economic data. And I note that tomorrow we get the preliminary purchasing managers index, my favorite economic statistic of the month. That's going to tell us what happened in June. And what I think is going to happen, Nicole, is we're going to see this weakness in manufacturing linger and maybe start to spread into services. Expect those services numbers in Germany, in France, in the U.S. and others to come down a little bit, maybe on signs of some weakening in what's really been the more resilient part of the global economy.
As you talk about that, you made me think of leading economic indicators. That's been negative, right, for 14 months. If you count the 1 month that was zero, it's 15 months of no growth, nothing good. What does that mean to you, and what does that mean to the Fed, if any?
Yeah, in fact, we've never seen a decline like this. I was just doing an event with Liz Ann Saunders yesterday. She talked about how, we're seeing these levels here in the U.S. of leading indicators really in line with all past recessions. We've never seen this kind of a dip and not been in a recession. I can say on a global basis, the OECD's leading indicator for the G20 countries is in a similar position. We've never been this far below that threshold of 99 that I would call the threshold between recession and growth and not been in a recession. And we're seeing it in economically sensitive areas like commodities. They are teetering on the brink of a fifth consecutive quarterly loss. You can see that here I shaded it as orange because we're not quite there at the end of the quarter yet. But if they're there, that would be the longest streak this century. We had another 5-quarter streak back in the middle of the 2010s. But look, it's been a long time since we've seen this kind of weakness. And that may or may not continue for another quarter, but it really does speak to the weakness we've seen so far in economically sensitive areas of the market, including, of course, commodity demand.
Yeah, so that really jumped out. You said, if we see this, it would match the worst streak this century. That sounds terrible. And what are you looking at specifically right? Because I saw the orange candle on the end there. But what does that really mean? I mean, what commodities are we talking about? What's your interpretation as an expert on this and looking historically? Obviously we're in a new century, but tell me more.
Well, this is an index. This is the All Commodities Index from the Commodity Research Bureau. So this is literally everything from energy to metals to agriculture to cotton to oil to everything's in this thing. So it really is a very broad look at the commodity markets, which I think is important because we know that demand for commodities feeds up into everything we do and produce. And so whether it's on the services side or the manufacturing side. So it really is a helpful economic indicator. The fact that we've seen this lingering weakness 5 quarters now speaks to certainly the weakness we've seen in China over the course of the last year and a half, but also speaks to more broader economic weakness as well. We've only seen more than 5 quarters of back-to-back declines way back in 82 at the end of that double dip recession in the early 80s. We saw it in 1999 as well on that emerging markets crisis when much of the world was tumbling through a very difficult Asian contagion, we called it at that time. So it's pretty rare, but we may not be set up for another one in Q3, although it may not have much to do with economic growth. We've got this summer's El Nino. possibly disrupting
Over stock
production
still
of
escalating.
agriculture, maybe some energy as well. Maybe we get to the end of the rate hikes. Maybe China's leadership actually cuts rates and adds some more stimulus. Those Saudi oil production cuts kick in next month, and Europe might be emerging from a recession. It's still early to say. So there are signs that maybe we don't get a sixth straight quarter, but certainly it does speak to how weak the global economic backdrop is after,
almost
after
looks
all this
bullish.
debate about whether we're in a recession or not.
Like it might be
And
flagging
your
up
advice to
here.
investors, I know Japan's on your mind.
I don't know. Maybe not.
If I say Japan, people are interested. If I say Warren
So it did hold good
Buffett,
support
they
here,
might
the
even
support
be
line.
more interested. And there's a correlation there. Tell us a little bit about your advice to investors and why you're watching Japan in particular.
Yeah, that's for sure. I often don't get a lot of questions about Japan, but I do get a lot of questions about what's Warren Buffett buying these days. Well, after 10 weeks in a row of gains, the rise in Japanese stocks has really narrowed the gap between the peak level that the Nikkei 225 hit back in December of 1989. Still hasn't recovered that peak, but it's just about 13% away. That's half of the gains we've seen this year. It's up about 28% this year. Japan's got a lot going for it. There's a regulatory push meant to encourage putting idle cash to work, buying share repurchases and other measures to improve shareholder returns. That's being mandated by the Tokyo Stock Exchange. That's helped lift stocks back towards their all-time highs. Second, Japan's GDP is actually growing faster than the U.S. and other G7 nations this year. And third, Japan may benefit from this de-risking of supply chains in Asia. Japan just hosted the G7 as a very friendly investment destination as leaders around the world are looking to diversify away from China. And yes, finally, foreign investors are increasingly seeking exposure to Japan, with Warren Buffett among them. But you know what, Nicole, despite all these gains, Japanese stocks are still inexpensive. They traded a PE ratio of 14 times on forward earnings. That's below the 20-year average compared to an above average 19 for the U.S.'s S&P 500.
Yeah, and that's if you're getting something sort of regular, that would be under 20. Anything that's sort of hot would be 40, 50, 60, and higher. Good to see you, Jeffrey Kleintop. Thank you so much, always. Charles Schwab, thank you. Coming up next, we're going to take a closer look at CoinDesk indices. So the new partnership there, they have this new partnership that's aimed at making
A choppy day on SPY. Yeah, barbecue sticking with 100,000 shares available on iBorrow. And in that 60% borrow fee. Last time borrow fee was this high. January 9. Look at that. Here. Oh snap. I don't want to buy it just based on the borrow fee, but if I were, it's looking good. See right here. Kind of hard to tell because the gaps. So this line's the close price, the price of barbecue. And this line's this orange line's the fee. Where did that just happen? There. Oh, lost it. My borrow desk breaking. Anyways, here's the fee. You can see it start to rise from 13% the 5th. That was a weekend, maybe 5th. Why is a gap there? Oh, there was no shares. That's what it was. From the 5th to the 9th, there were no shares, and the shares came back and went from 15%. They came back available. It was at 42%. Similar to how we've had that now. We had a couple days where there weren't shares available. Now it's at 64%. And the shares came back available on the 9th. See, the fee kept going up all the way up to 400%. February 9th. So January 9th. It looks like it's going to break out here. Here's January 9th in the chart. Yeah, there goes SPY. Dang it. Okay. Contracts are worthless anyways at this point. So here's January 9th. Up to February 9th. That borrow fee kept increasing. It stayed high all through here. All the way to here. The peak was right here. Yeah, we could be in store for a bit of a run. This is any indicator. But not sure how this will work on OTC. It should still be the same as far as borrow fee. That was a 365% move. As far as like a cycle though, specifically, I feel like they're kind of out of the cycle. With that daily candle on barbecue too, that is sick. The 363% puts it at $1. Quite. Somewhere around 90 cents. Buy on a tear, sort of. Not really. We'll see if this is just a little false breakout or if we actually continue up. If so, I think we've got room up to 437. On 237, hour and a half. About to moon. The borrow fee increasing is a good sign. I don't think moon unless there's news. But maybe a rally. Daily candles, super good looking. Just showing how strong that support is. Huge hammer. Ending green too would be sick. I closed because this head and shoulders also. So I was looking for any reason at this resistance spot to close. Then we got that failed bull flag. But now, you know, we'll see. We'll see. The head and shoulders is still there, so we really need to break through that for that to have failed. But a double bottom here is a good sign.
And then almost a double whammy with the investigation to Coinbase over listing of
And
unregistered
that just daily candle is sick.
What we've seen is really at a markets level view, we've seen a bifurcation of Bitcoin and Ethereum, and then the alternative tokens, the altcoins, everything else.
Overstock, escalator, 21%.
Relative certainty of being listed as commodities.
You may get a pump with this.
Whereas everything else is starting to be deemed an unregistered security. So with
Tesla's up 1.5.
there's there's a common metric that
I think we're building a handle here.
for the market of Bitcoin dominance. Of what percentage
This
of
inverse
the
cup.
total market cap of the
So I think we'll move up to this other
it's up to 50%.
shoulder.
And those are
437
levels
is
we haven't seen for the last 2 years. That
plausible.
plus Ethereum, you've got 70% of the market.
Potentially a gap fill.
Tokens take off relative
Not sure
to
if
the
that
rest
would
of
still
the
be considered a
market
handle.
because there's more certainty.
Could be, yeah.
So you have that's still a bit of that headwind with all the other tokens in these sectors. And then we've also seen the recent launch of EDX, which is an institutional-only platform. And actually, it follows very much the traditional exchange model, where you have separate custody from the exchange. A lot of these crypto exchanges have bundled them together. And that's generally been to the detriment of traders on those exchanges, such as FTX, where you have the commingling of funds and the bundling of those two functions.
Yeah, and I think that also brought some optimism to the market.
Absolutely.
In addition to the BlackRock story. That was the other story. I had it in my mind.
Yeah.
I lost it, and that is exactly what I was thinking of.
Not only towards, it's one step towards what is more familiar with institutional investors, but it also brings the names of Charles Schwab, of Fidelity, and Citadel.
Big rejection there, or what?
To the crypto market. Right. So it is continuing to show that there is institutional demand and interest in
Yeah,
the
might
space,
be building the head and shoulders
that's
too.
expressed through the EDX launch.
So this
We're just coming back down to test for support. We'll see.
This is a milestone for your companies, for both companies at this point. And does it make it easier for of our show, we're taking a look at the importance of personal branding and lessons to be learned from some of the big guys like Elon Musk, Sir Richard Branson. As we head to break, we'll explain. We'll be right back.
Whether you're an experienced investor or just getting started,
Sorry, that was me. I'm getting Okay.
Nicole, here you can see on the charts here, well off the 72 high that we saw yesterday, briefly down below 69. Here you can see we're back above that level to 69.50. The dark shaded area, the day session trade from today, and this is a 5-minute candle, some of the selling. Again, that actually started out in the overnight session amidst some of those demand concerns, rate hikes, as I mentioned, from Norway, Swiss National Bank, and then the BOE a little bit later on this morning sent crude lower. Just checking on where it is relative to the 50-day moving average. Crude, the WTI, has been holding below it for quite some time now. This helps in terms of those inflationary fears, concerns. But one thing I did notice, kind of tying the two conversations together, I've got the ES right here and the candles, the yellow and green candles. This blue purplish line is crude oil. Look at the divergence. Normally these two products track each other very closely, but you can see basically since the beginning of the year, since March, it's been a lot more well-defined. Indices rallying, crude holding these lower levels. This is going to resolve one way or the other. Either crude's going to start to work its way higher amidst some more demand expectations, or we're going to see the indices roll over at some point. I think it's more a matter of when, not if here, Nicole.
All right. Thank you so much, Ben Lichtenstein. Great
Lichtenstein.
to see you. Appreciate it. All right. Now, the cool topic. Joining me now to talk about the power of brand equity is Tyler Mounts, CEO of Henry Street Creative. Good to see you.
Thank you for having me, Nicole.
Off camera, we were having the first conversation of what I saw in the New York Post was the proposal by Elon Musk to have a cage battle with Mark Zuckerberg. I mean, we can get into the details of who would win, but more importantly, Elon Musk and these guys become the headline of the day. Is that the idea?
Absolutely, Nicole. I think regardless of who we think would win in this alleged cage fight, I think the biggest thing to remember is this is
Musk would
branding 101.
work
This
that
is the
kid.
gold standard of branding. Who are we talking about?
If he has any
These
experience with
figureheads
fighting,
and the organizations that they lead.
his weight would be huge advantage.
Brand equity. There's a lot of value in building your brand. Give us some examples. Explain to us what you watch as a pro in this field.
Yeah, absolutely. I think more and more today, consumers are less concerned about the
Dish now
actual
green
product
1.5.
and the use case, and actually more interested specifically in the figureheads,
Bigs
the
down
executives,
half.
the leaders who are actually empowering people to make these decisions, right? So I would say if you even take Elon Musk as a perfect example here,
right?
He, as the leader of Twitter, regardless of his political ideology, we're not here to debate that, I think the biggest takeaway is quite simple. The way that Elon Musk thinks, the way he sets up his values and his moral compass directly impacts what's happening at Twitter.
And so at this point now, I mean, who would be other names? It's not just the names of the folks, it's also companies too, right?
Absolutely.
I mean, what would be some good examples of the power of brand equity?
Absolutely. So no longer CEO, but the John Ledgers of the world, specifically who was redefining, I would argue, telecommunications with his stint at T-Mobile.
T-Mobile and all the pink, I remember
Absolutely.
it. I've met him, he's been here.
Absolutely, right? It was less about the product and more about the figurehead who was leading the product. That is the masterclass in brand equity.
So that is the whole thing. So it's not necessarily the brand, it's about the visionary that goes with it. I mean, people would argue that Nike or Apple or Lulu, you don't necessarily need a leader. I mean, they're just great brands.
Correct. Well, I hear you, right? Apple is a legacy brand. Lulu is certainly a newer brand, but certainly established in the fashion world. What I would say here is, though, getting a new CEO could have detrimental or wildly positive impacts to any legacy organization.
Right, I see. So it depends on who's leading this. So what is this social first strategy?
Yeah, so by social first, especially with the, the coming to light of the Gary V's of the world and VaynerMedia, right? He is really dedicated to branded content and social first content. Coming from my experience overseeing portions of digital strategy at NBC Universal, we started to see this, a pivot away from traditional linear advertisement and on to digital advertisement, really being funded and created by independent creators. That's what consumers are craving right now.
So, I mean, there must be risks involved, right? Because we're getting bombarded with stuff in social media, on our Instagrams, on our emails, everywhere that you are, you're getting bombarded. I mean, what should we be also wary of?
Yeah, absolutely. There's always inherent risk with social media. With the advent of the terminology of fake news, it's really hard to distinguish what is accurate, what is not, what is misleading advertisement. And first and foremost, it goes back to that first principle we discussed. Do we trust the brand? Do we trust the people in charge of hiring these people, coming up with the campaigns? From there, it's up to us as consumers to do our best to achieve due diligence. So that
Barbecue
we have
getting a red candle there.
Is this true? Is it not?
Yeah, understood. And I personally know someone who ran a great business, but then had like a cyber bully sort of ruin her reputation and her business. It's sort of, what's fake, what's not. I mean, that's problematic. So you want to have a social media presence, but at the same time, you put yourself out there for slander and lies.
Absolutely. It's inevitable. But if you think about the traditional news cycle, that's also true. Nike doesn't have to be on social to still be slandered by a potential cyber bully.
Right, understood. I mean, what do you think about some of these? I don't mean to throw you a hard question. You can, get away from it. But like Bud Light and Target and, Bud Light lost 25% of sales.
They sure did.
I saw something today that they should have stood their ground and Target shouldn't have moved the t-shirts to the back.
Yeah.
These are very difficult times, too, to navigate. I mean, I don't know, if you're a visionary, how do you get most of the people on board, I guess? Is that the goal? Because you're not going to get everybody on board.
Correct. Once you accept the fact that no matter what you do, whether you're Bud Light or Target or a brand in between, if you draw any hard line in the sand, whether it's for conservatives or the liberal community, what's important to remember here is you're making a stake in the ground, right? A lot of these organizations are making decisions that are prolific to the organization and could have catastrophic effects.
Right.
I would say, when we're talking about LGBT inclusivity, when we're talking about any type of polarizing social issue, the organization has to, stand to their ground, but it's important to realize the potential fallout of any of those opportunities.
Yeah, I mean, in the top 10, you just think of the people who are leaders in their brands and way people follow. People want to invest like Buffett. As soon
100%.
as the Berkshire Hathaway note comes out or people see what Berkshire Hathaway's buying, they try and buy Coca-Cola and Apple or whatever else he's been in. You mentioned Sir Richard Branson. Is he still Sir Richard Branson?
I assume he didn't lose the Sir.
So I'm going to go with that. Try and keep his title correct. So, I mean, why did you mention him?
Well, if you think about Sir Richard Branson, he is one of the original entrepreneur and thought leaders, right? He revolutionized what we think of first, obviously, cellular communication, and then now he's really reinventing the travel industry. And it all comes under the guise of his eccentric, over-the-top, outgoing personality, which trickles down into his organization.
I mean, I'm trying to think of other people. I got to wrap it here, but like if you were
Barbecue,
fire off, I just
back up,
Serena Williams.
1894.
Isn't that a goodie?
100%.
Just fire off a couple.
Yeah, absolutely. So Serena Williams is a good example. Her sister, 11 by Venus, is a fantastic example as well. well. If I'm thinking about real estate, the Ryan Serhants of the world, who are coming in and disrupting the Corcorans, the Douglas Ellimans of the world, I think they're really focused on personal brand and the equity that comes along with.
All right, so, I guess this will bring in the bucks.
Hopefully.
If people like what you're bringing to the table as a person, not just the brand, not just what you're selling. It's great to see you, Tyler.
Great to see you.
Thank you for that. Appreciate it. Tyler Mount, Henry Street Creative. Still ahead, we'll bring our panel in to talk about the labor market, the key takeaways from today's jobless claims, and what we need to watch going forward. Come right.
Root kind of selling off a little bit, up 26% now. Overstock just escalator. 10 minutes to power hour. See what we got. If we get a push up to this resistance, it's 437. With a gap fill, 437.18. Yon's up 4%.
actually think it is more recessionary than simply softening because the key level, according to our new study, which will be published next Monday, is 250K for the 3-month moving average. Of course, that strips away the weekly noise. And with this new data today, we are only just a hair away from that key level. Now, we think it's more likely than not that the trend will remain at or above 350K moving forward, which means new claims will be consistently 25% above the most recent low in November 2022 at around 200,000. And historically speaking, ever since the first jobless claim data was collected in the 60, whenever we reach that 25% threshold, the economy has been either months into a recession or fast approaching one. Of course, we need to see more of that trend to be more certain, but again, the signs from jobless claim data are quite clear in our opinion.
Here we go, Spy.
There was talk of a labor shortage for a while. People couldn't find the help they needed, and the idea here is that there may be a labor glut going forward. Continuing claims came down.
Double top or new high of the day?
Higher. Stephen, what's your reaction to what some of these statistics and maybe what Tuan's saying?
Well,
On that
I
trend
think
up.
the reality of the situation is the economy needs a recession. You've got 525 basis points. They're potentially going to go another 50 basis points. And to be honest with you, no one really knows the upper end of the short-term interest rate environment, primarily because nobody really funds at the front end of the curve. Most of the funding takes place in the belly of the curve where securitization happens. And when you look at the inversion between twos, for example, and tens versus the inversion between twos and fives, the real problem is the inversion between twos and fives. Twos and fives have not taken on, that inversion has not really taken on the idea that rates will stay higher for longer. They're continuing to anticipate what the dots tell them, which is 100 basis points worth of cuts. And the reality of the situation is don't see anywhere in evidence whatsoever that we're going to be in that kind of position. So we think until you get the 5-year to move up appreciably in yield and choke off the cost or raise the cost significantly for securitization, you're going to continue to have the consumer that surprises to the upside and keeps the economy from dipping into a recession. When you're in that 250 to 300 band, we know we have a slower economy. You get above that 300 band and you're really talking about a recession. And there are people who would look at the claims levels relative to the growth in the entire population and say the trigger level on claims is not lower at 250 than it has historically been. It's actually higher, closer to 300,000. So there's a big debate going on between people in terms of trying to interpret what claims mean for the economy. The traditional rule of thumb is you're in that 250 to 3
Or new high of the day on
and
Spy.
it's worked over repeated cycles. You've got a slowing in the economy. You get above 300,000, you're probably in a recession.
Thank you both so much, Stephen Rasciuto of Mizuho and Tuan Nguyen of RSM. Thank you. That's going to do it for me here on the Watch List. Thanks for being with me every day at 11 a.m. and 2 p.m. I'm Nicole Petalides. Keep it right here. Oliver Rennick, Market on Close, next.
Hi, rip rip. Few minutes to power hour. Dish is now 2%. Overstock 21%. Barbecue came down a little bit. 1936, down 5.5. Still above VWAP. Power hour.
An hour left in the day. Stocks right now are mixed. NASDAQ, though, has been carrying equities higher. And S&P now about 30 pips. Dow goes positive. Russell is down, going from a negative morning to a positive afternoon. Pretty good stuff here when you look at were some nerves out of the gate this morning. Amazon, the hero this afternoon. We'll talk some more about that. What's going on there, the bullish note that seems to be driving that action. For the first time, I think, since I stood on Lower Wacker Drive in the spring of 2020 when it became clear that COVID was going to really shock people. I remember I was standing outside the steakhouse right across from where I lived, and it was packed. It was packed in February 2020, and it was right after the stock market took that big leg down. And it was pretty clear that equities were gearing up for something huge that the general populace hadn't been ready for and wasn't prepared for at that point. It feels like the past couple weeks here in markets are the most normal things have been since I would say that week. Prior to that, it was a risk that was building, but people didn't really know how COVID was going to play out. And then everything changed, of course. 2021, the recovery year, 2022, and since, even those post-COVID years have been marked by bizarre economic circumstances. And we haven't been able to really figure out what to make of it, and volatility has reflected that. How hard do we hike interest rates? How big of a problem is inflation going to be? What are the lasting ramifications for industries that have undergone some extreme booms and busts? That was the story of the post-COVID world, and it really feels like things here have normalized in the last couple of weeks. Volatility does speak volumes, and VIX finding its way lower. Again today, right now, it's sub 13. VIX started out higher in the morning. It came down. Stocks firming up throughout the session. Market cap leaders doing the work basically according to math. It's hard to pull the market down when we have strength in companies like Amazon. This feels like the most pre-COVID week we've had since COVID. That's what I'm saying. And I don't say that lightly because last year also was very unique and problematic in its own way with runaway inflation. So now basically it seems the market's only real risk that is obvious. There's always, of course, the unknown and the shock, black swan type of stuff that you can't prepare for. But the clear risk right now, in my mind, the really only one we've narrowed things down to, is that inflation reroutes. And the Fed has to shock by then doing an about face and hiking even harder at the end of the year. But the risk of a big, deep collapse in the economy based on what's happened here over the last 6 months just doesn't seem like the base case that we should be operating from. That did seem a lot more likely 6 months ago. We've had our scares for sure. Regional banks, of course, were one of them. But since then, we've seen credit spreads continue to show very innocuous readings about corporate credit. We have seen financial conditions loosen. Economic data has been beating expectations. Look at this morning. It's a perfect example. Your jobless claims are quite a bit higher than they were a couple months ago. There is softening in the economy, no question about it. Maybe it continues to soften, but at least not spiral lower. You've got a higher 10-year yield and a firm dollar today. These are generally good things, especially when you have stocks up with it. If you followed along with my coverage over the past week, most of this adds up to what I've expected post-Powell. I'm a little surprised at how strong the dollar is based on the aggression from the Bank of England and other central banks, but yields firming makes perfect sense to me because Jerome Powell has now given the economy a chance to catch itself, stabilize, maybe firm up. And that's really why the only risk that I can think of right now is that inflation will reroute because the economy is so strong. But that's not exactly a problem until it's obvious it's a problem. And I think that's why we watch bonds. The 10-year yield is indeed rising again, but stocks have seen it at this level before, and they're able to take it in stride. If you get the dollar to catch back up to where the 10-year yield is, and the 10-year starts breaking out through 4%, then maybe the Fed has put us in a quandary by being too soft in the economy and allowing inflation to flare back up. But until that becomes obvious, this market has clearly established a buy-the-dip routine that we just haven't seen as this reliable in at least, 3.5 years now, plus. So that's my little speech here today. Because yesterday it looked like things maybe would slow down in the AI trade and that maybe we would see a steep rollover in the market, but investors right now are confident and they're buying the dip, and there's pretty good logic for it. Now watch for other signs that maybe the Fed will have to come back around, and we'll find out that we still are under the control of inflation. You see that a little bit in the regional banks too. When the 10-year yield goes higher and you have economic data this morning that is in line with expectations and not worsening, the market does start to process the odds maybe going a little bit higher of an acceleration in the economy and an acceleration in inflation. Regional banks don't like that. So I do think we need to keep close tabs on that. But Amazon's up almost 4% today because of all the big mega cap tech companies. It really has still been stuck in a downtrend. It hasn't had the same breakout as its peers. There's a big analyst now with a big bullish note, so let's start there. By the way, keep an eye on AMD, because if the AI trade does fade, it looks like that's the weak spot. Yeah, that chart's not great for AMD, but again, settling into earlier support at the bottom of that gap. So if AMD can hold on here, then chart looking okay, but it has shown up in the last couple sessions here as a weak spot of the AI trade. I got Renita Young, Kevin Hanks here with me. Let's talk about that Amazon note here some more, Renita, because it feels like it's really doing a lot of legwork for this market. It was the only one positive this morning, and it's been out there in front while a lot of the other tech trades caught up.
Right. In fact, it is one of the top performers in the S&P 500 today. So you're absolutely right when you say it's doing a lot of the work. But right now it's up on an upgrade, or rather a price target hike. And it is now being up on Loop Capital, which boosted the price target on Amazon to from $140 a share to $180 a share. That's about a 40% move to the upside from where it's been trading today. And the firm kept a buy rating on this stock. It has outperformed the S&P 500 so far this year. It's up year to date around 53%. And this analyst obviously feels like it's got more room to the upside. Now, one thing that this analyst noted was the revenue deceleration that's been happening in Amazon Web Services. That's undeniable, right? But the analyst says that this will bottom out in the next 2 quarters and make way for that to gain a lot more success afterward. And also, the way Amazon's been preparing for generative AI, this analyst says that's going to accelerate the recovery for Amazon, and the timing of that to end that AWS revenue deceleration is going to actually be the next driver of the stock. That's what the analyst said. But the recovering costs per unit in retail, this analyst says, is a bigger driver of earnings power. Now, meanwhile, we did see some more news with Amazon with its acquisition of iRobot. While Amazon did clear a hurdle in the UK last week to be able to do this, and the British Competition Authority gave Amazon an all clear to go ahead, broader in the EU, not so much of a smooth situation. It's because it's now launching an investigation into this $1.7 billion deal, and the deal was initially announced in August 2022. If it's successful, it'll extend Amazon's lineup of smart products. We now have the Ring doorbell, it's got the Alexa assistant, and it's got those smart thermometers. So it's hoping to be able to add to that. but it's facing a blockage in the form of the EU antitrust investigation right now. And then it also has other possible regulatory hurdles that it would have to get over to go through the whole process anyway.
It seemed like just yesterday, Amazon shrugging off the latest inquiry from the government and allegation, if you will, already reflected a pretty calm, stable stock. And then today, the way it responds to this analyst note, a little pent-up energy here, I guess, showing up in Amazon. Kevin Hanks, what do you think? Another day where things start off a little soft and we get leadership from the mega caps to carry us through. I mean, is this the good times again?
Yeah, it's the Magnificent Seven to the rescue today, Oliver. Look at the NASDAQ dominating the price activity, and even though NVIDIA is lagging, it's still up ever so slightly. It was down. Meta was down earlier today. Now it's up. So all seven participating on the upside here, leading the NASDAQ. And if you look at a landscape of the NASDAQ 100, it is dominated by those seven names that we mentioned. Microsoft, NVIDIA, Apple, Google, Alphabet, Meta, Amazon, and Tesla. They're all up. Tesla, Morgan Stanley downgrades it. No one cares. Stock going higher after a couple days on the soft side. You mentioned an interesting thing about AMD, though. AMD, kind of on the outside looking in, they are scrambling to get into the AI game. You know, NVIDIA currently has 80 to 95% market share in AI and that level in the GPUs. AMD, watch that gap though in AMD around 108.70. A pretty interesting gap that it could fill there pretty soon. But yeah, incredible weakness by AMD and such strength from everyone else, Oliver.
Yeah, okay, so you're watching the same thing I am, like it, on the same page here. You
Yeah.
know, when there are little weak spots that show up, gives us something, you know, to keep an eye on here. But Amazon enough to offset it with a little bit of a slowdown, a couple days here in some of the big AI winners. Thanks, Renita, for taking us through it. Thanks, Kevin Hanks. Appreciate it, team. Let's bring in Gary Black, manager partner of the Future Fund, and I'm sure loving the big tech strength as much as anybody, of course, including and not limited to, though, Tesla's big run-up. Because you're a big Tesla bull, Gary, and I know you haven't changed your thoughts about it at all, right?
Nope, we're still bullish here, even though you know, it's up 110% year to date, but it had a bad, 2012. But, they're going to have good second quarter. The volumes will come out in a couple of weeks. They'll be up 75% year over year. The Cybertruck is coming probably in third quarter, which is a little early. And everybody's talking about it as an AI play. They've been investing a lot. They're going to start licensing their Dojo supercomputer probably next year. They're setting up a separate business unit, we believe. So that gives it a little bit even more spark. So we're still pretty bullish on it, even though it's up at about 52 times next year's earnings, but it's growing at 35%. So it doesn't look expensive the way we look at it, price earnings to growth. We think it's still a relatively cheap stock. We like it.
What do you think could be within the realm of possibility for Tesla stock? Could we be seeing all-time highs again in this company?
You know, we're still down from where we were. Back, remember, in the fourth quarter, Elon had to sell about $23 billion of his Tesla stock to buy Twitter, and you had all this discounting going on in China and then in the U.S. Revisions to make the stock go to a new high, which we think is possible. You've got to get revisions to turn around, meaning earnings estimates have been dropping all year because they took pricing down in the first quarter, and they've stabilized, and that's why the stock has had an amazing run since about May 15th or so. Because people believe that the second quarter gross margins are the trough, because we haven't seen any price cuts. Pricing has actually been stable. As we mentioned, people are getting excited about the Cybertruck. The last time they had a new product like this was in 2020 when they introduced Model Y, which was a crossover. And the stock, as you know, went up sevenfold in 2020 versus, I think, NASDAQ was up about 50%. So we think that's what you're going to get. Everybody's going to be very excited when Cybertruck deliveries start. It's very unique looking. I don't know if you've ever seen one up close, but it's about as big as an F-150. It looks like it belongs on Mars. But people are going to see it, and then they're going to go to the Tesla website or go to the Tesla store and buy a Model 3 or Model Y. That's what happened with Model Y. It just stimulated interest in the Tesla brand. And we haven't talked about all these EV charging arrangements between GM, Ford, now Rivian.
Yeah, everybody's on board.
The whole industry is getting behind the Tesla NACS standard. That's probably worth another 20 cents a share. We think the Cybertruck, because the street is underestimating it, is worth about 60 cents a share. So we think estimates for 2024, street estimates are about 70, 80 cents too low. And we think we'll start seeing people get more excited about Tesla as we get to the back half of the year and Cybertruck comes out. Now, but he downgraded stock. He took his earnings estimates up. So we'll usually, when people take earnings estimates up and price targets up, they don't downgrade the stock, but maybe he was just getting tired of it. Who knows?
The company's been important to your fund, the FFND ETF, the Future Fund ETF, year to date up 26%. Where is Tesla as a percent of that fund at this point? Gary, give us an update. And then also, do you, though, still have a fund that is dependent on a company, concentrated on a company here that obviously last year got slammed?
Yeah. So Tesla is about 10% of the portfolio today. Okay. We took it down actually before first quarter earnings because we thought the estimates were too high because of the price cuts. The stock at the time, the stock was about 180, and then we bought back about half of it at 168. Not that we were day trading, but we thought the estimates had come down enough. And then the annual meeting happened. And we just felt very optimistic that Elon wasn't going anywhere. There was some debate that, maybe he would go to Twitter and give up Tesla. He hired Linda Yaccarino to run Twitter, which is great. I know Linda. I've talked to her many times. She will be great at Twitter. So we think there's less of a chance that he'll have to put money into Twitter because we think she can turn this around. You've got 2024 for Twitter. You've got the election. You've got the Olympics. So they should be cash flow positive by the end of the year, and she's a very strong media operator, so we feel good about that.
So you feel it's not going to distract Elon?
Correct, and he's not going to have to put more money in, which is the most important thing. But more importantly, to your point, we think that earnings can start turning around here because the pricing has firmed up. Cybertruck's going to be huge. The charging contracts that they've set with GM and Ford and Rivian, and probably Stellantis is next, and maybe Toyota will be very good for Tesla. And in the meantime, we still have, the IRA credit just went into effect this year with $7,500. Tesla's getting on its Model 3 and Model Y, which are 90% of its volume. So we think there's a lot of information out there that is still not being incorporated into Tesla stock. So we're keeping it at about a 10% weight. We do worry a little bit about, the economy. Right. I heard you talk about before that if the recession hits, because the Fed insists on continuing to raise rates, as Powell has talked about the last 2 days, a recession will hurt the auto industry and it'll hurt Tesla. So that's probably the biggest risk, that the Fed does something stupid and keeps raising rates here.
Okay, well, the last part there, of course, your own opinion inserted. Maybe fighting inflation is the smart thing long term, even if it means Tesla going down. Another two-parter for you real quick, Gary. Number one is, do you think there are price cuts in the 6-month to year-long future for Tesla's cars like it did earlier this year and late last year? And number two, is that a sign, if it happens, that things are softening on the margin?
I don't think we're going to have more price cuts on Model Y, which is where all the volume is. That's now become the best-selling car and truck in the United States, even not just EVs, all cars. And the inventories are very low. We track the inventories every day. We can see them. And the inventories around the world are pretty low. So we don't see that. What we are seeing for the second quarter, there's some inventory discounts on Model 3, Model S, and X, which, again, that's not the same as a price cut. Because once the inventory is gone, or at least depleted, then the price cuts go away. So we are seeing some of that as we end second quarter. But I think that goes back to our investment thesis. Second quarter will be the trough in gross margins. Gross margins at Tesla, auto gross margins, were about 30% last year. They dropped to 19 after the price cuts in first quarter. This quarter, we think they'll get down to 17. And then we see a gradual increase back into the 21, 22, 23 range. We've already seen price increases on Model Y, since April as the inventories have fallen. So I don't think we're going to see price cuts. again, if and the other thing that's really important is the EV credit goes from being a tax credit this year to an instant rebate next year. And so that means you could walk into a Tesla store, take $7,500 off, and when you're coming up with your loan payments, it's based on a $7,500 lower price versus a tax credit. You got to wait for your income tax return, and then you get the credit back. Having an instant rebate off the purchase price is so much better, and that kicks into play January 1st of 2024. So there's really no need for a price cut, I guess, at this point in our mind.
Okay. Hey, real fast, you also launched a long short fund.
Yeah. Thanks for asking.
Can you give us the kind of 60-second elevator pitch on how you're going to run it?
So FFLS, it's very unique. There aren't many fundamental-driven, bottom-up, long-short ETFs out there. It's high conviction. We have 30 longs, 20 shorts, and we play off the same mega trends that we use on the long side. Same research, where we're looking at 24/7 information, entertainment, climate sustainability, big data, people living longer, lifestyle betterment. So when you see a short, it'll usually be something that's getting hurt by those mega trends. So a good example is Toyota. It's our largest short. Tesla's our second largest long. Google's our number one long. But Toyota's got 10% of the market globally, and they are nowhere in EVs. So as EV adoption continues to rocket ahead, it's 10%. Last year, it'll be 15 this year globally. We think it'll be 60% by 2030. They're nowhere in EVs. So it's our largest short. And so we're trying to look for offsetting hedges, because back to the market, we think the rest of the year is going to be pretty choppy. The Fed isn't sure. Well, we don't think the Fed, even though they sound sure, but we don't think they're sure they're going to actually raise rates the rest of the year. And so as we go through this choppy period, unlike the first 6 months, this is the first time that I can remember as an investor where we don't have really good clarity about what the Fed's going to do. They say they're going to raise rates by another 50 basis points, and that's what the dot plot says. But we're not sure, because inflation is coming down sharply. When you get to June, you're going to have year-over-year CPI down at about 3%. GDP, right now, it's estimated to be 1.5 to 2. So as we get into the July meeting, with inflation coming down, GDP coming down, and still systemic risk out there. You still have banks struggling because you've got money market rates of 5 to 5.5%, and they're paying 1.5 to 2% on deposits. So you still have the risk that the more they raise, the more that deposits could go out the bank's deposit window. And so as a result of that, you got a lot of systemic risk out there. So I believe as we get into the rest of the year, you'll have the economy choppy. And if the economy's choppy, a fund that hedges its longs with alpha shorts, and we're targeting, you got to be careful, we're targeting S&P returns with half the risk, because we are shorting. We're looking at about 100% long today. We're about 40% short, so our net's about 60. That net number can go between 40 and 60% based on our view about the economy and the markets. We're pretty bullish right now about the market, so we feel pretty good about it. FFLS is the ticker on the New York Stock Exchange.
All right, thanks, Gary. We got John. Appreciate it. Gary Blackman, partner of the.
He's talking about barbecue, Jack.
Come back. Let's dive into the financials behind the financial services.
Dave SPY bounces off this breakout.
Climbing over the last 3 years.
A little head and shoulders up here.
It's Innova International. We've got the Chief Financial Officer joining us to dive into the numbers and the strategy when we come back.
they're focused on here. FDA just approved their RSV pre-fusion F vaccine. That's a positive, but this stock's just struggled off over 20%
SPY 440
so
call.
far this year. Those updated
Nice, tasty,
vaccines
well done.
can then pull them, back to some normality here. But this has been one of the drug companies that has not performed well at all. And I saw some unusual option activity, and I brought this up because it's just an unusual type of trade, right?
The lack of love for GME on
spread that a trader bought.
Oh, yeah.
20,000 of the July monthly.
Yeah, he's got an emotional issue with
38 strike put. They bought
GME.
20,000 of those. They sold 40,000
That's a big bounce on SPY there.
of the 36 strike puts against it. And the net debit was 28 cents. So you've got 2 break-evens on this example trade. And you'll see from the risk profile here in a minute how it looks. You see there where they're expecting, this trader's expecting a little bit of down move, but not an implosion to the downside. That break-even of 34.28 is downside break-even. Anything above the upside break-even at 37.72.
Huge bounce there,
you
wow.
only lose that 28 cents that you paid by this 20 by 40,000 lot trade. But the apex profitability right at or near that short strike around the 36 strike, and then it tails off to that break even of about 34, just over $34. So interesting trade.
Interesting trade.
A lot of options contract, 30,000 or 3
Got the
times.
tail over there.
Yeah, 3 times normal trading volume as far as on the put side over the last 5 trading days. But an interesting trade, 1 by 2, where they expect maybe the stock to continue to grind a little bit lower and hover around that 36 level.
Well, they've got a specific payout structure, right? Where it's like, okay, I'm bearish, but I'm really confident I'm bearish to this point right here.
Right. And then I'm willing to buy the shares at 34.28.
Right.
Yeah.
Okay. Huh.
Yeah.
All right. Interesting trade.
Yeah.
You do have a bullish one for us today in Goldman Sachs.
Yeah, which has not done well this year. And you know what? Rates were up today, and I saw financials really struggling early on in the session. Goldman down a little bit here today, over 1%, down 6% on the years. They're starting to reevaluate CEO David Solomon following his costly and botched venture into consumer banking. This was a New York Post report. They're going to probably take more painful cost-cutting measures, according to Reuters. So there's a lot
Little
on the
pop on
table
barbecue
here.
there.
There's rumblings around the street that perhaps the board might try to oust Solomon. You know, one of the things that
he's
they
been DJing too much?
Yeah, that was one of their complaints, that hey, you need to focus on our business and not your DJ.
Out in the Hamptons.
Your DJ hits out in the Hamptons and stuff like that.
Having a good time.
Nobody wants it. But we did see some unusual option activity.
Didn't he like headline somewhere? Kind of like, didn't he?
Yeah, some festival he did. Yeah.
He made the festival circuit.
Right.
All right.
Yeah.
Okay.
But we did see some unusual option activity, but it's a longer duration type of positioning by this trader. October 350 strike calls to the upside. Trader would bought over 3,000 of those. Average debit is $6.30, so that takes the break even to $356.30 over the next 120 days. So you're giving yourself about 4 months in this position. That break even's 11% above the current share price. But if we start seeing a tick up in maybe the financials, which have been severely underperforming so far this year, everybody's talking about this rotation trade. Well, maybe you should take your winners out of tech that have been doing so well, rotate into underperforming sectors, and banking's definitely one of them. But this trader thinks over the next 4 months we're going to see Goldman return to some glory and get back above that $356 level.
All right, I don't know what day, month he started at Goldman Sachs, but I know he started in 2018. Since then, GS is, well, he actually started when it was closer to the lows, okay? So it's up about 40% since then. The overall financial index is up about half that, so they have beaten the sector benchmark, but, you know, Lloyd still kind of has a presence. You know, he's like kind of shadow over the company.
I think he made some comments about it.
He did,
recently. That CEO Solomon should just focus on the task at hand instead of scratching records there.
Yep. Okay. More focus on the job, less on the DJ gig. All right. Thanks, Tom. Someone's fading that report, though, because they're buying Goldman. Or I don't know, maybe it's unrelated. Maybe they think that if he does get replaced, it's good for the stock. Either way, someone's buying some upside in GS while they fade AI and Pfizer. Thanks for the options trades, Tom. Coming up.
Yeah, SPY retraced right up to that shoulder. I don't like to have position in the last 10 minutes, but we'll see.
was just thinking that this could be Twitter's first pay-per-view event. And this is what makes it profitable, and bam, it's on.
100%.
Barbecue stores set to close.
I have no question in my mind.
Yes, they've been closing stores for like a year now.
Well, as far as, there's a lot of different commodities that are making a bunch of big moves. I think that the grain markets that's a spot to be at. That's where all the action's at. The speculators are at. The funds reversed. They went back long. The farmers are in this weird predicament.
Like soybeans?
The grains, yes, grains. Remember? You eat grains. That's how this country was founded on grains. So wheat, soybeans, corn, there's just no rain out there. The crop is dry. The good to excellent ratio is dropping. The funds, like I said, got trapped. They reversed their positions.
10 minutes of
farmers
Fugazi
right now are scratching
with a
their heads
pump.
going, hey, maybe we'll take off our hedges, ride this a little bit longer. So grains have gone through the roof, man. That's the spot to be at. None of this trying to talk about treasury yields in 2 years and things like that. That's just too boring. Grains are where the fire's at.
Well, there's been a pretty sharp move here in beans and corn. We're looking at corn right now. Beans basically look the same way. So that's your drought right there? You think it's got more to go?
100%. That's where it's at. If they don't get rain in the next week or two, anything substantial, they're gonna have to call it quits. They're gonna have some acreage losses. You're gonna see those yields come down quite a bit, and we could accelerate higher. The problem is that me being a precious metals bull and things like that, what happens when these food prices go back up, the inflation story
goes down.
Yeah. So I think that's what the Bank of England was doing. They came out and they said, hey, look, we got to get ahead of this thing. We're going 50 basis points, rip it off like a Band-Aid. And that's what they're attempting to do. And that's another reason why these precious metals keep going down, because the Fed is probably going to follow that type of path.
All right. Like that to the point, specific sector trade. Sprinkle a little macro on top. You know how to make me happy. Phil Strebel, appreciate it. Chief Market Strategist, Blue Line Futures. Bullish on the grains. Corn, soybeans, and wheat all been ripping here the past week. Might have missed it, but pretty interesting one to target there. And maybe some inflationary implications too. Let's start there in our discussion with the big picture Schwab team. Cooper Howard and Michelle Gibley here with me this afternoon. Cooper's the director and fixed income strategist. Michelle's director of international research. Right on cue, Michelle, as we've got a little talk about the Bank of England there from Phil. A pretty substantial hike. How the heck is our dollar higher here this afternoon?
Well, I think some of the hike was somewhat expected. It was either 25 or 50 basis points that we knew that they were likely to do. Inflation there is just too strong. And so, they hiked by 50 basis points. It's another in the string of hawkish moves we've seen by central banks lately. Norway also accelerated today to 50 basis points after hiking 25 the last time. And, the Bank of England still has a lot of work to do. Markets are expecting them to hike by another 100 basis points by November, and that's only 3 meetings. So that means one of those might be 50 basis points again.
Not to belabor the point, but and sometimes I do admittedly kind of get caught in some of the short-term stuff here, but I am just shocked that the dollar is not lower after our Fed chair said that inflation is going to be a problem, but he's going to fight it later. And then their central bank said inflation's a problem now. We're going to go even more aggressive, and we're going to have to keep at it. In theory, shouldn't that be dollar negative unless Jerome Powell's got a big hawkish surprise coming out soon, Michelle?
Well, one thing today is that the yen is quite weak. And, Japan just looks increasingly like an outlier on rate hikes and inflation. And the Bank of Japan is likely to welcome a return of inflation. And, right now they're waiting, but that doesn't mean they can't increase rates later.
Okay. And fitting with our morning discussion is Ben was focused on Bank of Japan too. So a good reminder here that they're still looking for growth and okay with a little inflation. Cooper, is it possible? What do you think as a bond guy? Is there a silent message in the dollar's strength about just how hawkish Powell could be down the road?
I really don't see it as a silent message in what the dollar is saying right now. I think that if we look at what Powell and the other chairman or the other Fed members, have come out and kind of hinted at and said, especially yesterday, is that they do want to hike rates again in this cycle. Now, I would expect that that would mean at least one more time, potentially two more times. The dots plots, that opened it up to potentially two more times during this cycle. So that does leave the door to it. But what the Fed is doing right now is that we're probably near the peak in the rate hiking cycle. Chairman Powell has been explicit and clear about that one of the examples that he used is it's like driving a car and nearing your off ramp. They're starting to slow down from it. So he does think that by pausing, but also suggesting that they are going to continue rate hikes, those two views aren't inconsistent.
5 minutes
So I think
base slap.
right now the market's kind of
The
reacting
upside.
to that. We're seeing yields up a little bit on the day. So I think that that's really the story that's happening.
Huge retest of the high.
Okay. Michelle, if we look at inflation around the world and its relationship with the U.S., what's that look like?
Cohen tweeted,
there's levels out
my
there
boss
much,
doubled
much
my pay and
higher
made me
than
employee
our
of the
own.
month.
Does that not creep in here? Can we keep it separate?
Talking
Can we
about
assume that
furlong?
if we're going to deflate, we're going to do it separate from the rest of the world? What's the connection?
Dude.
I mean, I think there are
Gotta be, right?
factors that are similar. Central banks were kind of late to start raising
Gotta
rates.
be about furlong.
Certainly, energy and food prices have been high globally.
My
But I
boss
think
doubled my
there are
pay and
some
made me employee of the
factors in
month.
different countries that you're starting to see a little bit more of asynchronous rate hikes. In the UK, Brexit probably hasn't helped their case. Like I said earlier, Japan is still low.
Got furlong.
Inflation. And
Working somewhere
also,
else.
the central banks have gone by different
He doubled his
rates.
pay.
So, the Fed is
I mean, maybe not
able to
doubled,
regulate
but
more aggressively than other
maybe.
Developed market central banks. If we look at it compared to the Bank of England only started going more than 25 basis points 6 months
No, the
after the
algos
Fed,
don't pick up. This is from
only
SPY.
raised by 75 basis points
Algos don't pick
once,
up RC tweets
versus
anymore.
4 times for the Fed. So, there are just different factors going on.
Okay. Cooper, with the presentation from Powell finished here.
Give himself a raise?
Information that we gathered this week.
Oh, that's a good point too. Yeah, because he changed roles.
I really don't
Could be as simple as that.
New information that we gathered this week, especially today. Yesterday was really kind of the bigger news story, the bigger event.
Yeah, he's maybe just
Today
kidding
was
around
really
because
kind of
he's his own boss now.
story event.
He's always,
Just really reiterated that
always been his own boss.
that the rest of the FOMC
Play of the month.
really want to get inflation under control. So
Yeah, maybe he's just screwing around.
back to what
Because
Jim
now
was
he's
talking about,
chairman,
cage match,
executive
you
chairman.
can see the Fed's fighting a cage match with inflation right now, or in a cage match with inflation, I should say.
Or he's talking about
I don't
furlong.
think that we got really any new information. If we look at what the market is expecting a rate hike at the next meeting. Right now, there's about a 75% probability of a rate hike. So I would expect that that would be the case. And I think that right now, if we do continue to see the talk about higher yields on the short end of the yield curve, then we'll continue to see an inverted yield curve. We saw the 210 spread reach down to about 100 basis points, negative 100 basis points today. So that's one of the lowest levels going back for quite some time. So I would expect we'd continue to stay in this major negative environment going forward. But I really don't think that what was said yesterday or today is any new information. It really reiterates just all of what we've heard before.
All right. And jobless claims this morning, real quick, Cooper, which side of the cage match is that on, inflation or the Feds?
Yeah, but corporate America.
What that shows is that the
Could be.
labor market continues to remain tight. However, it is a little bit of a lagging indicator. So if we do potentially go into a recession, then I do think that that's where you would start to see those jobless claims tick up a little bit higher. But right now, the labor market's in pretty good.
I guess I'd think up furlong because that's
Michelle,
from his last
let's
tweet.
Go outside the box real quick. Outside the U.S.,
And
Prime Minister.
we're already thinking maybe that he had another place for him.
What does that make you think about that region?
I don't know. That's maybe just my bias.
We're getting a lot of questions about India in terms of investment. The consumer market there is growing.
I don't know if SPY's finished making this handle.
Entering the middle class.
Really don't think so.
Also,
Got an inverted head and shoulders here now.
manufacturing base because the
That head,
government's
shoulder,
making
shoulder on the hourly.
to reduce red tape and giving subsidies for meeting production targets. And
It
so
still wants to
it is
move up.
a unique
437.
opportunity.
Maybe that
The
gap
stock
fill.
market is near all-time highs, but valuations there reflect a lot of optimism. Its price to earnings ratio for the overall market is above its longer term average.
He's not taking a pay.
So,
Yeah, I kind of remember something like that too.
A little bit cautious, but it is certainly something that's interesting.
All right.
Yeah, this whole day is inverted head and shoulders.
Guys, nice to hit an array of topics here this afternoon. As stock markets finish firm, Cooper Howard, Michelle Gibley. Let's look at the indexes in about 90 seconds. We'll come back for the closing bell.
All right, rallying up. And then to close, you're about to get fired. Close it down. I want to hear that bell. GME trying to fill this gap into close. Yeah, I'm still getting lag on my browser. Something else is up. Something else is going on. Maybe relocate can help me figure it out. If you guys are on Discord and have any insight to what's happening, that would be much appreciated. Seems to be a little better with Edge, but I think it's just what's the word? Showing itself more or less, showing itself with my browser because that's all I'm really using. So still a CPU issue, but it's only evident from my browser. I don't know, I've used Premiere lately and I didn't get any CPU stuff with that, so I'm not sure. But yeah, thanks guys for the support, appreciate it today. We had Powell again, pretty choppy day once more. Very similar to yesterday really, a little bigger range. Gap down with a rally up. Bears are taking control in the extended hours. Bulls are taking the fight back to them during the day. Continuing to gap down and rally. But tomorrow being Friday, and this inverted head and shoulders, I think will be might be a gap up or a rally up of sorts. I think 438 could be 437, I suppose. I almost hit there today. So looking for, okay, there's a gap there too. Looking for a gap fill here. And then maybe this is the resistance, or we get all the way up to 438.97, 439, and finally top, or even this spot here. Yeah. No signs of reversal. I think the reversal day will be pretty evident. Might not happen tomorrow, but not till next week. I think it'll be a morning where it pumps for a bit, and then the rest of the day is just going to sell off. We're going to probably break through all of these supports. You know, just going to go, we're probably going to flush all the way down to 432. Or we're not bearish at all, and we're still in an uptrend. Actually, looking at the daily, look at that. Still kind of in a channel. This is a clear bull flag. This could also still be a bit of a bull flag. Today's candle is engulfing also. Yeah, really just need to see if we find resistance anywhere. The upside. Otherwise, we're still bullish. Crazy. Just with some consolidating the last few days. Thanks, Christopher. Thanks, Tasty. Appreciate it, guys. Thank you guys for the support. Kind of slow. It is the summer months. Slower volume, less trading. We got to 34 likes today, though. I appreciate it. Thanks, Kitty Daddy. Yeah, so on these Powell days, I've been just commentating less just because we've been listening to Powell. So typically think it's important to listen to that stuff, even though sometimes it's just for comedy. And so I'm usually quiet, just listening. But yeah, thanks for watching, guys. Thanks for the support. Thanks, Trace. Thank you. We'll see you on Discord or Twitter.